Exchanges on navigating macro uncertainty. Exchanges on the forces shaping global markets. For the sharpest analysis on finance, business, and the economy, count on Exchanges, the Goldman Sachs podcast. Listen now.
News when you want it with Bloomberg News Now. I'm Doug Krisner. The U.S. government shutdown is now in its 34th day, and some senators are predicting this could be the week to finally break the impasse. However, those informal chats haven't involved party leaders nor President Trump. Meantime, the Trump administration said it will partially fund the supplemental nutrition program for the month of November. This is after two judges issued rulings requiring the government to keep SNAP running. Now, the Agriculture Department had planned to freeze payments beginning November 1st due to the shutdown, but now the USDA will use an emergency fund with $4.65 billion to cover about half the normal benefits. Here is House Minority Leader Hakeem Jeffries, who criticized the move.
42 million Americans who are at risk of going hungry. This includes 16 million children. This is an intentional decision not to pay full benefits because the money exists in a contingency fund to ensure that not a single American, not a single child, not a single veteran, not a single senior goes hungry.
House Minority Leader Hakeem Jeffries speaking there. We go to earnings news next. After the bell, Palantir Technologies reported third quarter results above analyst estimates, and Palantir raised its annual outlook. The company cited accelerating and otherworldly growth for its artificial intelligence and data analytics products. We got reaction from Gil Luria. He is head of tech research at D.A. Davidson.
This really is about the fact that this company is doing so unbelievably well. This is by far the best software company, and they keep raising the bar for themselves at a level that nobody.
हेलो एवरीवन, गुड मॉर्निंग टू ऑल ऑफ यू. वेलकम वंस अगेन टू दिस लाइव एनालिसिस. स्टार्ट करते हैं आज का सेशन. फिलहाल के लिए देखोगे क्रूड ऑयल और नेचुरल गैस को फिलहाल के लिए तो फ्लैट ओपन हुआ है. ऑलमोस्ट नेचुरल गैस, क्रूड ऑयल हल्का सा गैप डाउन कल वापस गया था ऊपर, वहीं साइडवे चला गया था क्लोजिंग बेसिस पे. देन आज फिर से गैप डाउन ओपन हुआ है सपोर्ट एरिया पे. लेट्स सी, ऊपर जा ही नहीं रही है. पॉइंट ऑफ इंटरेस्ट से ही रिटर्न हो जा रहा है ऑलमोस्ट. तो अभी भी पॉइंट ऑफ इंटरेस्ट के ऊपर प्राइस नहीं जा रहा है. लेट्स सी क्या होता है. बाकी निफ्टी बैंक निफ्टी को देखोगे मॉर्निंग पे ओपन होते ही सेल ऑफ आया है. लेट्स सी थोड़ा कंटिन्यू करता है क्योंकि नीचे सपोर्ट भी है निफ्टी 50 में स्पेशली. बैंक निफ्टी भी देखोगे ओपन इक्वल टू हाई पहली कैंडल फ्यूचर की, एंड देन कंटिन्यू सेल ऑफ में जा रहा है. दूसरी कैंडल भी ओपन इक्वल टू हाई ही है. बैंक निफ्टी का मैंने देखा नहीं है सपोर्ट. निफ्टी का तो नीचे सपोर्ट है. लेट्स सी क्या ये सपोर्ट ब्रेक करता है या फिर नहीं. मल्टीपल टाइम टेस्ट हो गया है, हल्का सा आइडेंटिकल सपोर्ट बन रहा है. ब्रेक हुआ तो फिर बड़ा फॉल आएगा. ठीक है, 25,790 के अराउंड ये सपोर्ट जोन है. पहली बार यहाँ से बाइंग करके ऑलरेडी प्राइस चला गया था 28 अक्टूबर को, फिर कल आया था 3 नवंबर. आज फिर से उसी लेवल पे आ रहा है. लेट्स सी ब्रेक करता है नहीं करता. अगर यहाँ पर ब्रेकडाउन सक्सेसफुल रहता है बिलो 25,750 के नीचे, जो कि 750 से 800 के बीच में सपोर्ट है, इसके नीचे अगर मार्केट ब्रेकडाउन सक्सेसफुली करता है तो फिर थोड़ा सा एक और सपोर्ट जोन है उसके नीचे, मोस्टली फिर वहां तक जाने की कोशिश करेगा, विच इज अराउंड 25,680 टू 25,700 के बीच में. तो ज़्यादा गैप नहीं है दो सपोर्ट के बीच में. लेट्स होप अगर इसको ब्रेक करता है तो फिर नीचे वाले से सपोर्ट ले तो ऑलमोस्ट सपोर्ट के अराउंड है. जो सेलर्स हैं थोड़ा ध्यान रखना अगर ऑलरेडी सेलिंग में हो. इन निफ्टी 50 फ्यूचर की बात कर रहा हूँ. ये लोगों ने लाइक नहीं किया गाइस, डोंट फॉरगेट टू लाइक द स्ट्रीम. डेटा की बात करें 12:30 लंदन सेशन ओपन होगा, 7 PM यूएस मार्केट ओपन होगा, 5:30 न्यूयॉर्क सेशन ओपन होगा और कोई डेटा नहीं है। कुछ अगर न्यूज़ वगैरह आती है इसका डायरेक्ट इम्पैक्ट होगा तो देखेंगे। अभी के लिए फिलहाल और कोई न्यूज़ नहीं है इसका कोई डायरेक्टली इम्पैक्ट मार्केट पे देखने के लिए मिले। कि बाकी लेवल सेम ही है, कुछ चेंज खास हुआ नहीं है। आई कांट सी एनी चेंज इन द लेवल इन क्रूड ऑयल एंड नेचुरल गैस। ठीक है, कोई स्पेसिफिक चेंज लेवल में दिख तो नहीं रहा है मुझे, सेम ही लेवल है ऑलमोस्ट। कि अगर निफ्टी 50 ऊपर आता है वापस तो डे हाई रेजिस्टेंस है, वापस सेल ही कर सकते हैं वहां पर अगर नहीं कर पाए हो तो। बाकी ऊपर जो मेजर रेजिस्टेंस है निफ्टी 50 में 25,980 के अराउंड मेजर रेजिस्टेंस जोन है। नेचुरल गैस स्टिल सेम लेवल ही है, कुछ नया रेजिस्टेंस रेजिस्टेंस सेम ही है, कुछ चेंज हुआ नहीं है। रेजिस्टेंस वापस सेल कर सकते हैं ऊपर से, यू कैन सेल अगेन इन नेचुरल गैस फ्रॉम द सेम अबव लेवल। सपोर्ट भी कुछ नया तो बना नहीं है। नीचे कोई नया सपोर्ट भी नहीं है, दैट इज द सेम लेवल फॉर सपोर्ट जो नीचे लगा रखा है। कुछ नया सपोर्ट होगा तो देखेंगे, अभी के लिए यही सेम लेवल है एज अ सपोर्ट एरिया। सपोर्ट पे आया ही नहीं एग्जैक्टली, लेट्स सी आज अगर आ जाता है। ठीक है, तो लेवल सेम ही है, वापस ऊपर सेलिंग का प्लान कर सकते हैं। इसके ऊपर भी देख लेते हैं, एक लेवल अगर ब्रेकआउट होता है तो नीचे सपोर्ट तो स्ट्रांग ही है। एक्सपेक्ट दिस रेंज अनटिल अनलेस कोई नया सपोर्ट और नहीं बनता है इन नेचुरल गैस।
News when you want it with Bloomberg News Now. I'm Doug Krisner. The U.S. government shutdown is now in its 34th day, and some senators are predicting this could be the week to finally break the impasse. However, those informal chats haven't involved party leaders nor President Trump. Meantime, the Trump administration said it will partially fund the Supplemental Nutrition Program for November. Two judges today issued rulings requiring the government to keep SNAP running. Now, the Department of Agriculture had planned to freeze payments beginning November 1st due to the government shutdown. But now, the USDA will use an emergency fund with $4.65 billion to cover about half the normal benefits. Here is Bloomberg's Tyler Kendall.
This was compelled by a pair of federal judges that said that the administration had to look for some sort of solution with this contingency funding. But at this point, they're saying it's partially funded. It is unclear just how much recipients are going to receive and how quickly they will get that money. It looks like it might be replenished sometime later this week around Wednesday.
That is Bloomberg's Tyler Kendall. Meantime, the FAA was forced to slow traffic at many airports due to rising controller staffing shortages given the shutdown. Today, Transportation Secretary Sean Duffy said he would close U.S. airspace if officials determined air travel was dangerous. Here is Duffy speaking on CNBC.
If I have a controller doing two jobs, and by the way, they're certified, they're able to do both of those jobs. But is there more risk in the system when you have a shutdown? Absolutely, there's more risk. But if we thought that it was unsafe, we'll shut the whole airspace down. We won't let people travel. We're not there at this point. It's just significant delays.
Transportation Secretary Sean Duffy speaking to CNBC. We go to earnings news next. After the bell, Palantir Technologies reported third quarter results above analyst estimates, and Palantir raised its annual outlook. The company cited accelerating and otherworldly growth for its artificial intelligence and data analytics products. We got reaction from Gil Luria. He is head of tech research at D.A. Davidson.
This really is about the fact that this company is doing so unbelievably well. This is by far the best software company, and they keep raising the bar for themselves at a level that nobody else is even close to. This is a company with a $4 billion run rate that's growing 63%. There's nothing even remotely close to that.
That is Gil Luria from D.A. Davidson. Starbucks is selling a 60% stake in its China unit to the private equity firm Boyu Capital. Price tag here is about $4 billion. Now, this new joint venture will give Starbucks a 40% interest, and the company will continue to license the brand and intellectual property to the joint venture. Fed Governor Lisa Cook sees the risk of labor market weakness being greater than the risk that inflation will pick up. Today, Cook said she's expecting inflation to remain elevated for the next year due to the effects of President Trump's tariffs. However, she went on to say inflation could recede toward the Fed's 2% target once tariff effects fade.
The big caveat is that tariff effects must prove not to be persistent, and that monetary policy remains appropriately focused on achieving that goal. Looking ahead, policy is not on a predetermined path. We are at a moment when risks to both sides of the dual mandate are elevated. Keeping rates too high increases the likelihood that the labor market will deteriorate sharply.
Fed Governor Lisa Cook speaking at the Brookings Institution in Washington. She did stop short of endorsing another cut in interest rates next month. She said every Fed meeting, including the one in December, is a live meeting and that Fed policy is not on a predetermined path. Microsoft has signed a deal to buy artificial intelligence computing capacity from Australia's IREN Limited. This contract is worth roughly $9.7 billion. And separately, Microsoft is planning to spend more than $7.9 billion in the United Arab Emirates over the next 4 years. Here is Microsoft President Brad Smith.
If you look at the UAE now literally leads the world in the percentage of the population using AI. 59.4%, number one. Singapore, about a point behind, is number two. Wow. But what we're seeing here in the UAE is across the economy, whether it's companies like ADNOC in the energy sector or the financial services or the healthcare sector, All of this is being put to work.
That is Microsoft President Brad Smith speaking to Bloomberg. Shares in Microsoft finished the day down more than 0.1%. Tomorrow is Election Day, and voters are heading to the polls for governor's races in both Virginia and New Jersey. And in New York City, a new mayor will be elected. Frank Luntz is pollster and CEO of FIL. He says those are not the races he is keeping an eye on.
It's the California redistricting ballot initiative, because that's going to determine who controls Congress. If the Democrats are successful, if they win that initiative, it will be 5, maybe even 6 seats switching from Republican to Democrat as they carve up the state more politically.
Frank Luntz there. He is a pollster and CEO of FIL, speaking on Bloomberg's balance of power. And that is news when you want it. With Bloomberg News Now, I'm Doug Krisner, and this is Bloomberg.
Very good conditions. We're in an equity bull market, Mag 7 and everything else. We've had this historic meeting last week between the two presidents, U.S. and China. What do you make of the state of play right now? Are we in a much better position than we were at the start of the year?
Well, it seems like the meeting was constructive. I'm watching the news the same way you're all watching the news. I think at the moment, a de-escalation is a good thing, but there's obviously a lot of work to do to really arrive at a real stable deal that can endure, over a period of time. I'm encouraged by the prospect of a potential visit from the U.S. president that was telegraphed in the fall. But for the moment, I did not think the escalation on either side was constructive. And so, I much prefer a de-escalation. And I think both sides really had a purpose in that meeting to talk constructively, to have a more de-escalated environment. And that allows now for constructive conversations as they move forward.
1 year truce, though, is there pros and cons to that? What does that do to business?
I couldn't hear what you said.
1 year truce, though, between the two. Is that a good or bad thing? I mean, what does it do in terms of business sentiment when there's a 12-month time frame now we're talking about?
It's better than an escalation at unreasonable levels, which is kind of where we were, over the most recent time. Trade negotiations are complicated, and there are a lot of issues on the table. They need thoughtful responses and responses that can be durable, that both sides embrace and get to the right place. Yes, there's some uncertainty because it's a 1 year, delay in all of this, but it's also a realistic period of time to try to get the right kind of deal done so both economies can move forward in a constructive way. And look, these are the two most important economies in the world. Right. I think it's very important that, we arrive in a better place where we can both participate constructively with each other in the global growth of the world.
I mean, speaking of, let me borrow your phrase, participate, there's been a resurgence in equity capital market raising here in Hong Kong. A lot of the Chinese companies, tech or otherwise, are raising capital for the future. I want to get your sense, as someone who sits in New York, you travel, of course, all around the world. Is there a lot of appetite now from U.S.-based investors to participate by giving that capital to Chinese companies right now in order to realize their ambitions?
Sure, there's more appetite for it than there was 12 months ago. I remember actually last November sitting in a dinner in the United States with a group of U.S. investors, and this topic came up, and there were a couple of investors that basically said we all should be looking to China, and the reason that had evolved that way is if you look last fall, the prices had gotten so cheap. The capital flows had moved so in the other direction that you just knew that things would come more into balance and there'd be a recycling. And we've seen that recycling. You've seen a big move in prices year over year. You've seen more foreign capital come in and start to participate. That's a fundamentally different question about the big capital allocators really fundamentally shifting their allocations up to be higher again. So foreign direct investment in China has come down. Yeah. And I think one of the big questions is until we understand kind of the trade and the geopolitical landscape, it's harder to see significant shifts back to higher levels of foreign direct investment and more capital allocation. But for the moment, those flows are making for a better IPO market here and more opportunities here.
How do you look at that? I mean, the whole competition has kind of changed into the dynamics, right? You have so many of these Chinese banks now that are doing some of these deals with Chinese companies when it comes to going public. How does Goldman Sachs compete?
Well, Goldman Sachs competes just fine, thank you very much. When it comes to taking companies public on a global stage, Goldman Sachs is a leading position. We've had a moment. Those flows are making for a better IPO market here and more opportunities here.
How do you look at that? I mean, the whole competition has kind of changed into the dynamics, right? You have so many of these Chinese banks now that are doing some of these deals with Chinese companies when it comes to going public. How does Goldman Sachs compete?
Well, Goldman Sachs competes just fine, thank you very much. When it comes to taking companies public on a global stage, Goldman Sachs is a leading position. We've had a leading position for 50 years, and there's always competition in the business, and we'll continue to compete. So we welcome competition, but we have a pretty active footprint out here, as you well know. We have a pretty active footprint around the world, and look, one of the big advantages. I just had breakfast this morning with a company here. That it's actually a Chinese company, but the CEO, the founder, was here. And why does he value Goldman Sachs? He values Goldman Sachs because we have access to people, information, capital markets all over the world, not just in a narrow portion of the world. And so it's a competitive business. It always will be. But I'm comfortable that we have the resources and the position to compete effectively.
Right. And, I've been reading up, of course, and I understand your history. You guys have been doing business in China a very long time. You guys took the big banks public back 20 plus years ago. So, I mean, you're headed there, my understanding, after here. You're going to China, of course, to speak with regulators, what have you. What's your long-term vision for the franchise in Greater China? What do you want? What do you want your franchise to become longer term?
I think you have to look at Goldman Sachs and just think strategically that as a global firm, that when you think about our businesses, what are our two big businesses? Global banking and markets, the investment banking and trading business, and asset and wealth management. And so if you think about how we think strategically about the firm, what advantages does the firm have? Besides the fact that we have at-scale businesses, we're very good at those activities, we're leaders in those activities, and we have a right to compete and win, in those activities. Another big advantage for the firm is we're truly global. And in fact, we're more global and have a capacity to communicate and interact globally for our clients in a way that not many firms can. And so if you think about where GDP is in the world, where big economies are in the world, China is always going to fit that bill. And barring a much more significant shift in geopolitics and the relationship between the U.S. and China, there are definitely issues. There are definitely things that need to be sorted. But China is going to continue to be one of the most important economies in the world. The U.S. is going to continue to be the most important economy in the world. And we're linked. And so as a big global firm that does what we do, we have to be long-term committed to serving our clients that need access to advice, capital, and resources, in China and around the world. And of course, we've got to do that in whatever environment the regulatory structure or the geopolitics play up. But we're long-term committed. We've been long-term committed, and we'll remain long-term committed unless there was something that significantly changed that.
I'm glad you mentioned that because we've seen governments being, I guess, more involved in some of these business deals. I take a look at Intel, for example. I look at Nippon Steel, even CK Hutch, which Goldman Sachs was a sole advisor to. What's the advice now to clients now in terms of that intervention risk?
Well, you just mentioned three different deals, and they're completely different.
Right.
I mean, they're completely different. Governments are always going to opine and weigh in on different transactions. There are regulatory approvals in the United States. There's CFIUS. There are all sorts of issues where governments weigh in. That is a very different thing than a government taking an investment, in a specific company. Sure. Wouldn't surprise you, I'm not a big fan of that as a general practice. That doesn't mean there aren't exceptions, because I believe that the markets should allow capital formation and competition, around companies. And, this administration is in one or two situations. They're taking actions like that. As I said, I'm not black and white and dogmatic. There can be exceptional circumstances. But I don't think as a general practice, having governments take stakes in companies is the direction of travel we want our free market system to go.
Right. You mentioned how would you describe the current environment for deals going into next year? Because I remember just sitting here this time last year, and we were going into 2025. There was a U.S. election. We weren't sure where the guardrails were going to be. Looking at next year, I was just speaking with Yvonne. I can't seem to think of a major risk apart from, I guess, frothy valuation. We can talk about that later. But what's your sense of the environment right now, and what risks we have to consider? What's not obvious?
Well, in the U.S., and the U.S. is a huge part of the global M&A market, either for target or acquirer.
Right.
I would say it's extremely constructive, and we see it, in our advisory business. You can take a look at our, M&A revenues last quarter, which are a reflection of deals closing. But if you also go through our earnings call, we made a comment about the level of our M&A backlog,
yes.
the very high level of our M&A backlog.
Yeah.
And that's just an indication of the fact that there's a lot of activity inside the firm. I say this is really rooted from the fact that we went through a period for 4 years during the Biden administration where if you wanted to do something strategically, if you wanted to do something significant from an M&A perspective, whatever the question was, the answer was no. We're now in an environment where whatever the question is, the answer is maybe. And I think CEOs are unleashed in believing that they have a chance of doing strategic things to advance their position, to advance their scale, to advance, how they sit competitively. And so we see a tremendous backlog of significant consolidating situations, what I'll call large cap M&A. Large cap M&A in the United States is up very, very meaningfully. Deals over $10 billion, very, very meaningfully year over year. And so I think we're in a pretty constructive environment. And my expectation is 26 and 27 will be quite constructive in terms of large cap M&A, particularly in the United States.
Obviously, we've been talking about AI. That's a big thing in terms of how does it work for Goldman Sachs in terms of operational efficiencies? How does the onslaught of AI really going to impact how you hire or even just headcount in this part of the world now, David?
Well, it's interesting to me that you go right to headcount, and I actually think that that's a different lens than the lens that we would look at. And I don't know if you saw, but when we reported earnings 2 weeks ago, we put out a memo that we called Goldman Sachs 3.0, where we highlighted the approach that we were taking to integrating AI, and we talked about a handful of things that were goals, including, operating efficiency, automation, better sales management, and then we identified 6 processes that we were going to look at from a very fresh perspective to see if we could automate them and build better efficiency so that we would have more capacity to invest in areas in the business where we see growth opportunities. And so, I think for a firm like Goldman Sachs, there are 2 avenues here. One, we have very smart people.
Right.
And we can put these tools in their hands, and that makes them more productive. And by the way, that's no different than 40 years ago when I was starting, and somebody gave me a desktop computer and Lotus 123 software, and I had the ability to do a spreadsheet in a fraction of the time that it took me before that tool was put into my hand. That just continues. That's been going on for 40 years. It doesn't mean we have less smart people inside Goldman Sachs. If you look at Goldman Sachs' productivity per person, it's much higher today than it was 25 years ago. And my guess is 25 years from now, it will be much higher than it is today. But our goal is to figure out ways that we can invest in growth, because we see lots of growth in our franchise. By using AI technology to reimagine processes, we can create operating efficiencies, and it gives us more of a scaled opportunity to reinvest in growth in the business. And look, of course, over the way, there are going to be shifts in jobs and job functions, as there always have been. I think one of the things you've got to wrestle with today is the pace of this is quicker. And so since the pace is quicker, there's a chance that it might be a little bit more disruptive, in the short term. But at the end of the day, technology changes jobs, it changes the way people work. This has been going on for a long, long time. It is continuing. I don't think it's different this time.
Connecting the dot between what's at stake and what is possible. Connecting the dot between what's at stake and what is possible.
Investor. Let's get insights from Kalpesh Parekh, MD and CEO of DSP Mutual Fund, one of India's largest quant funds. Kalpesh, good to have you with us. Isn't this IPO so expensive? We're talking about valuations of in excess of $820 million. It is expensive, isn't it?
So, Aslinda, we don't comment on individual stocks, and especially when the IPOs are going on. So it won't be right for me to make any comment specifically on any particular company on a public forum.
But 45 times forward earnings on a normal occasion, is that okay? How would it look for companies looking to IPO?
So I think, see, in the last few years, there are so many new profit pools which have emerged in the Indian market, and new business models which have emerged, whether it is in consumer tech, whether it is in wealth management. 4 asset managements have got listed in the last few years, and some of them have created immense amount of wealth. Exchanges have got listed, and as money managers, what we do is we always analyze companies around their future prospects, around their pedigree, like we do for any listed stock. So I think that, like in the listed market, there are existing companies which make money and don't make money. So is the case with the IPOs. From our perspective, like I said, in the last few years, we've been invested in so many wealth management companies, a couple of asset management companies, and we decide how to allocate capital. And largely 95 to 98% of our portfolios are in existing stocks, and that has done well for us.
Calvin, what is attractive about Lenskart? Is it the fact that it is scalable? It is a scalable business. Is that a good enough reason to be investing in this company?
So, Aslinda, you'll have to call me a couple of months later, because like I said, when the IPO is on, we generally don't comment on individual stocks. Either ways, I represent an asset management company which is $26 billion. So happy to talk about the broad markets and broad strategies and ideology that we have. I will not be able to speak specific on individual stocks.
Are you concerned that the current market, if you talk about, the broad macro picture of the Indian market, it's been propped up by retail investors? Is there reason to be concerned that retail investors are propping it up while foreign investors are pulling out? And we're talking about in excess of $16 billion for the year.
So I think, every market goes through its cycles of growth and valuations. What we have to look back is over the last 35 years now. 35 years is a long history of 3.5 decades. Indian markets have, in dollar terms, in spite of a 3% currency depreciation, outperformed any other market in the world. And the primary reason for that is, Indian corporate sector offers very attractive return on equity, return on capital, almost 16% ROCs. The highest in the world, barring maybe US. You have capital efficiency. There is a 12 to 14% long-term earnings growth rate in this market, and promoters have respected capital, and shareholders have been rewarded. So I think in that context, India has deservingly been a premium market compared to most other markets over the last decade or so. No doubt, when you are at 25 times to earnings multiple, markets are a bit stretched, maybe 1 year ahead of fair value. But last year, we've already seen that consolidation. In the last 1 year, Indian markets have been broadly flat, and which makes them, move closer to their fair value and take away some of the fraud. And the beauty about investors in India who are investing over the last 6 years now, this is the 53rd month in a row where Indian investors have continuously kept on investing, is they are not investing at a point in time. They are investing every month. So in the last 6 years, investors have bought the COVID lows. They have bought the lows that happened at Ukraine-Russia war. They bought the lows during the Israel war or the India-Pak geopolitical. So in 5 years, you've got 4 lows intermittently. And this series of money coming in every month through something called as SIBs has really benefited investors, because they've not bought at highs. They've bought all through ups and downs. And I think it is the discipline of investing which is creating a very disciplined cult of investing in India in the last so many years.
So foreign investors are missing out, you say. You say the froth is gone, it's fair value. What would you say then?
No, I think, see, every investor has choices in the world, right? Global investors have choices to invest across the world, including India. And even today, see, global investors have been investing in India since '93. It's been 32 years. They've been as loyal or more loyal to Indian markets than even Indian investors. And there are periods when they do profit booking, they rebalance. So having seen, some parts of the market becoming frothy. So, last year, let's say exactly 1 year back in 2024, September, when our markets were expensive, there were two sides of the market. You had banking stocks which for 5 years had earned less than a savings account return on the stock. And then on the other hand, you had industrials and engineering stocks which were at a premium. So in the same market, there were two components. And there are opportunities. So I think global investors have rebalanced after almost 2 decades of significant returns. And I think last year, relatively, they had opportunities in China, in Asia, in Europe. To some extent, they've rebalanced. And I think it's part of the game. It is allowing markets to remain, more meaningful in terms of valuations and not becoming euphoric, and which is great for an investor who's coming in today.
Right. Kalpan, one of the reasons why foreign investors are not convinced about the Indian market is actually to do with the currency. The Indian rupee continues to be weak. In fact, even intervention by the RBI has not managed to provide that support consistently for a longer term. How are you reading into this weakness in the Indian currency?
So, Slinda, the way we always tell global investors is, if you look at last 30 years in India, the currency generally depreciates by 3%. And that's a very long-term trend. So every year there is a range of depreciation between 2% to 5%. Some years it is 5, some years it is 2. A couple of years there is marginal consolidation or appreciation. This year, primarily, one of the reasons has been, I think, largely, the rise in interest rates globally, whereas Indian rates have remained fairly stable because our inflation and macro deficits are at its best ever shape. But on the other hand, the tariff uncertainty, India and US are yet to conclude on tariff talks, and as and when that gets concluded, you will see some consolidation on our currency. But we are not concerned with the fact that every year there is a 3% currency depreciation loss. But in spite of that, in local currency, Indian markets have delivered 14% long-term returns over 10, 20 or 30 years. If you take out 3% of currency depreciation, that still comes to 11% dollar depreciation, dollar returns on a 15% return on capital market. So I think this is an order. This is not a new bug. It is a feature of every emerging market which typically tends to have depreciation of its currency. As long as earnings growth makes up for it, investors are happy.
Would you agree that, there's a limit to what the RBI can do, especially when it's also, the currency's weakness is also a function of a resilient dollar?
Absolutely. So, see, if you remember 13 years back, 12 years back in 2013, India was part of so-called Fragile Five. And from that day till today, there has been huge improvement in our twin deficits, whether it is the current account deficit or the fiscal deficit. India's inflation has toned down from highs of 8-9% 10 years back down to 3 to 4%. So a lot of our, inner operating statistics as a country have stabilized significantly. Inflation has been under control, deficits under control. So in that sense, RBI may not have as much to worry as it was 10-15 years back. In fact, the rest of the world is struggling with very high inflation, very high leverage, very high debt, sovereign debt. India has been very prudent all through even the COVID period. The government did not expand its balance sheet and maintained macro stability. I think after 2013-14, a very primary objective for the government of India and Reserve Bank was to ensure macro stability, and I think they have executed that very well. There are always these bouts of 1 or 2% excess depreciation in any market, but I think it's part of the routine journey.
Kalpan, I want to talk about the asset management space. It's getting pretty competitive. You have new rivals, the likes of Geo, BlackRock. How are you assessing this new landscape of new competitors?
See, I think we have around 50 asset management companies in India, and any space which has fast growth, our industry has grown by around 25% in the last 6 years. Like I said, 53rd month in a row of inflows continuing month after month will obviously attract new players. There are global players who want to come into India. There are domestic boutiques who want to get into the asset management space. So definitely it becomes competitive. It keeps us on our toes. The person who has to celebrate the most is the consumer. In the last 7-8 years, SEBI has been one of the finest regulators to make our industry very transparent. I think we are the only industry where there is existence of something called as direct plans. There is existence of something called as categorization of funds. So we have all large cap funds which have a framework. All mid cap funds have a framework. So like-to-like comparison can be done by investors. And we have the most cost-efficient structure. There is a concept called telescopic pricing. As the size of our assets goes up, automatically the fees or the expenses that we charge comes down, which means the investor gets economics, the scale economy benefits. So this has led to great outcomes for our investors. And on top of it, the digital infrastructure in India has enabled consumers in the smallest of villages to invest by pressing 2 buttons and starting a mutual fund investment. So I think this infrastructure creation, the digital infrastructure creation, the payment infrastructure, and the fact that the market has rewarded investors will bring in more competition, will keep us on our toes,
right,
will make choices available for investors for their better outcomes.
You talk about the cost structure, the fee structure. Of course, we know SEBI is overhauling the fee structure. When it is formalized, I'm just wondering what you see the impact would be on your margins, on your business.
So I think what SEBI is doing, it's a white paper, and that's again another beauty about our regulator, that they come up with a white paper a few months in advance. They create a dialogue with all the market participants so that there is practical input which is taken. What I see is that they are doing 2 things here. One, they are still rationalizing the fee structure, may have a few basis points, maybe at best 3 to 7 basis point of impact on the margin, but too early to say at this point in time because it's still in a white paper stage and discussions are on. But more importantly, it's making it more transparent. A lot of statutory levies like taxation or GST cost, which was layered inside the fees, will get very clearly demarcated. The second thing SEBI is also doing is bringing down the cost of broking. So every time we buy and sell the stock on the exchange, we pay certain basis point to our brokers. That cost also is likely to come down. So overall, the entire impact is not on the asset managers alone. It is getting distributed between the ecosystem. So at best, 3 to 5 basis point is what my rough indicative calculation today is, but too early to say because we are still in very early stages of dialogue. And once it is out, I'll be able to give more clarity.
So even though it is a white paper stage still, you welcome the changes that will be implemented by SEBI when they happen? Is that a fair assumption to make?
Absolutely.
Kalpan, before we let you go, I'm just wondering, given the current market environment, how best to play India at this stage?
I think, this is what we've been advocating to all our investors in India and to even our global investors, that you're getting invest in equities, but then with a very long-term horizon of 5 years and above, whether you come from Asia or Europe or any part of the world, including in India. Alternatively, to our Indian investors, we recommend them to invest in hybrid funds, which is a mix of stocks and bonds. Bonds are earning around 7.5% yields, and in a very stable macro regime, there is a reasonable possibility of bonds to also, yields to go down, which can create room for high carry as well as some bit of mark-to-market. So good mix of 70-30 in stocks and bonds is a good way to invest. And there are pockets in India now, very large sectors like banks are at reasonable valuations. Tech stocks are down 25% this year. They are coming closer to 4% free cash flow yield. So, they are 15% of our market cap. So almost half the market is at fairly priced valuations. There is some part of the market which is frothy like anywhere else in the world. There is no market in the last 1 year which has not risen sharply. So I'm not worried about valuation risk because that's true everywhere in the world. The only way to solve for it is good quality businesses and longer time horizon.
Great perspective there, Kalpan. Thank you so much for your time today. Kalpan Parekh, MD and CEO of DSP Mutual Fund. Now, still to come, Adani Enterprises, the flagship of Gautam Adani's ports to power conglomerate, reports earnings today. We have a preview of what to watch. Keep it here with us. This is Bloomberg.
Connecting the dot between what's at stake and what is possible.
We have two essential crises, and for both it's now or never: democracy and climate, and they are absolutely interlinked. And we have to solve them together. We're losing the democratic infrastructure and norms to deal with the climate, and we're losing the climate stability that is essential for a democracy. We have to solve them together. We've never faced a threat like this to our democracy at a time when it's a perfect storm, at a time when we're being told by climate scientists, some of you may be in this room, that we have to cut our emissions, fossil fuel emissions, in half in 5 years now. You know, when I started to realize what was happening, it was 12 years, and we haven't done it.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? You're in tune with how events around the world affect each other. It becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
In case you missed it, on the opening trade. Rates are on hold. I think rates being on hold is appropriate for the current period. If they tighten more, then we have to loosen later. More than a year ago, I talked about that being a policy boogie.
Yep.
And I thought that's not a good thing for monetary policymakers to do. The hold is appropriate at this point.
Avoid dancing at all costs.
Dancing. Don't miss the opening trade live every weekday.
Welcome back. You're watching Insight. Shares of Adani's flagship unit, Adani Enterprises, are in focus ahead of its earnings report later Tuesday. Investors will be watching for its fundraising plans and the performance of Adani Airport Holdings. Earlier on the show, we spoke to GQG Partners' Brian Cashman about how he views the company's stock ahead of the earnings report.
Like gravity. So as long as the companies continue to put up, these robust earnings over the course of time, the market will appreciate the growth in the businesses over the course of time. I don't believe that you're going to see a multiple D rating from here. These are actually priced at pretty attractive levels here. Again, if you do any sort of sum of the parts on any of the businesses for Adani Enterprises, you actually see that there is tremendous amount of value that's unlocked.
For more on what to expect, let's bring in Bloomberg Conglomerates reporter PR Sanjay in Mumbai. Sanjay, tell us about what is expected. What kind of numbers?
Adani Enterprise, the flagship company, which incubates several businesses, including data centers, real estate, airport, green hydrogen, and several others, would be reporting its quarterly earnings today. And the most important number people are watching is it's not its net income, but it is looking at what is the kind of money they would be raising via rights issue, because now they're entering into a capital new fresh capital expenditure cycle because airport is ready. They are looking at demerging the airport business and to get an IPO by 2027. And at the same time, they are also increasing their business footprint in data centers, which we had witnessed, tying up with Bharti Airtel and Google, etc. And the most interesting leg here is another leg is green hydrogen, where we are expecting more action. So to fund all this, they have to have a new capex cycle. So the first and foremost thing, what we are expecting today's board meeting is like what is the kind of a rights issue which Adani Enterprises, the flagship and the incubating company of Adani Group, the port-to-power conglomerate, would be doing. That is the most interesting thing. And of course, analysts are also waiting for the net income, because always the coal trading can have a drag. So they're also waiting kind of a narration on what happened to the coal trading and how it is impacted, because we know that the other unit companies like Adani Power or Adani ports or various other businesses have done extremely well. So we are waiting for the street is waiting for the numbers, net income, and the rights issue, the fundraising initiative.
You talk about the fundraising. It is a reflection of how the momentum is now picking up. I mean, this is a company that wants to build a global empire, and this fundraising is testimony to that.
Of course, it's also a kind of a reflection of how the promoters are seeing the company. Since it's a rights issue, at least 70% of the fund will have to be poured in by the promoters. So they believe their own company. Of course, that will have a repercussion, that will have a positive reflections among the investors. And when investors also became that road assets and real estate assets and airports are doing extremely well, what now they would want more fund for airports and for the green hydrogen business. So this rights issue fundraising is very crucial, that can have a very positive impact on long term for Adani Enterprises, which will be now incubating for the new line of businesses as well.
Sanjay, thank you so much for that. Bloomberg Conglomerates reporter here. Sanjay, in Mumbai. Before we go, here's a look at our guests for tomorrow. We'll get exclusive market insights from Natixis CIB's APEC CEO, Bruno Sain. Plus, Vimea Growth Capital founder will be joining us to discuss why they're betting big on Indian companies like Zepto and Zedwork. And that is it for Insight. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.
Connecting the dot between what's at stake and what is possible.
Do you know what to tell people about what the tariffs are going to do on the United States economy and the investment environment, or is it not clear yet?
If you look at the impact of the tariffs, they were much more significant and broad than I think the market expected. Looks closer to 19% on balance versus 2 and change last year. So effectively, it's a 20% increase on 10% of household goods that are imported into this country.
And do you think it's going to lead to a recession?
Well, we think that it's going to impact both inflation and the economic growth scenario. So we were coming into yesterday expecting the real economy to grow at 2%. and inflation to be closer to 2.8%. If you just go through the math, it would suggest there's probably 1 to 2 points upward increase on inflation and a similar amount on economic growth. So it could put us in a position where we're teetering.
So the tariffs will likely depress the GDP growth rate and increase inflation. So what's the advantage of tariffs?
From our standpoint, we have a hard time seeing the benefits of tariffs. They do tend to be inflationary in the short term. As you're pointing out, the longer term impact on economies is probably the greater downside.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning. This is Horizons Middle East and Africa, our top stories this morning. Oil earnings. Aramco expected to report that higher output and a recovery in refining margins is offsetting softer crude prices, while BP investors are waiting for more updates on its divestment program. Election day in the United States. President Donald Trump endorses former New York Governor Andrew Cuomo for mayor and threatens to withhold federal funding in a last-ditch effort to prevent Democrat Zohar Mamdani from winning in today's poll. Plus, risk off. Asian stocks and futures extend losses as Palantir's earnings and uncertainty of the Fed's policy outlook weigh on sentiment. Well, it has just gone 9 a.m. across the Emirates. I'm Joanna Bersachi in Abu Dhabi, live from the ADIPEC conference, where executives, policymakers, and energy leaders from across the world are gathering to discuss indices trends and the global outlook. We did plenty of interviews yesterday. We're going to play some of them on the show today, and then also a lot more to come this afternoon as well, alongside a panel that I'm doing. But before we move on and talk about markets, I do want to bring you some of the big news in terms of earnings. We have just got Aramco earnings, so let me bring you some of the flashes here. Third quarter revenue has come in at 386.1 billion riyals. It is setting the adjusted net profits, I should say, is a big beat versus estimates of 104.92 billion riyals versus estimates of 96.91 billion riyals. Third quarter performance-linked dividend is at $200 million. Remember, this is the performance-linked dividend, and that has been trending lower. The base dividend stays at $21.1 billion. In terms of other commentary that we're getting, Aramco says increased production with minimal incremental cost, and surely that's part and parcel because of the role that artificial intelligence and technology is playing in allowing for that to happen, the increased production with the minimal increased cost. As for other commentary, they say that they're continuing to enhance upstream capabilities as well. In terms of some of the other numbers that we've got, again, I broke to you the third quarter adjusted net profit, that is 104.92 versus estimates of 96.91. Total revenue 418 versus estimates of 375. So what we got is a beat on the top line. The bottom line, the dividend remains as it was for the base dividend. Of course, the performance-linked dividend continues to trend lower. In terms of the free cash flow, third quarter free cash flow has come in at $23.6 billion, and then they have announced higher sales for their gas forecast. So again, gas is a very strong growing business for Aramco too. And here that they're saying that they are announcing higher sales forecasts, and they're targeting sales gas output capacity growth of about 80%. So a lot coming through from Aramco this morning, but a recap of that will come shortly. Ultimately, a beat on the top line and the bottom line. All right, let's switch over and talk about Well, no, let's move on. I have Mitchell sitting with me here, our experts from Bloomberg, so to discuss this. I was going to go through markets, but since you're sitting right next to me, Mitchell, let's talk about Aramco earnings. Seems to me that we had a break, a beat, both on the top and the bottom line here. Blowing through market estimates, but at the same time, the backdrop to all of this, as we've been discussing in the last week, the other earnings that have come through, is lower oil prices.
Yeah, it's largely an upstream story for Aramco and the other of the world's biggest oil companies. Last week we saw Exxon, Chevron, and Total Energies all report higher production in the quarter. And as you say, it comes as oil prices are trending lower. We have OPEC over the weekend saying that they're going to pause the output revival this winter, which could potentially impact prices to the upside a little bit. But, these companies are all clearly focused on pumping more oil.
Yeah, no, absolutely. And just, waiting to hear a little bit more commentary also around their refining business, because I think that also downstream business was one of the positives for Aramco over the last quarter. So waiting for some commentary there. While you're with me, I also want to talk about BP, because they're going to be reporting earnings later today. This is a company that has been under a lot of pressure from shareholders. They've had to change their strategy. I was on a panel with Murray Auchincloss, the CEO, yesterday, talking about how they were under pressure to change their strategy and go back to their bread and butter, which is investments in hydrocarbons, in oil. Is it paying off?
Yeah, BP is looking to reverse years of underperformance. They lagged all of their rivals in recent years, and they see investing in the upstream oil and gas business as a way to narrow the gap. So far, the last quarter seemed to be a hint of a turnaround, analysts said.
was the stock market that wasn't okay with it.
Yeah, yesterday we did see that $30 billion bond sale coming out from Meta, and we did see the bond market respond with spreads widening 2 basis points in the investment grade market. I am curious, though, how different it would be if we were getting some of the real-time indicators. Today we should be getting personal income, personal spending, and core PCE, a key metric that the Fed should be looking at to understand whether or not it should cut rates again, which, of course, we don't really understand the reaction function because it's not clear there is one right now. But I am curious how much a lot of the tech spending is filling a vacuum that otherwise could be offset by some of this other data that would be coming out of Washington.
Well, so much has been made that the tech spending is contributing to economic growth, but maybe people are looking to Chair Powell, who in his press conference seemed confident that even if they don't have data coming before December, that they can use alternative data and the beige book. To him, that was enough to prove or disprove that they need to cut or not cut.
He seemed like the father in a car, in a fog, on the street, and the kid in the backseat saying, could you just press the gas a little bit because you know where you're going? And he's like, no, it's foggy. Cut it out. Right now, we're looking at markets that seem to be really building on gains. As Danny said, a third weekly gain that we're poised to see, led by the tech sector. S&P futures up 0.6%. You are seeing just a little bit more dollar weakness. And that 10-year yield, really watch this space, especially after Fed Chair Jay Powell pushed off the potential for a guaranteed December rate cut at that 4.10 level. Coming up this hour, Peter Shear of Academy Securities as the equity rally looks to get back on track. Dan Ives of Wedbush Securities on the big week for big tech, and Dan Stuyven of Goldman Sachs breaking down earnings from the oil giants. We get Chevron and Exxon later this hour. We begin this hour with stocks rising after a slate of upbeat earnings from big tech. Peter Shear of Academy Securities writing this: the lack of breadth has been a concern again recently, but big tech has provided earnings that warranted that. Peter joins us now. And Peter, are you going to provide us with one of these puns? Bad breath, et cetera. I mean, how many of those do we have every day?
No, I'm sticking to one major theme, which is production for security, or PROSEC. And that's kind of our main investment philosophy right now, is look for things that the government's going to get involved with and really rethinking this kind of production for security. I think it's the new ESG. This is going to be a multi-year trend where countries, corporations, governments, asset managers all think about what we need to be truly sustainable.
So this is the reason why, and some investors have welcomed a lot of the capex spend that we've seen from the big tech players, from some of the other energy intensive industrial companies. At what point is there enough money already sloshing around the system to finance this without being diverted away from other efforts?
Right now, I think there's a ton of money. I think you've got private credit looking to put money into this. Banks are all very flush. The banks are doing very well. So I think the banks are looking to lend to this. And I really think the growth story is going to be, how do we keep our energy production or electron production or electricity production, however you want to phrase it, to keep up with this demand. So I think there's just going to be an immense amount of growth as we look at rare earths and critical minerals, not just the rare earths and critical minerals, but the process and refine. These are going to be important parts of it. Then I think it's ultimately, can we build enough electricity production to keep up with what we're going to do? And that's going to be the growth story. It's going to be a big commodity push, right? We're going to have to build all these things out in conjunction if we want to win the AI race.
But when you have both a huge amount of capital supply and demand for that capital, typically, that's kind of the environment where things get papered over because there's so much money being put to work and the need for it. Are you concerned that there are places in the margin where we go too far?
I think it's at the margin, though, right now, right? There's probably going to be, I think, I would be cautious if I'm investing in someone who doesn't get good deal flow. I think the people who have good deal flow have plenty of opportunities. I think, you're just seeing this investment. It's real. But again, that's why I'm kind of really much more focused on, okay, what are going to be the underlying building blocks of this? There I have less concerns about whether there's a bubble or not in valuations, right? That Dan Ives can speak to later. I think he's still probably fairly bullish. You can understand why. But for me, I'm looking, okay, what is the core that we need to really make this, to really compete? We're way behind China in terms of electricity production. Clearly, the rare earths and critical minerals, the refined versions of those, was a huge sticking point during all these trade negotiations. I think we're just going to explode on that front, and that's where my efforts are. You look at the things we're doing in nuclear. I think nuclear is going to be a big part of this, and I do think eventually the president's going to give up on solar, and you're going to see solar become part of the equation and really get growth there. And everything we're doing, I think the rest of the world should be copying.
Can we catch up? I mean, it's an immense push and a lot of money being put behind it. But we're starting, to your point, from such a place of being behind.
I don't know whether we can catch up. I know if we don't start or do anything about it, we won't catch up. So at least now you're seeing the building blocks put in place. The Department of Energy has 70 nuclear projects listed. Only one supposedly has all the regulatory approval. You did see the U.S. government take steps to allow small nuclear reactors on military bases, right? The government has a lot more control over federal land. So I think we're just starting to see this whole process. And when I think about kind of this replacement of ESG and this production for security, I'm thinking everyone's going back and saying, if I want to be truly sustainable, what do I need to make myself? I need to make some things myself to be truly sustainable. Then I can work with my close allies and neighbors and friends to get some other it. And then sure, I can buy some percentage of that on the open market from whoever. But I think we're looking at it this way. I think the government's looking at it this way. I think corporations are going to look at their supply chain. So I think we kind of got away from what it is to be truly sustainable. To be sustainable, you actually have to be in control of certain things. And I think that's also going to apply. We're looking much more at South America. The opportunity is there. So I think the Monroe Doctrine, always been talked about, not much has been done. I think we're seeing that. So that's where I'm kind of looking at the investment landscape away from the AI, the data centers. Who's going to benefit? It's going to be South America, and it's going to be this production for security.
So I just want to point out that ProSec is something that you've trademarked, and you hope that we all use at some point in terms of
you got to try something,
a trading theme, and that is a longer-term theme that you have been talking about before all the rest of us were. So kudos to you. If you just take a look at this week, and this really goes to what spending is the right kind of spending that should be rewarded, and what is the spending that shouldn't. This week we saw massive capex from the likes of Microsoft and Amazon and Meta and Google, and there's this question about whether this is sustainable and whether it is going to the right types of areas that either go with your ProSec theme or that just in general go with the AI and exactly what form it will manifest in. From your perspective, is this the right kind of spending?
Again, it's very hard, right? One company yesterday, Meta, clearly went down 10% on the stock on spending, and today now you have Amazon going up 10%. So clearly everyone's trying to figure out where we are in that cycle. And that to me is where it gets a little bit dangerous, right? Maybe we go up another 30, 40% from here. Maybe we drop 10, 20%, just as people try and figure that out. That's why I'm kind of trying to deviate away from that and away from the big high flyers, away from the momentum, into these other areas where there's less pressure. Again, look at energy. I think energy is going to be a huge part of this. Most hedge funds, my understanding is, are underweight energy. You don't see a lot of bullishness there. That to me is like, okay, I would rather be there. Maybe I don't have the same upside as some of the big AI providers. On the other hand, I don't think I have the downside. And I think we benefit from whichever one of those scenarios wins. We benefit if we're in that space.
It also has the benefit of removing from the backdrop of the murky mess that is the U.S. economy, of trying to understand the K-shape and exactly what's happening with some of this investment and what it means or what it doesn't mean for employment. So I just wonder from your perspective what you expect in terms of how much your call is dependent on an economy that does keep chugging along, on a Fed that does keep cutting rates, on a backdrop that is as benign as so many people seem to think it is.
So, we've been talking a little bit about the little I-shaped economy where there's a little dot that's doing phenomenal well. The stick, I don't know how bad it's doing. I know there's a lot of talk about the K-shaped economy. I do think there's some weakness. I'm not comfortable with the job situation. I think the job market's still been overstated. Having said that, I really do like this push towards this production domestically, working with some of our allies. We're starting to take tariffs off of things like avocados, bananas, things that we just don't have here anyway. So I think you're seeing some rationality flow into all of this that lets us grow. And I think the one thing that's underestimated in the big, beautiful bill is the accelerated depreciation, right? If you get lower rates and you start seeing this move. And again, I think the best thing about capitalism is money flows to where there's opportunity. And I think some of the things I've been describing, whether it's in the chip sector, whether it's the data center AI sector, whether it's space, money is going to start going there. You're seeing things rewarded. Like miners have been left in the dust or the dirt for ages. All of a sudden, they're becoming exciting. Yeah, sorry about the pun, but it's. But I do think that's where capital is going, and you're going to see ETFs built on this sort of concept. Money will flow there, and that will allow the growth to occur, and that's where you're going to see the real development.
The growth, though, again, is occurring in such a specific place that you're talking about. This gets back to Lisa's original question. Are we witnessing something that looks incredibly regressive?
No, I'm going to push back a little bit on that. I think the growth is occurring on things where we realize we ceded these things to China, who is not our friend, not our ally, is a long way away from us. And we have to go back. What do we need to make either domestically or nearshored to make sure that we're safe, that we can sustain ourselves for periods of times if we have a friction with China?
Does that help the I part of the stick part of the I?
I think it does. I think it does really help the stick part, because then we're going to be building these things out. And let's say a nuclear plant, right? Okay, it's going to take 7 to 10 years probably to be online for a big one. Maybe a small one can get on in 5 years. There is going to be a ton of construction around that, right? So the amount of construction jobs, right? And if we're going to do this construction, we're going to need steel, we're going to need aluminum, we're going to need concrete. So I think the job job creation in and around that build out is the part. So it's going to be years before we have a full electricity grid that we need, but just trying to get there. And again, don't forget, the U.S. government already took a stake. I don't know exactly what it looks like in U.S. Steel. You know, the government is going to be involved in kind of what we're looking at as kind of national champions. I think they're figuring out who they can work with to progress this. You're seeing the regulatory environment change. So that's where the jobs, that's where I think the stick does better. And so I think the stick has kind of been left behind. Maybe we're still going to be left behind the data center. But if that stick can...
The
dot is doing phenomenal.
Okay.
But I think the stick is moving in the right direction.
Peter Scheer of Academy Securities, who trademarked ProSec. Thank you. Always wonderful to start the day with you. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Amazon shares are rising nearly 13% in the pre-market after earnings. The tech giant reported $33 billion in revenue from its AWS unit, a 20% jump from the year prior and its biggest year-over-year increase since 2022. CEO Andy Jassy praising the impact AI's had on Amazon's business, saying, "We have momentum." Meanwhile, Apple shares also getting a lift, up 1.8% in the pre-market. The company shared it anticipates a blockbuster holiday season led by demand for its newest iPhones. Apple also reported a surprise decline in China sales due to supply constraints, but says it expects to return to growth in the market. CEO Tim Cook saying store traffic is up significantly in China. And Vice President J.D. Vance is warning a prolonged U.S. government shutdown will impact travel during the holiday season, telling reporters it could be a disaster if the shutdown extends into the Thanksgiving travel season. The comments come after Vance held a roundtable with the CEOs of United and American Airlines. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira. Up next, de-risking from China.
We do not want to decouple from China. We need to de-risk. My guess is a year from now, we'll be back at the table and we'll get another delay, another roll.
So what is decoupling and what is de-risking? Ed Mills of Raymond James will explain all. This is Bloomberg Surveillance.
As I reach a milestone in my life, I'm humbled by my good fortune, yet well aware that I still have much to learn. And if I stay true to myself and follow my instincts, my legacy will be looked on kindly by my friends, my family, and hopefully generations to come.
Connecting the dot between what's at stake and what is possible.
Setting up for a third straight week of gains, as you do see some sort of legitimacy put into some of the concerns about the AI bubble. When you take a look at why, you can see what kind of CapEx plans these companies have. We didn't put Apple in here because they don't have the same type of AI-related CapEx. But Danny, when you take a look at the numbers on the screen, when you take a look at a 75% increase year over year in Q3 CapEx for Microsoft at $35 billion, $34 billion for Amazon, $19.4 billion for Meta, and $24 billion for Google. Just the scope of money going into this is absolutely shocking. They've basically doubled CapEx in 1.5 years, and it underscores just how much these tech giants have changed. This was a sector that was usually loved for its free cash flow and limited exposure exposure to things that depreciate. That's completely been flipped on its head, and they're tapping the debt markets too. So they're becoming increasingly indebted. It's a completely different model for evaluating these companies.
Particularly for Meta, and when you take a look at the expense plans for next year, it continues to increase at a similar pace. Meanwhile, ongoing spending is expected more broadly as the United States tries to move away from its dependency on China, on the rest of the world for some critical minerals. Under surveillance this morning, de-risking from China.
We do not want to decouple from China. We need to de-risk. My guess is a year from now we'll be back at the table, and we'll get another delay, another roll, because what everyone misses is the Chinese have rare earths, but we have President Trump's threat on tariffs. He gave the team maximum negotiating leverage.
Here's the latest. U.S. and China tensions are de-escalating after striking a year-long truce on tariffs and rare earth export curbs. The two countries continuing a push to reduce dependence on each other. Bloomberg's Tyler Kendall joins us now from Seoul. Tyler, a really tricky dance here. Yes, a sort of a truce of some sort in the near term, but really accelerating the push on the back end for each country to move away from one another.
Yeah, hey, Lisa, good morning. You're exactly right. While the trade truce is intact for now, it really doesn't address those more fundamental issues that contributed to the standoff between the U.S. and China in the first place, including national security, the persistent trade imbalances, but of course also what you're alluding to here, which is this jockeying for dominance when it comes to the tech sector. Now, we did hear from Chinese President Xi Jinping today for the first time since his meeting with President Trump, and he struck this positive tone when he addressed the APEC Leader Summit here in South Korea. He called on countries not to threaten global supply chains, saying that instead they should be working together. But of course, it is worth noting that China's now delayed export curbs on critical and rare earth minerals had the potential to disrupt supply chains, not just in the U.S., but globally as well. Plus, these curbs, Lisa, are technically still in place. They are still rather in the pipeline. They still could be coming down the road a year later. Plus, there are old curbs that are still in place, have been at this point for years, and many businesses note that the Chinese export licensing system is really opaque. So that's led our analysts at Bloomberg Economics to say that even after these talks, China really does maintain its grip on the global critical minerals supply chain. But of course, that led the White House during this trip to try to strike those cooperation pacts with countries like Japan, like South Korea, in these essential sectors like rare earths and like shipbuilding. But Lisa, I did want to point out that while President Trump is in Washington, here in South Korea today, the Chinese leader did hold some pretty high-profile meetings, including with Japan's prime minister, but also with the Canadian Prime Minister Mark Carney, too, saying that they're going to start re-talking about trade all in a bid as both countries try to bolster their leverage, even as we have just gotten this most recent trade truce.
Bloomberg's Tyler Kendall, great work. Thank you so much. Also some discussion with respect to NVIDIA speaking in South Korea about potentially restarting Blackwell sales into China. At least that is Jensen Huang's goal going forward. Joining us now is Ed Mills of Raymond James. Ed, I just wonder your takeaway about how the geopolitical chips are falling after this Xi Jinping-Donald Trump meeting.
I think they're basically where we would expect them to be, which is getting a de-escalation, getting delay. But the real question now is kind of how long does this last? And I don't think there's anyone who thinks that we're going to go through the next year or through the term of President Trump without kind of some more hiccups. This is a roller coaster ride. I am sure there's going to be more export controls that are going to be kind of suggested by either side. But really, the big question that we've been getting here at Raymond James is how much semiconductors can go into China, how much relaxation of some of those tech controls. We've talked about that de-risking. In the last 8 years, that's been about blocking what China can buy. De-risking now in D.C. is making sure that China gets hooked on our AI technology so that we don't have the risk that China develops something else and is a competitor globally. That's a fundamental change that is going to potentially drive a lot of this AI trade even a bit higher as we get those kind of de-risking sales into China that were not expected.
To Lisa's point, Ed, the president had said that Blackwell would be discussed. Jensen Huang said he hoped he'd be able to sell Blackwell back into China, but it appears that wasn't on the table during these negotiations. What do you make of the fact that that specifically was left out?
So, Danny, the president said that NVIDIA and China are going to have conversations and that he was going to let NVIDIA be the referee. He did say that Blackwell, in NVIDIA's latest chip, the Rubin, is probably off the table. And I think that's appropriate. What we do know is that the Trump administration had previously banned the H20. They banned one of the AMD chips. They've reversed those bans. China hasn't purchased that because they want to see what else they can get. I do think that there is a version of Blackwell that probably can be sold into China. I do think that that is going to be part of future negotiations. So on a scale of 1 to 10, if I had been hoping for a 10, what came out of this is probably a 6 or a 7. And if we can get those negotiations ongoing, it can go up from here. But the opportunity to possibly relax tech standards versus where we've been is a fundamental shift in and of itself, which gives optimism for a lot of investors that I talk to.
So notably, not a 12, as the president said that the outcome of the meeting was, Ed. What else wasn't discussed? Also, TikTok, Taiwan, transshipments. What do you make of just what was left out of the discussions?
It is a 2-hour meeting, but that's not very long when you kind of have all these different negotiations. I think as it relates to TikTok, that has been moving along. That has had a lot of other negotiations. One thing that I've always heard about Vice President Xi is that he likes to go into these meetings with things 98, 99% settled. So I think what was discussed in the meeting was what Besson and his counterpart were able to do the week before. There is a desire to have another meeting first half of next year where Trump goes to China. Maybe Xi comes to the United States at an appropriate time. So there is opportunities to follow up from this. On rare earths, yes, they are going to have this pause. But because there's licensing, there's plenty of opportunities for China to tighten in certain ways that will get U.S. response. So the fact that we have more to discuss at later dates and other dates already set to kind of have the leaders come together seems fairly appropriate at this point.
Ed, just really quickly here, do you think that we're going to get a completion to this government shutdown by Thanksgiving so we cannot worry about flight delays?
I think Thanksgiving, yes, but I think that that's where I kind of have been putting the over-under. Once we get to November 21st, which is the date of the CR that passed the House, the conversation changes because it's not that the Senate could just vote to turn it on because there's nothing to vote on. I do think that there's going to be a conversation today and over the next week about nuking the filibuster. That's what President Trump has put on Truth Social. I don't think the Senate goes in that direction. I think that's about Trump trying to regain negotiating leverage. But because of those social media posts, this does go on at least another week. As the pressure builds, President Trump is probably going to have to be the off-ramp. But as we get closer to kind of November, kind of 21st, and as we get closer to Thanksgiving, that's really, I think, where this finally comes to a head. I think we're at the beginning of the end. But unfortunately, we're still at the beginning, not the end.
Not the end of the end. Ed Mills of Raymond James, thank you so much for being with us and have a wonderful weekend and a wonderful Halloween. Right now, we are getting data from some of the biggest companies, the big oil company, Chevron Corporation, reporting earnings, beating earnings estimates as profits from the Hess Corporation acquisition seem to pay off. You are seeing the adjusted third quarter earnings of $185 a share, exceeding the 166 average. They also are talking about share buybacks, and it really flies in the face of oil prices, Danny, which have gone down. You are still seeing profits coming out of some of the oil majors.
Yeah, Brent crude on pace for its worst year since 2020, since COVID really depressed demand for oil. It's notable, to your point, that the Hess acquisition is what got them through. Speaks to the consolidation that's happening in this industry and why it's happening.
And why we expect more to come, especially with the deregulatory push that can allow more big oil tie-ups. Coming up, we're going to be talking about big tech with Dan Ives of Wedbush, who probably will be bullish, as Pete Shear noted, on big tech after the earnings we got this week. Plus, Yahira Anand with your morning movers, Reddit soaring on strong advertising projections. This is Bloomberg.
Advertising as we know it is dead. Consumers don't want brands to come and keep on bombarding them with advertisements. We need to keep experiences frictionless and seamless. We keep saying, oh, attention is the new currency. No, it's trust which is the new currency. So we need to reinvent marketing with a new set of laws and theories. How consumers will actually make their choice is based on trust and the purpose of your company. Yes, we are here to make profits, but we're also here to make a difference. And this difference is not for political correctness, a sincere, genuine purpose. You have to connect the dots between your purpose, your passion, and your profitability and make it an integral part of your business model. And when you do that, there is a profound sense of fulfillment.
Good morning. Welcome back. 3 hours until the opening bell. What we can see right now is a market that wants to grind higher toward new record highs, building on a third weekly gain. And you can see that really being driven by the tech space after the earnings of the likes of Amazon and Apple yesterday. Tech up, NASDAQ up 1.1%, S&P futures up 0.6%. The Russell taking it a little bit, but yesterday was an outperformer. What you are seeing is that Amazon absolutely crushing it in pre-market trading, up almost 13% after their beat, showing that cloud revenue came in at the strongest going back to 2022. Apple shares getting a boost because people are upgrading their phones finally to the iPhone 17, and it really does have to come down to the hardware. And this has been bolstering sentiment. Just a reminder, though, Amazon shares are only up 1.6% before this move. So definitely the underperformer of the year so far from the big tech space. Meanwhile, in the bond space, a real question about what a Fed that isn't going to cut rates in December means for credit markets, for fixed income markets more broadly. 10-year yields are the ones that I'm watching at that 410 mark after selling off, seeing a 10 basis point rise on Wednesday following the press conference. 2-year yields getting a bid, 3.6%, 3 hours away from the cash open. Here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with Amazon. As you said, the stock is soaring nearly 13% after a strong performance. It's a big win for a stock that's lagged its tech peers this year. The company's profit engine, AWS, saw revenue jump 20% year over year. As you said, its strongest growth since 2022 and well ahead of forecasts. I will also note Amazon said that CapEx last quarter hit a record more than $34 billion. And moving on to Apple, also another strong performance there. Shares are up 1.75% after the company predicted a strong holiday period thanks to its newest iPhones. The tech giant says revenue will jump as much as 12%, while iPhone sales will jump in the double digits. That would make it Apple's strongest iPhone quarter ever. And we end on Reddit, also soaring nearly 11% now in the pre-market after posting some pretty impressive numbers in the third quarter and saying that momentum will continue into the end of the year thanks to its advertising unit. Thanks to its advertising, daily active users jumping nearly 20%, while revenue grew 70% year on year. It also gave a better outlook than analysts expected. Lisa?
Thank you so much, Yahira. We are getting earnings ongoing this morning. We did get Chevron earlier. Now, we just got the numbers from Exxon, the reaction in shares. A little bit worse than what we saw from Chevron. Those shares down 2%, even though, Danny, they seem to beat pretty much across the board for earnings as well as for revenues coming in far above expectations.
And kind of not the same flavor as Chevron, but a similar one in terms of what is driving it. It's just new projects and what they called growth acquisitions. The cost of capital is very low for them. So at Exxon, they're betting that they can take on more debt. They're already coming from low levels, take on that debt, have new projects, and that be the thing to lift them up despite the fact crude oil prices have been tumbling all year this year.
Yeah, talking about how their cash capex is coming in slightly below the lower end of the $27 to $29 billion. Interestingly, they did talk about having some sort of $18 billion in cumulative cost savings. Whenever I see cost savings, I wonder, is this just sort of a sanitized way of saying job cuts? Is this part of the economies of scale of some of these acquisitions?
At least they didn't blame AI. At least they weren't like, oh, we're doing AI things, so we're shaving jobs.
But maybe they will be anyway, in terms of exactly what's behind it. We'll dig into that as we get more details and as the call comes through. On our radar this morning, a turnaround for tech following Thursday's losses. Amazon shares surging on its fastest cloud unit growth in nearly 3 years, while Apple gained on a revenue beat and an upbeat holiday forecast. Meanwhile, NVIDIA CEO Jensen Huang remaining hopeful about selling his company's new Blackwell AI chips in China, adding sales were not discussed during his meeting with Chinese trade officials. I love, by the way, Danny, that they talk about how he's going to be the sort of referee on these talks. It's sort of like, the fox in the hen house, no?
Right. Is that comforting or discomforting? I mean, it's a China that's explicitly said we want to use our own homegrown chips. So you're, pun intended, putting literally all the chips in Xi Jinping's basket.
All right, Punny
You're
Friday. I
welcome
love
for
it.
that.
Absolutely loving it. And there is this question about whether it's a national security thing in order to get U.S. tech into China so that there isn't this huge divergence. Meanwhile, Netflix reportedly exploring a major bid for Warner Brothers Discovery Studio and streaming businesses. This, according to Reuters. Netflix has hired advisors to evaluate any potential deal. Netflix also announcing a 10-for-1 stock split to benefit employees and, of course, to make their stocks more accessible to the individual investor. But the tie-ups right now in the media space, it seems like there is a rush to get big enough to survive whatever kinds of tech advancements there are in the years to come.
I want to know if this Netflix bid, if it's something that Warner Brothers Discovery would actually entertain too, because one, I guess it would involve splitting up the company because they just want streaming in their studios, or if this was all just a ploy to get Skydance Paramount to up their bid, which has been said many times. But maybe if Netflix offers enough, all of a sudden it becomes attractive.
Yeah, this to me is really the question. What is the price? What is the clearing level for a lot of these companies? Turning back to Apple, shares rising in the pre-market after giving a strong outlook despite reporting a surprise decline in China revenue. Dan Ives of Wedbush maintaining, guess what, an outperform rating on Apple and raising his price target to $320. Dan joins us now, his colorful self. You never sleep. Love seeing you. So what is it that was so good, given the fact that this really is a hardware story, not necessarily a technology story, which is what's going on with the rest of the tech world?
Sure. I mean, look, if you look services, that continues to be rock of Gibraltar for them, and that mid-teen growth. I think that's something from a multiple perspective that investors are really focused on. But look, the reality is we've talked about it so many times in the show over the years, like other cycles have been disappointing from iPhone. If you look 15, 16, iPhone 17, it almost looks like a surprise upgrade cycle. Especially in China. China was the headwind, now looking like a tailwind. And then also it comes back to Cook. I mean, 10% politician, 90% CEO, playing nice in the sandbox in DC. That's going to have an impact as well. And this is all the drum roll to AI. I mean, that is what you're playing for here when it comes to Apple over the next year.
Is it? I mean, I guess that's really the key question. Is this still the promise of AI? Or is this really a question of we all have phones that are broken and cracked and we've been waiting for a long time and we're going to now upgrade to the i17. They are capacity constrained at this point, which was the biggest hamper for them. And it's a completely different story than the AI spend that we're seeing in the other companies and a very different kind of trajectory than maybe what we're seeing in the other space.
Yeah, and that's been the frustration, right? Because, I mean, if you look at Apple, this AI party where it was 9 p.m., it's now 10:30 p.m., that party goes to 4 a.m. Apple, they've been out on the outside looking through the windows, right? So now the focus is consumer AI revolution. It's going to go through Cupertino. Now, how does that happen? Comes down to that Google DOJ win. That's huge. And now, candlelight dinner, Sundar, Cook, I believe it's a matter of time. They're going to announce a massive AI partnership on Gemini. That's what you're playing for, because you're 25% of what you're playing for is the stock's cheap relative to what I think could happen on an iPhone 17 services. But what you're really playing for here is they get to the AI party. They announce that deal over the next year. This is a $350, $400 stock as AI finally comes to Cupertino.
Doesn't that, though, completely not illegitimize, but basically challenge this idea that you have to spend in the AI race to keep ahead? If you have a company like Apple that basically figures we can partner with people, we don't need to spend, and we can still benefit, does that just show you don't need to participate in the arms race for every other company that is?
Yeah, look, I think for them, it's unique because there's 2.4 billion iOS devices, 1.5 billion iPhones. So they've built the mountain, right? The field of dreams. I mean, they've built it, they will come. So now it comes down to from a consumer perspective, you have to monetize that on the consumer perspective. I think AI revolution comes through Apple on the consumer side. When you look what's happening on the enterprise, look, it's a fourth industrial revolution. The reality is that from this tech earnings, going into eating chocolate tonight and Sour Patch Kids and whatever else on Halloween, you go in as a bull more bullish relative to everything we've seen from hyperscaler, Amazon, Microsoft, even Meta, stock down, but why is it down? They're spending more and more, and it speaks to our view. This is only second inning of the 9-inning game.
It really changes, though, how you analyze these tech companies. If they are taking on AI servers and other relatively short-lived assets, it means that depreciation charges start racking up. How does that change how you think about these companies and the otherwise cost discipline that they need to exercise?
Yeah, and look, and I think that's the debate, right? Because if you look at these companies over a year, then you wouldn't have bought even the last few years. But the reality is it's an AI arms race. You're essentially building out the new economy on the consumer, on the enterprise front. And that's why you have to be able to look out 2-3 years to what this is going to look like. Microsoft, a good example. I mean, you essentially have almost built a Microsoft within a Microsoft. You look what's happening at Google, right? New York City cab drivers bearish on Google and Alphabet. If you look back over the last 6 months, now when DOJ, search, death greatly exaggerated, that's actually a positive relative to AI. You look at Amazon, finally Jassy's saying like, hey, don't forget about us. And that was a huge pop the champagne moment for them last night.
We saw a huge bulk of the Magnificent Seven report earnings this week, and I want to just take a look and take stock of what we've learned. And our team put together a fantastic series of charts really looking at the CapEx expense and just what this is compared to revenue. What you can see is that revenues are expected to increase the likes of 5% in Amazon, expected CapEx rise 51%. Google, expected revenue rise 6%, CapEx rise 43%. A similar story for Microsoft. At what point does that become a concern? That they have to fund an increasing amount of this with debt, that it's increasingly going to depend on leverage and the benevolence of private creditors and all sorts of other investors who are going to finance this.
Yeah, and to that point, that's, I think, also outside Mag 7 in terms of companies that are basically going to have to raise debt. They're going to compete from a CapEx perspective. When it comes to big tech, I mean, $1 trillion in the balance sheet, generate $300 to $400 billion a year. So that's why the reality is they are fueling this AI revolution. But if you look at CapEx, look, a year ago, CapEx going into this year is $220, $230 billion. That was a thought. It's actually going to be $380 billion. So I think investors continue to underestimate the scale and scope, and that's the fuel in the engine. That's what's fueling all of this in terms of the CapEx cycle, and that's why in his leather jacket, the godfather of AI, Jensen, continues to be the chip that really fueling the AI revolution. But AMD, TSMC, Broadcom, it speaks to our view. I mean, I've seen it even like authentication with, what we're doing on Orb side, where you're seeing like authentication, cybersecurity, CrowdStrike, Palo Alto. This is where it's all going, second, third, fourth derivatives.
Yeah, we get Palantir on Monday, and then we get the rest, so we can see exactly how that's playing out. Just taking stock, though, of what we've heard. And people think of Dan Ives, they think of Tech Bull. And you've been right. You've been 100% right with a lot of this. I'm just wondering, what are you seeing that does seem excessive, that does make you think, hold on a second, there is something here that makes me just a little bit nervous that there's some good money going after bad in small pockets that are getting a little bit bigger?
Well, to that point, I mean, like I just got back from basically being gone a month around the world trying to understand, like, especially in Asia, what demand and supply looks like. So for the real ones, demand and supply is 10 to 1, okay? But just because you say AI 30 times in a conference call doesn't make you an AI play. So when you say what worries me, that's what, but Lisa, that's like I focus on, like, we have our ETF, like who are the winners, who are the fakes. So it just speaks to my view, like that, when you say what worries me, it's just separating out. You need to own the winners. You can't just own an AI play because they have great PowerPoints.
Is Caterpillar an AI play?
There's a better chance of me playing in tonight's like Blue Jays like Dodgers game than Caterpillar be an AI play. That's my opinion, but it speaks to the view, like you have to be careful about who's AI, who's real, what are the derivatives. And I think as an investor, that's how you separate, like look at the spending, who the winners are, second, third, fourth derivatives, obviously messy of AI, Palantir being one of them.
Dan Ives, always wonderful to speak with you. Thank you so much. And I hope that we someday learn how to have no sleep like you do, Dan Ives of Wedbush Securities. I want to go as AI to Halloween as AI. What would that look like? I'm just trying to think about that.
So I actually had a friend pitch me this. For you and your husband, one of you dresses really artificially and then the other person looks very intelligent. Dan seems to have an idea.
But
How do you
I
do
would just say, like, but Lisa's the one, she's the house, she's the one where you actually give out full chocolate bars.
Totally.
And the problem is, like, but you're just one of those. And because it's your world, we all pay rent.
Oh, yeah.
But I just want to be.
Lisa's the CapEx giant of Halloween, investing in good-sized
She's the CapEx from a chocolate perspective. And then the neighbor, you have the small chocolate, you feel bad. That's the problem.
All right, so I'm making everybody feel bad. Right now, let's move on. Let's get you an update on stories else for this morning. Here's your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. U.S. oil majors Chevron and Exxon are reporting this morning. Exxon posted an earnings beat. The company is pressing ahead with a raft of expansion projects despite slumping oil prices. Meanwhile, Chevron beat earnings estimates as profits from the Hess acquisition were included in the results for the first time and provided a boost. Chevron's global production rose 21% to the equivalent of 4.1 million barrels a day. Meanwhile, American soybeans are great again. China has purchased at least 4 U.S. soybean cargoes following the summit between President Donald Trump and Chinese leader Xi Jinping. Sources telling us here at Bloomberg the cargoes are for shipments later this year and in early 2026, and the total volume is about 250,000 tons. And California Public Employees Retirement System is planning to vote against Elon Musk's $1 trillion Tesla pay package. CalPERS, which owns about 5 million Tesla shares, says the pay package is far larger than those for CEOs in comparable companies and further concentrates power in a single shareholder. The $1 trillion agreement spans 10 years and requires Musk to meet certain benchmarks. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Up next, Dan Stuyvesant of Goldman Sachs as oil giants report earnings and eyes turn to rare earth minerals. This is Bloomberg Surveillance. Well, the earnings have delivered, and they've delivered big time. And to the extent that this was going to be a risk week with Magnificent Seven stocks reporting, it has not been. And what you are seeing is a lift to markets. Equity futures indicated higher, led by those tech shares, up 0.6% on the S&P futures. You are seeing yields just marginally higher at that 410 level on the 10-year. Crude continuing to fall. A real question here with the oversupply. Under surveillance this morning, earnings from the oil giants crossing this hour. Exxon shares are lower with the plans for major expansion projects. Chevron rising after posting strong results. Joining us now, Goldman Sachs' head of oil research, Dan Stuyvesant. Dan, thank you so much for being here. What a year on all the commodity fronts. I'm just wondering with the oil giants, what this tells you about the path of production in the months and years to come.
Yeah, so I think those earnings help us to check in on the key assumption that global supply will continue to grow. We estimate that actually in the fourth quarter of this year, on a year-over-year basis, global oil production will be up 4%. That's 4 times more than in a normal year. And that, in combination with the global stocks data that are rising, supports our view that you sort of have another $10 per barrel of downside for oil prices over the next year, with Brent next year averaging $56 per barrel.
Does it look like a race to the bottom, though? You have Exxon talking about the fact that they have low levels of debt, so they can take on more debt and finance more projects. Is that what the path looks like?
So I think 25 and 26 are pretty exceptional in how much extra supply we expect to come to the markets, coming both from core OPEC producers like Saudi Arabia, the UAE, and others, and then also from production in the Americas, especially from Latin America, actually, Brazil and Guyana. If you look out further down the horizon, we see a sharp slowdown in supply growth from 27 onwards. So we really think of this as the last jump in global supply. And that's why I think prices will probably come down somewhat more next year, the last leg lower, before we likely recover, as demand probably keeps growing while supply starts to moderate.
Meanwhile, the other big production jump, at least hope of which, is in the U.S. for rare earth materials. And it's a Trump administration that, yes, may have reached a pause with China, but has been investing in the key players in the U.S. Can the U.S. decouple from China when it comes to rare earths? So
investment in the space is definitely rising at a quick pace. Western governments are investing, but we think it will take years to build up an independent supply chain. China's dominance in the rare earth supply chain is pretty incredible. China refines about 92% of rare earths in the world. China produces 98% of the magnets that are critical to make batteries, for instance, or in the defense and AI sectors. And another challenge really has to do with the fact that if you look at some of the deposits of the so-called heavy rare earths, they're incredibly concentrated in China and Myanmar. And so we think this issue is not going to go away. Of course, in the last 2 days, we saw China postponing rare earth export controls for a year, but I think this topic is here to stay with markets and investors for years to come.
So as you suss out where in the world there are these other reserves that could potentially support U.S. efforts to de-risk, not necessarily decouple, we can dive into what that exactly means. Where are you seeing rife opportunities?
Yeah, so if you for instance, look at some of the American, Australian, Canadian companies active in the rare earth supply chain, those equities have really surged year to date. They're actually down over the last 2 weeks, but year to date, you're still up sometimes, if you take an average, 200, 300%. Because we need higher prices to incentivize a big ramp up in production. And so I think the companies in these supply chains are typically in the West, either in Australia, the US or Canada.
What is the biggest obstacle for the U.S. being self-sufficient in some of these areas, in the production side of things, the refining side of things? Is it the regulatory environment? Is it just how long it will take for the plants to get built? Is it just the expertise and the fact that we haven't had it since 2003, 2004? Which is it?
Yeah, I think all of these above, but if I had to give you the top two, I would put refining on number one. Refining rare earths is incredibly complex. These minerals are incredibly similar to each other from a chemical perspective. And so removing them, splitting them is incredibly hard. It requires a lot of expertise. Building a refinery typically takes 5 years. And actually, if you go back to the 70s and the 80s, Western countries like, for instance, France, were leading the refining process. But then those technologies were exported to China. And then they were improved very, very significantly over time. So I think refining is complex. It takes time. And the second major bottleneck is just that some of these deposits, the rare earth raw minerals for the heavy rare earths, they're mostly concentrated in China and Myanmar.
All of that just underscores the immense amount of leverage that China has in discussions with the U.S. And it used that leverage on rare earth elements to bring the U.S. to the table. Does it demonstrate a playbook? Could commodity weaponization in trade talks go beyond rare earths?
So I think that commodities are clearly a key part of sort of the U.S. China race for tech and AI dominance. I think on the China side, indeed, access to rare earths gives China a lot of leverage. If you look at the US side, I think China has been very focused on allowing the US to continue to export advanced chips. You both need very advanced chips, and you need rare earths in this big race for tech and AI dominance. And more broadly, we do think that in a world where countries are very focused on becoming dominant and decouple, we think the risk of commodities being used as sources of geopolitical and economic leverage, will stay high, and arguably has risen over the last 10 years. We have seen export restrictions for rare earths minerals, for cobalt out of the DRC Congo. Big picture, commodity supply concentration is high, has risen further. And that's, I think, why for investors the message is diversify into commodities. It's a hedge against negative supply shocks.
Yeah, the whole idea that Eddie Fishman of Columbia talks about the choke points in the global order. Just real quick, how many calls are you getting on things like nickel that you've never gotten before? I mean, just can you give us a sense of your scope of inbound calls that you're getting?
This is a great year to push our boundaries and expand the scope of commodities we cover. We're enjoying the process, but sometimes we have to go back to our Mendeleev, chemistry tables to go back to the basics.
I was about to say we should have a chemistry. You should have a periodic table on the screen. Dan Stuyven, thank you so much for being here with us. Dan Stuyven of Goldman Sachs. And we are seeing, with respect to oil, this question of how the oil majors are trying to weather this overproduction in the near term. And it does seem like it's cutting staff, consolidating, continuing to produce and weathering the storm.
It's a vicious feedback loop, because if you're continuing to produce, to Dan's point, you're contributing to that oversupply. So then do you need to produce more? Do you need to cut more staff at a time when we're seeing a lot of corporate America think about slimming down?
Yeah, and we already have seen a lot of layoff announcements at some of the big oil companies. Next week, we are going to get a number of other tech companies coming out. I'm curious what they have to say about some of the production issues with rare earth minerals. Coming up next, we'll continue the conversation with Barbara Duran of BD8 Capital Partners, former White House trade official Kate Kalukowicz, Gene Munster of Deepwater Asset Management, and Winnie Caesar of Credit Sites. This is Bloomberg Surveillance. Good morning.
People feel deeply destabilized by inflation, by misinformation, by the potential for job loss. We have to be in service of the individual. Purpose, I think, for the last 15 years has been about we. It's been about societal progress. We actually have an Edelman Trust Barometer special report on the shift from we to me. It's moved from societal to personal. This is profound for brands. You can't buy people's loyalty anymore. We have to be about the individual benefit, giving them optimism. Brands need to live in culture. They have to earn their way forward by doing something. Trust is to do the right thing. That's the essential difference between success and failure.
There's so much uncertainty what's happening here.
That's what's hard for the Fed. They're in the muddled middle.
We're in a bit of a data vacuum.
I don't think that the December rate cut is a foregone conclusion.
There are strong signs here that Powell is struggling to manage the committee.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. We're getting data in the form of earnings. Big tech coming in strong. Take a look at Amazon pre-market shares, just absolutely soaring in pre-market trading. Now the question is the data that we're not getting, the K-shaped economy. Torsten Sklock of Apollo coming out saying K-shaped economy also for corporates, because you can see that big tech space doing absolutely phenomenally, posting incredible numbers. The rest of the world, Danny, not so much.
And the breath has been so bad in this equity market. We have had near record-breaking numbers of days when you are up in the very limited amount of stocks that are taking us there. Is it a really regressive event? Because not only is the stock market going higher, maybe it puts pressure on energy demand, so energy gets more expensive for everyday people. I will say, Peter Scheer in the last hour says not so. The construction projects are actually going to benefit the lower income people and the creation of jobs.
Which is really a key question as we take a look at the CapEx spending from some of these companies. Let's take a look at what some of these companies have been pledging for the year to come as well as the current year. Next year forecasts. Microsoft coming out saying yes, that they plan to increase what they spent this year significantly. Amazon going from $34 billion this year to $125 billion of CapEx next year. We're talking about Meta tripling from almost $20 billion to $72 billion next year, and Google going from $24 to $93 billion. This is massive spending plans that have really been edifying a lot of the rally that we have seen.
And of course, the big tech company that's not on there is Apple. And I really do wonder if the good results from Apple stress test the idea that you have to spend, because it is Apple that has bet that it doesn't need to spend. It can benefit from everybody else. It can partner up with other people, and it doesn't need to commit hundreds of billions in CapEx. So do they prove maybe for some of these companies, I don't know, it's unnecessary?
Yeah, and you're building on what Dan said earlier today, Dan Ives, which I thought was fascinating, the idea that Apple could end up partnering with Google and Gemini using their artificial intelligence rather than investing on their own to really build this out. Is this the model if this isn't going to violate some of the antitrust agreements? That's really a key question here.
That is a huge question because Google has come up against it and lost before. But maybe in this administration, they'll find a more friendly player. Of course, those original cases were brought on by the Trump administration 1.0. But at least it seems like it's a bet Apple's willing to take.
And Google has won some of those cases. So that's also part of the issue. Right now, you're seeing in markets a win for the bulls. You are seeing a third straight weekly gain. Building on that gain this morning, S&P futures up 0.6%. You are seeing yields just marginally higher as people assess the Fed's landscape as well as just the strength in the underlying economy. What you are seeing in Amazon and Apple, real gains, as we mentioned before. Coming up this hour, Barbara Duran of BDA Capital as Wall Street delivers another big tech rally. Former White House trade official Kate Kalukowicz with President Trump's global tariffs facing a legal challenge. And Winnie Caesar of Credit Sites as the AI boom takes on more debt. We begin this hour with stocks edging higher on strong earnings from Apple and Amazon. Bloomberg's Matthew Bloxham joins us now for more. Matthew, thank you so much for being with us. I just want to get a sort of report card on what we've learned this week. Who are the winners? Who are the losers? Are there losers? Or was this just a big beat that blows back all bubble talks?
I think if you look at the top line, it was a win for all of the companies. You know, they generally beat expectations. If you look at someone like a Google or a Meta, where there's question marks about whether so-called legacy social media businesses, which generate all this kind of advertising revenue, are at immediate risk from the likes of ChatGPT. I think what we've seen is they're actually using AI to their advantage to strengthen those businesses in the near term and fend off that competition. But that clearly is a kind of midterm risk around AI browsers eating into that. I think that the story is more nuanced around the investment side. We saw Meta severely punished earlier in the week because there isn't a particularly clear link between the huge amount of money they're spending on AI infrastructure and the revenue that's going to come in to justify that investment. And you're seeing a much stronger connection with the likes of Amazon, Microsoft, and even Google's cloud business. And I think that's because that revenue connection is into the business market. We are definitely starting to see businesses move from a piloting phase into a more kind of implementation phase when it comes to AI. There are much clearer use cases forming that they're investing in, and that's driving demand for additional compute and cloud capacity. And Meta doesn't really have that. And so it's a bit more aspirational in terms of where the new revenue streams are going to come from to justify the huge sums they're investing in AI capacity.
And right now they're looking to the debt markets to open up their pocketbooks to try to help fuel that. Bloomberg's Matthew Bloxham, thank you so much for being with us. Barbara Duran of BD8 Capital writing, the market in the near term seems to have been fully discounting positive outcomes. The narrow advance this week also likely signaled unsustainable near-term highs. Barbara joins us now for more. Barbara, are you pushing back right now against the optimism we're seeing in markets?
In the very near term, but you're also seeing the response. That was a response. This week has been very interesting because going into the earnings for Microsoft and Meta, you had the highest expectations in terms of you had the Fed cutting. You had earnings are coming in well above, targets. And then you also had, people were thinking of the AI. We've had so much reaffirmation in the last few weeks in terms of announcements, especially from NVIDIA and partnerships and orders and that sort of thing. So understandable with a 23 times PE, we're going to have volatility. So in the near term, caution is warranted. However, you're seeing this morning what's happening, with the Amazon, good earnings there, and Apple, not to mention Coinbase. So I think just caution in general at this point, putting new money to work. However, when you get sell-offs like yesterday and you see Meta down, I think Meta is a buying opportunity in here because, again, we saw this a couple years ago. People were freaking out on one earnings because they were spending so much money. The stock got down to $100.99 briefly, and it was a great buying opportunity because it's really about the users and engagement. So on these kinds of sell-offs, that's when you can cherry pick, some of these high-flying names because you have to be long them. And if you're not, you need to get it.
So has Meta then done enough in your mind to prove that it's not just spending for the sake of spending, that it will in turn result in real revenue for them?
I think they've proven that over and over again. And certainly in the last year, they're one of the first to really show their spending on AI, but they're also one of the first to use it effectively. You've seen that in terms of increasing their user base, their engagement, their advertising targeting is much better. They are leading the pack there. So I think they are living proof that AI can really change the productivity of your business.
I say it's remarkable how much event risk we've just lived through in the past 5 days. You laid out a bunch of them, add in tariff China trade talks to the central banks into the tech earnings. Nomura's Charlie McElliott has said the fact that we've gotten the central bank decisions out of the way and the trade deals where it's kind of like nothing to see here means that macro won't be the influence for the rest of the year, that it will be a melt up and a fear of the right tail that keeps people buying. Would you agree with that?
Yeah, I think that's accurate. I mean, we've been through so much geopolitical risk, this year in terms of the Middle East. We still have Russia to deal with, particularly this recent nuclear testing things. That seems to be ratcheting up. China, they really didn't address some of the major things in terms of, are we going to sell the Blackwell chips, or are we going to do a lot more? But that seems to have calmed down. And with President Trump's commitment to go back in April, I think those geopolitical and trade tariffs, I think we're getting used to, there can be a sudden tweet, and we saw that sell-off a couple of weeks ago, and he said 100% tariff on China, but then the market calmed down. So I think that a lot of those things, the macro risks are calming down. So I think it's really looking at, again, right now the market has a high valuation. However, This week also was the again about AI that is so driving it. You had talked earlier about the narrow advance, and it is indeed narrow, but that is where the action is. These are big free cash flow, and if you look ahead to next year, again, we're seeing great earnings, and the guidance is key because obviously the earnings are just what happened. But you've also got the full impact of the tax package, and CapEx should start to kick in. If bank deregulation happens, that's going to actually increase capital available to loan out, helping individuals, businesses, particularly small businesses. So I think there's a lot to look forward to next year that's going to be positive.
Is stock markets gain the credit markets pain? And I ask this because this week we saw a transfer of some of the risk with some of these CapEx plans. And yes, Meta is the poster child of it, but it's not just Meta, it's also Oracle. We've seen these huge debt sales come out. How much does this start to raise your alarm bells about taking more risk in the credit sphere and maybe consolidating any kind of risk on move within the equity space?
Well, I think these are excellent questions, and it's something that you will tend to see in any sector where there's an explosion of interest. Overcapacity is very easy to happen because everybody's doing it. And where does it end up? You know, if you, one example has been the fiber build out, but it's very different because, and I think, and Jensen Huang described it, I think, yesterday about the virtuous circle. Because the more you spend, the more you up the abilities of AI, the more it gets adopted, the more affordable it gets. And a lot of these things, yeah, we're talking about the debt that's been announced, but so much is being financed by free cash flow from these companies, which generate just huge amounts. So I think we are going to see it just continue to build and build and build. And I'm not so concerned about the debt because I think they'll get the payoff on that in a not so distant future.
What you have seen from earnings has been this K-shape, and this is something that Torsten Slok of Apollo put out this morning. You have seen the winners, you have seen the Chipotles, the losers, this idea that you are going to struggle with a consumer that is weaker in certain pockets. And I just wonder whether it matters to you with the narrow breadth and the sort of AI promise in the equity market, whether it matters if the Fed cuts rates in December, or whether essentially this week we learned it doesn't really matter because ultimately it's all about big tech for the risk assets.
It does, and it doesn't matter. I mean, obviously, if they cut, it does help, you know, the big tech guys because it obviously the value of the cash flows going forward. That can be a PE expansion. It obviously matters for housing, for the lower income consumer. We're talking a lot about that, and that's where I think Chipotle is the canary in the coal mine. We've got retail reports coming up. You know, although it was interesting, Amazon, when they reported yesterday in e-commerce, they're not seeing any, you know, impact from tariffs. They're not seeing prices go up. They're not seeing demand come down. But I think it's going to be very different as people start to shop, you know, for the holiday season and what that means and how much the lower income is going to impact. So I think that if the Fed does not cut in December, I don't think it's such a big deal, but we're going to have a lot more information, too, because if right now from private sources and from the companies themselves that are reporting, labor seems to be sort of in a flat line, and whether that's because there's lower supply or whatever. But the one thing we are watching, we've seen these layoff announcements with Amazon, UPS, and others. Right now, still can be one-offs. We don't know if that's a trend because that's been the whole thing. There's no hiring, but there's no firing. Yeah. And so that's being watched very closely. You know, but I think, and again, we're going to have a real lag in information going into that December meeting. Even if the government shutdown stopped tomorrow, it's going to take a while to gather because they haven't been gathering information. So that's got to happen. Yeah. So I could see the Fed not cutting in December, but depending on the information that comes in, could be January because we've been doing pretty well. You know, even with the Fed supposedly restrictive.
Barbara Duran, thank you so much for being here. Barbara Duran of BDA Capital joining us here. And we should be getting personal income and personal spending, Danny, as well as core PCE. And personal spending was supposed to go down to 0.4% based on economist survey by Bloomberg from 0.6%. That's the data you're going to get, estimates from economists, because we're not going to get it officially.
Yeah, you're going to get alternative data. You're going to get the beige book. And again, I go back to Chair Powell saying that's enough for us to make a decision to, I guess, not move.
Yeah, well, exactly. To be in the fog and call it the dark and say,
correct.
Come on, guys, get it together. Right now, let's get you an update on stories elsewhere this morning. Here's a Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. Pfizer has 4 business days to offer a better deal than Novo Nordisk's bid for obesity biotech Metsera or walk away from the deal. Novo Nordisk is offering at least $6.5 billion to Metsera shareholders with the possibility of the price rising to $9 billion if certain targets are met. Metsera is working on an obesity drug that could be given as a monthly shot, while current comparable drugs are taken weekly. Meanwhile, Netflix is reportedly considering a bid for Warner Brothers Discovery studio and streaming businesses. According to Reuters, Netflix has hired advisors and accessed confidential financial data to evaluate a potential offer. Warner Brothers Discovery announced earlier this month that it was exploring strategic options, including a possible sale after receiving interest from multiple parties. And President Trump is urging Republican senators to scrap the filibuster in order to bypass Democrats and reopen the government. The filibuster is a tactic used to delay or block votes by keeping debate running. 60 votes are required to overcome a filibuster. Republicans currently have just a 53-seat majority. It's been 30 days since the start of the government shutdown. That's your Bloomberg Brief. Lisa?
And will they get it resolved by Thanksgiving? So if you're flying anywhere, nobody can blame air traffic controllers because they have a hard enough job. Up next, the Supreme Court showdown.
I think that we have a very high level of confidence that the Supreme Court will side with us. I even spoke in the Oval with the President about it. I'd say the level of confidence is extremely high.
Former White House trade official Kate Kalukowicz joins next. This is Bloomberg Surveillance.
If you are a marketer today, you are not competing with AI. You're competing with a marketer who's using AI better than you are. Consumer behavior is changing dramatically. They're scrolling, they're streaming, they're searching, they're shopping, they're making 35,000 decisions every day. AI is really what's going to enable someone to keep up with that pace of change. The future of advertising is here. I think generative AI is making a difference across the entire advertising journey, whether it is coming up with research briefs or insights or helping you generate creative. It's going to require us all to be leaning in, and I think we're going to see much better work as a result. What animates me today is this unmet opportunity and how the businesses can take advantage of what is going to be the most transformative technology shift of our lifetimes.
Coming into third week of gains on the S&P 500, on the NASDAQ. You are seeing those gains build this morning after tech earnings for the likes of Apple and Amazon. Yesterday up almost 0.7% now on the S&P. Yields just slightly higher, crude lower, as we do get a sense that there is going to be that ongoing oversupply from the likes of Chevron and Exxon competing for market share, not necessarily on price. Under surveillance this morning, Supreme Court showdown.
I think that we have a very high level of confidence that the Supreme Court will side with us. We think we're on very strong grounds. I've been fishing through the briefs myself just to see what the arguments are, and I think that the case is very, very strong, and we're highly confident that they'll side with us. I even spoke in the Oval with the President about it, and I'd say the level of confidence is extremely high.
Here's the latest Supreme Court arguments on the legality of President Trump's global tariffs set for next week. Bloomberg's Tyler Kendall joins us now. Tyler, it seems like a big potential risk for markets. What are you watching as those arguments come to the light?
Yeah, hey, Lisa. Well, the Supreme Court, first of all, agreed to hear this on an unusually aggressive schedule, signaling to us that they may like to resolve this quickly. Now, as you mentioned, this has to do with the legality of President Trump's tariffs invoked through IEEPA, the International Emergency Economic Powers Act, and whether or not President Trump has the legal authority to do so, because we have never seen tariffs enacted through IEEPA before. There's questions here about whether or not he bypassed Congress. But importantly, when it comes to IEEPA, President Trump needs to declare a national emergency in order to use the law. So he did that, one, when he cited fentanyl and the border to impose tariffs on Mexico, Canada, and China, and then again for the so-called reciprocal tariffs, where he cited persistent trade imbalances as amounting to a national emergency. And that is really the second big question to watch out for as this case unfolds, is whether or not those national emergencies that President Trump declared, if he does have the legal authority to use IEEPA, reach the legal standard of being an unusual and extraordinary threat. So those are some of the ways that this could actually play out when it does reach the Supreme Court. But Lisa, it's important for us to note that while IEEPA does extend to the vast majority of the tariffs imposed by the Trump administration, it's definitely not all of them. And U.S. officials have been pretty open with us that they have other tariff tools in the toolbox to use, including those Section 232 tariffs enacted over national security concerns on sector-specific industries, and then Section 301 301 tariffs, for example, which look into unfair trade practices.
Tyler Kendall, thank you so much. As always, right now joining us, former White House trade official Kate Kalukowicz, who wrote, a decision would have the potential to redefine presidential authority over trade policy. Kate joins us now. And Kate, before we get into the big sweeping questions, how are you advising clients who are suggesting that maybe they should try to claw back some of the tariffs that they've already paid, should some of these tariffs be overturned, or potentially could face other tariffs that could be just as punitive, if not more so?
Well, I think as exciting as it is for companies that have been worried about these tariffs and have been arguing about the impact on their businesses, it's really best to take a calm approach to this, a wait and see approach to this, because as you just heard, the president has many other tariff authorities. And I think, frankly, if he loses his ability to use these IEEPA tariffs, he has many other authorities in his quiver to put these back in place.
Even if he has other tools, Kate, how long does it take to implement? How different does the implementation look, if not with the use of IEEPA?
Well, it's a great question because, of course, some of these other authorities require procedures to take place. We've seen in the case of these 232 tariffs that there is about a 200 to 250 day delay in between the announcement and the imposition of tariffs. Section 301 tariffs, which were just referenced about unfair trade practices, can take up to a year. So they are simply not as fast as the IEEPA tariffs, but I think it's important to remember they are more durable than the IEEPA tariffs simply because a process has established them. The one benefit of the IEEPA tariffs, if we want to call it that, is that they can be removed as quickly as they're imposed. So that provides the president and companies a bit more flexibility about the long-term nature of them.
Flexibility, can we translate that into certainty, Kate? Dependent on the Supreme Court decision, what outcome would give more or less certainty to corporate America?
Well, it depends on the type of certainty we're looking for. I mean, frankly, the certainty around tariffs, I think, in a medium-term picture, is that they're here to stay and they're going to expand much more drastically. IEEPA tariffs are quite exciting because of the Supreme Court, because of the way they've been imposed in such a broad way across the globe. The 232 tariffs, which are these national security tariffs on a wide-ranging amount of sectors in the United States, are probably going to be here to stay. And these are very high tariffs. They're 25%, 50% on things like steel and aluminum and cars. And I think, frankly, we need to be prepared for some long-term imposition of these sorts of tariffs.
Kate, how does it change negotiations with China? This week, we saw a standstill or back to normal and waiting another year to renegotiate things. How do changes in the legality impact those conversations?
Well, I'm of the view that they don't change them at all. If you remember, the tariff burden on China largely at this point relates to Section 301, the authority we talked about that allows the administration to go after unfair trade practices. Importantly, before President Trump went to Asia, USTR, U.S. Trade Representative, announced that they would be launching another 301 investigation into China's compliance with the commitments it made to President Trump. So USTR is already gearing up for another round of potential tariffs under a very steady authority. The IEEPA tariffs, or so-called fentanyl tariffs, as you saw, were reduced by half. So that remains 10% on fentanyl and 10% reciprocal, which are under the IEEPA authority. The other 25% are under 301 and can be expanded with fair ease.
Right now, we're just trying to assess what actually got done in Asia, what the landscape looks like. What are you telling clients about how much they can rely on the sort of new effective rates of about 30% for China, 20% for Southeast Asian countries that are big trade partners with the United States?
From a U.S. perspective and from a client perspective, I can say these are fairly stable. The president, of course, has not indicated his interest in raising tariffs on China. I think this is a result and an outcome that he had hoped for. He's going to be very focused, as we saw in the days leading up to the summit with President Xi, a focus on negotiating trade agreements with other economies in the region. He is attempting at the moment, I believe, to isolate China to provide a stronger amount of leverage going into his next meeting with Xi. So whether or not that takes place in the spring or in a year from now, I think we will be moving toward stronger leverage on the United States side. But that will be done to exact wins from the Chinese side rather than impose significantly higher tariffs. Now, of course, we can't predict what the Chinese may do, and our president always likes to go back to tariffs. So I think if President Xi and the Chinese make some big moves, we could see ourselves back in a higher tariff scenario. But as for now, I don't think that's what President Trump wants.
Kate, why is Canada so bad?
Canada is challenging, but I mean, it's not a question of being bad or good. I think there is just some ill personal will that dates back, frankly, for President Trump and former Prime Minister Trudeau. But also, you know, when I speak to former colleagues at the U.S. Trade Representative, negotiators continue to say, we loved negotiating with Canada, but they were tough. They echo a little bit what President Trump says. The barriers that remain between the United States and frankly, its most important trading partner are long held, very difficult barriers. You hear them on dairy and lumber. These sort of sit below the surface and I think create these unpleasant tensions. I am hopeful that Canada, I think, will realize that the United States economy, the United States consumer pool are in its best interest. And I'm hoping some cooler heads can prevail here.
Former White House trade official Kate Klukowicz, thank you so much. It does feel, Danny, like a family affair, doesn't it? Sort of.
Yeah, incredibly personal, like putting out this attack ad here,
Oh,
that
totally.
one there.
I mean, at my Thanksgiving dinner, we're going to have attack ads. I just, you know, different relatives.
Would love to be invited, Lisa. That sounds marvelous.
Actually, not at all. It'll be much more tame. Coming up next hour, not that. Gene Munster of Deepwater Asset Management wrapping up this week's big tech earnings. Plus, Yahaira Anand with your morning movers. Shares of Coinbase higher on earnings and an uptick in crypto trading.
On the other side of every screen is a person looking to make a decision, how to spend their money, how to spend their time. And I think we want to be really respectful of that. If you think about who is on the other side of receiving this messaging, empathy is really critical. You have to think about that human experience and not just a transactional relationship. So how do you make advertising feel less disruptive? It's our responsibility to create those human connections, but do it in a seamless way that makes people feel that it's in service of what they're looking for. Context really matters, and depending on what your brand message is, it really can be powerful when you align your messaging with the content. It gives consumers a better perception of the brand to say, they met me in the moment, and that felt good.
2 hours to the opening bell, and you can see that lift continuing to build heading into the open. Futures higher across the board, up 0.7% on the S&P, even more so on the NASDAQ as we look to tech companies to rally. You do see yields just marginally higher, crude lower. Take a look at these two particular names. We're looking at Amazon and Apple after yesterday's earnings. Amazon shares up almost 13% in pre-market trading. Apple shares up 2.3%. Amazon coming into this was only up about 1.6% on the year. So really put the catch-up trade here to the other tech giants. 2 hours away from that cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. We are seeing Netflix shares and Warner Brothers Discovery shares rising in the pre-market on a Reuters report that Netflix is eyeing Warner Brothers Discovery's studio and streaming businesses drawn by HBO Max and its popular library that includes DC Comics and, of course, the Harry Potter franchise. We know that Comcast and Paramount Skydance are also circling, so this could turn into quite the showdown. And we move on to Coinbase. Those shares are up more than 4% in the pre-market on third quarter profit surge, thanks to stronger trading, plus an acquisition and more digital assets on its platform, helping nearly double transaction volume. Investors also liking what they heard on the call, with Coinbase aiming to become an everything exchange and getting into things like prediction markets. And this is one of those companies gaining attention as an AI play. Shares of Western Digital up nearly 10%. This is a data storage giant, and it is soaring after reporting first quarter profit that more than doubled, with the company saying that AI and data center growth are driving record demand for its high capacity drives. Lisa.
Thank you so much, Yahaira. Danny, I think that we should just be an AI play. I keep thinking that.
I think so. We'd probably get paid more. Maybe we can list ourselves on the stock market and do wonderfully. It's the playbook.
Yeah, AI fueled anchor. On our radar this morning, Amazon Web Services reporting third quarter revenue of $33 billion. That's a 20% jump from last year and the biggest year-over-year rise since the end of 2022. Amazon's total sales rose 13% to more than $180 billion. And really key in this is that, Danny, this is a company that always has been heavily capital intensive. It has never been an asset light company in the tech space. Right now, they're demonstrating the power in their cloud services at a time where the other parts seem to at least not be losing ground.
Right, and in that excellent board you've been showing about how much everybody is spending, Amazon is far and away spending the most. But to your point, they're showing that the spending is paying off, that AI is powering their cloud results. Unlike a Meta, where Mark Zuckerberg was a little bit more vague on exactly what the returns would be from its AI spend. So the market does seem, at least just this week, who knows what happens after that, but more discerning on what you're getting in return for the spend.
Yeah, and how much the spending is outpacing some of the increases that we're seeing in revenue. Meanwhile, when it comes to other sectors other than AI, although they could also be an AI play, U.S. oil majors Chevron and Exxon reporting this morning. Exxon posting an earnings beat, the company pressing ahead with a raft of expansion projects despite slumping oil prices. Meanwhile, Chevron beating earnings estimates as profits from the Hess acquisition were included in the results for the first time. Danny, to me, these stories are fascinating because of the job cuts coming with them and the play for just simply having the supply in order to compete on just product rather than price at a time where prices are expected to continue to be at least somnolent for a while.
Right. It's a symptom of oil prices that are on track for their worst year in 5 years. Plus an OPEC Plus decision this weekend where they're likely to increase oil supply yet again. So you have them and the oil majors increasing the supply. So what do? You just try to get more market share and you go big on expense discipline, which can result in job losses.
Yeah, we saw $18 billion of expense discipline from the likes of Exxon this morning. Vice President J.D. Vance, meanwhile, meeting with airline CEOs amid a push to end the government shutdown. Ahead of the busy holiday travel season, air traffic controller absences causing major delays and cancellations at airports along the East Coast Thursday. This is what really caused the end to the shutdown, the prior longest shutdown that we saw during the first Trump term. I just wonder whether this is also a play for political cover, how much this is trying to jockey for public sentiment as to who's to blame.
And I mean, it's notable that the airlines weren't just like end the shutdown. They said we want to clean CR, which is decidedly with the Republicans and what they want. So the airline's almost making a clear decision in that. But I mean, the statistics and numbers have been so bad. Orlando apparently is one of the worst hit when it comes to air traffic control. The average delay was nearing 3 hours for airlines. In New York City, they had a ground halt, not just because of the bad weather, but also insufficient staff. For these senators and for these representatives who go home basically every weekend, this is hitting them literally where it hurts.
I really would like to see that chart. If you have it, if you could send it to me,
Yeah,
just where the biggest delays are, just because I'm very curious where not to travel.
It will make you at Florida, basically. Don't go to Orlando.
Yeah,
sorry, Orlando.
Honestly, I've seen that happen though so many times. The storm that always happens, the canceled flight, not getting rebooked, but you know.
Yeah, it feels like shutdown or not, you're sitting on the tarmac. Sorry.
Turning back to tech, less of that. Apple share is getting a boost following a revenue beat and an upbeat holiday forecast. Gene Munster of Deepwater Asset Management writing this: I expect Apple to be the best performing Mag 7 through the end of the year. Gene joins us now. Gene, Apple, best performing. Why?
It's pretty straightforward. There's two big levers. First is that iPhone demand for the next 3 quarters is likely going to outpace the street. The street's looking for around 7%. I expect it to be 10%. That, of course, is one of the big focus. That's why the stock was moving around aftermarket yesterday. It's all about the iPhone. So that piece. And it begs the question of why is the iPhone going to be better? It's not about AI features. It's less about product features. It's more about this massive upgrade pool they had back in 2021. As a reminder, that year iPhone grew 39%, huge growth. And then the subsequent 15 quarters, it basically was down 0.5%. And now we're starting to reap the benefits of that big cycle. So that's one piece, is just we're going to see some better iPhone numbers than expectations. And the second is that the Apple Intelligence bar is just so low coming into the new Siri next year. And I think that hope springs eternal when it comes to investors and when it comes to a feature like Apple Intelligence that I believe is going to be the biggest step forward since the iPhone itself. I mean, this is a massive potential for them to contextualize personal data with some sort of digital assistant. And, they've set this high bar out that it's going to be next year. Your own Mark Gurman is saying that it's going to be kind of March, April timeframe. And I think that anticipation of that's going to be good for the multiple. So when you put those two together, I think that sales are going to be better because of the iPhone upgrade pool. And then separately, I think the multiple expands because anticipation of what's going to happen with Apple Intelligence.
Gene, we were speaking with Dan Ives earlier of Wedbush Securities, and he said that he expects Apple to partner with the likes of Google with some sort of a Gemini partnership to provide some of the heavy lifting for the AI effort. Is that something that you're expecting? Is that kind of the underpinning of the optimism around Apple AI?
That's part of it, and I think Dan's definitely onto something that what's going on with Gemini and just Apple working beyond GPT and OpenAI. And what they have told us back at WWDC in June is that they are open to other developers, other platforms, other large language models, and they've specifically pointed out to Gemini. The central question is just how much? Is this just in terms of the menu for developers? Are they going to just allow developers to use the Gemini model when they build iOS apps? Or is this something bigger where they really lean on Gemini to power this new Siri experience? And so it is a daunting task to take this personalized data and do this contextual, build these personalized bots around it. And so I expect them to pull from more than one, more than just OpenAI to deliver that. So I think he's onto something. One of the other big questions around this is what does this mean in terms of financially? And in the case where they would be doing something with Gemini, this is a little bit of a different piece where they're actually licensing technology from Google. It's most likely where Apple would pay Google for that. Now, they've given guidance to expect some of their CapEx and some expenses around AI to go up modestly next year, a few $1 billion, which seems like chump change when you look at these hundreds of billions of dollars that are being spent. So the bottom line is that this is a cost if they do end up leveraging more around Google is a cost that Apple can easily manage and maintain the margins that investors love so much.
Gene, is there any regulatory risk to that? Is this a relationship that regulators would welcome and not challenge?
Clearly, the regulatory piece has been something that has concerned investors. That has been diminishing over time. And I think what we saw with the regulatory around Google and their search deal, of course, this is about a fifth of Apple's earnings come from this Google search placement. And so the fact that that kind of went in a good direction, I think is a sign of a little bit of a softening tone on the regulatory side. So I think that in this piece, this dynamic around Google, it largely won't have a regulatory topic. There is a question about if Apple does want to do something bigger, if they want to acquire somebody like a Perplexity, which I think would make a ton of sense for them. That is something that may be a little bit more of a challenge. These big tech companies want to get a hold of Perplexity and Anthropic, but I think that regulatory piece is something that's going to make that less likely.
So, Gene, if a strong iPhone 17 upgrade cycle allowed Apple to play for time when it comes to their AI offering, just how much time did it give them? How patient are you willing to be to allow Apple to figure out and solve the mess that currently is Siri?
It's really the central question for Apple over the next 2 years, 3 years, maybe even 5 years of how much time investors are going to give them to figure this out. So point of time today is that the bar is really high because they've set that bar high about what the next series is going to look like. But if we fast forward into April and let's say that it's a disappointment, I think that the stock will clearly trade off, but investors are going to give Apple more time. Competitively, all that's on the horizon next year is this new device that we'll see for the first time from OpenAI. It'll be available likely in 2027. But there has been essentially nothing that's happened when it comes to consumer hardware AI that has changed the competitive field. And so at the end of the day, consumers love their Apple devices. This resurgence we've seen with the iPhone in the last 2 quarters, and the guidance for December is all about that commitment that Apple customers have to the platform, that upgrade pool. And so the reality is that these devices just become entrenched in our lives. They just surround us. It's not just the phone. And I think that that's going to give them much more time. Yes, the stock is going to have some variations around how people feel about any given change to their AI, but ultimately, investors will give them more time. And most importantly, the consumers will, because they've made such a big investment into Apple's products over the last decade.
Gene, just quickly here, you said that Apple is going to be the biggest gainer through the end of the year. Who do you see in the Magnificent Seven names as being the biggest loser?
I mean, I think that, surprisingly, I think Amazon's going to have its surge today, but expectations have shifted higher. I still think that they're struggling with, they're losing share within cloud. Yes, they had a good quarter with AWS, but that losing share piece. And so it's been a laggard. It's getting its day in the sun today, but I think that that's probably going to be towards the bottom of the list.
Gene Munster of Deepwater Asset Management, thank you so much for those insights. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. NVIDIA pushing to expand AI infrastructure around the world. The chip maker is supplying accelerator chips to South Korea's largest companies, Samsung, Hyundai, and SK Group. This as NVIDIA plans to invest as much as $1 billion in the AI company. Poolside, the deal would quadruple the valuation of the startup. Meanwhile, American soybeans are great again. China has purchased at least 4 U.S. soybean cargoes following the summit between President Trump and Chinese leader Xi Jinping. Sources telling us here at Bloomberg the cargoes are for shipment later this year and in early 2026, and the total volume is about 250,000 tons. And Google's YouTube TV has lost major channels like ESPN and ABC after failing to strike a new licensing deal with the Walt Disney Company. YouTube called the blackout a Disney negotiating tactic to force price hikes, while Disney argues Google is trying to undercut industry standard terms. Discussions between the companies are ongoing, and YouTube will offer subscribers a $20 credit if the channels remain unavailable. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. Up next, price for perfection.
Spreads are very tight. It probably makes sense for these companies to issue. But I would say that overall, we're starting from a position where credit is priced pretty close to perfection. Not much scope for error.
Winnie Caesar of Credit Sites joins next. This is Bloomberg Surveillance.
I think one big area that we need to reckon with as an industry is the notion of creative effectiveness. Is the work really effective? In the context of marketing for brands, the return on investments needs to be the effectiveness that creativity enables. All roads have to lead to, did we expand the addressable markets because we can now sell to new customers? If you don't have that strategic route to commercial effectiveness, I'm not sure what the creativity was in service of. If a brand of a product, service, or solution is truly differentiated, then it will also stand for something beyond the utility of the product. You want the combination of buying and buying into. That is the playground for creative effectiveness.
Stocks pushing higher on the last day of this week, which would be the third straight weekly gain. You can see it led by the NASDAQ. You are seeing, as the session grows older, futures in the S&P continuing to push higher, up 0.75%, 74 basis points. We're looking also at yields marginally higher. A real question here about a Fed that might not cut in December and what this means longer term, about just how dovish they are. 10-year yields at 4.1%. We did also see yesterday a whole glut of bond sales. And Danny, one thing that we saw was Meta coming out with $30 billion of sales. This follows Oracle with their blockbuster debt sales. And we did see a huge reaction in credit markets, 2 basis point push upward in terms of investment grade credit spreads. Not much in terms of pushback. In fact, more just give us more.
And it's weird because the equity market for Meta fell 11.33%. Usually it's supposed to be the discerning credit investors who get scared and are bearish. Instead, it was the equity market. Does it speak to the amount of capital in this credit market that has to be put to work? That maybe some of the risks are getting papered over, and then you do get that divergence, bearish equity market, bullish credit market.
Is the risk transferring from equities in some ways to credit as they fund the build out of the AI promise, hopes, and dreams? Under surveillance this morning, priced for perfection.
I don't think I'd go as far as saying we are concerned. The fact is the market is currently absorbing it. Spreads are very tight. It probably makes sense for these companies to issue. But I would say that overall, we're starting from a position where credit is priced pretty close to perfection. Not much scope for error.
Here's the latest. Meta defying AI spending gloom with a record-breaking bond sale. The social media giant selling $30 billion of bonds while drawing record interest for the debt. I think that there were offers of something north of $100 billion. Winnie Caesar of credit sites writing this. The acceleration in debt-financed capex on AI-related initiatives is weighing on free cash flow and credit metrics. Meta could turn free cash flow negative next year as capex reaches 50% of sales. Winnie joins us now. Winnie, great to see you. Thank you so much for being here. How much are you getting concerned about the amount of debt issuance tied to some of these big tech companies?
Hey, good morning, Lisa. So we are definitely seeing a shift away from cash flow financed investment, equity financed investment, back into intentional releveraging and some debt financed investment, which is very typical of that middle stage of the credit cycle where you start to see more M&A, more financial engineering, a bump up in capex and spending. And that does come with some additional concerns around where valuations are and are they appropriately reflecting the potential return on that investment.
At this point, do you think that investors just throw caution to the wind as soon as they see the word artificial intelligence in any kind of prospectus?
Well, I think it's a little bit of a more nuanced view than that. I think that people realize that AI is going to be a defining trend probably for the next 5, 10, 20 years. There's definitely sustainability and durability there. But there are a lot of open questions as to the magnitude of return on investment, the timing of that. And I think that people are looking at things like Meta bond deals, which is still a pretty high quality issuer, and thinking this seems like a reasonable place to continue to put cash to work, especially because that new bond sale did come with a pretty significant new issue concession, which is something that a lot of investors have not been getting this year in the primary market. So there's that balance of, are these valuations compensating me for the potential risk in a higher quality company? Now, if this were a single B or triple C related bond deal, I think that we'd have a very different conversation.
Winnie, it's notable, though, that the debt being raised isn't just in the syndicate market. It's also private credit that's been participating in this, too. Meta also doing this, a JV with Blue Owl and PIMCO that leans on Meta's creditworthiness without actually impacting Meta credit because it's off-balance sheet debt. Is that concerning, especially with off-balance sheet debt and that being used as a way to fundraise? Seems problematic in some areas.
Yes, I think that off-balance sheet debt is always a very appropriate Halloween topic. It gets your spooky senses rising a little bit because there is a historic track record of off-balance sheet debt sometimes going a little bit sideways. Now, when it comes to the AI investment spend, there is just the reality that so much capital is being raised and needed to be put to work in such a wide variety of initiatives that some sort of diversification of financing does make some sense. Now, that being said, anytime we see off balance sheet, we're definitely taking a closer look, trying to ensure that we understand kind of the stream of cash flows and where the risks really lie.
Well, for things like project finance in general, things happen, Winnie. There's force majeure. There are big events that disrupt, especially physical plants. Are those types of risks fully appreciated by this market?
Yeah, that's a great point. Project finance can be a really challenging road sometimes. And I think when we look back at valuations and where they stand, the reality is corporate credit spreads are very, very tight. Now, that doesn't mean that they necessarily have to widen, but the balance of risks does seem to be skewed much more to the widening rather than incremental compression or tightening from here on out. And that does leave us a little bit more cautious just in terms of the direction of travel of spreads more broadly, as we have this mix of kind of broader macroeconomic risk with what's going on in the consumer complex, and then also just capital structure and balance sheet risk with how things are being financed, where the capital is flowing, and whether that return on investment is going to be realized in the relatively near term.
You have all of that, and spreads are barely moved, Winnie. What would it take to significantly and sustainably widen spreads at this point?
That is the question that every client is asking us. And I think that it comes down to some sort of acknowledgement that the fundamental picture is perhaps less healthy than what people are currently anticipating. Earnings expectations for 2026 are pretty lofty. The most recent earnings have come in, I would say, relatively well in aggregate, though we have seen some signs of pressure in some different sectors. Now, what usually changes that technical demand for fixed income is concerns around downgrades, around defaults, around the potential recession word. And I do think that over the next 12 months, there is that risk that some of these lofty expectations start to be a little bit disappointed. And that's where you start to introduce some of the conversations around what is the true fundamental trajectory of corporate credit. We've enjoyed a massive ratings upgrade cycle. Is that going to start to reverse and start to spook investors a little bit?
I'm looking at a cuddly cockroach costume from Halloween Cost that looks like it is definitely going to do the trick. Winnie, without government data, I'm just wondering from your perspective, is there any sign whatsoever that we do have that downturn that could potentially call people's bluff?
Yeah, so I think that when we look at the composition of economic growth recently, we do realize that so much of the momentum in the broader economy and also the market has been linked to AI spending, to tech spending, to all of those initiatives. When we think about the current health of the consumer, it's a little bit more of a mixed bag, with the bank saying, hey, we're not seeing a lot of signs of pressure here on the consumer. And then some of the consumer products companies saying this is the worst consumer sentiment, the worst consumer environment that we've seen in a very, very long time. Trying to reconcile all of those things, I think, indicates to us that the job market is going to be the linchpin here. Yeah. We've already seen a pretty significant downdraft in the pace of job ads. Of course, we are flying a little bit blind as it relates to official economic data, but there are some substitutions there that would generally point to not a super encouraging labor market overall.
Yeah.
And we're very much focused on those announcements.
Winnie Caesar of Credit Sites, unfortunately, we have to leave it there. Definitely would be great to get that labor market report next Friday. Coming up next hour, Jim Caron of Morgan Stanley, Vivek Arya of Bank of America Securities, Ryan Wang of HSBC, and Emily Rowland of Manulife John Hancock Investments. From New York on this Halloween Friday, this is Bloomberg Surveillance.
In a world where we're moving so fast and we have all this digital technology, I do think you have to slow down to speed up a bit and reflect. AI is the accelerator of your strategy. It is not your strategy. You can make content 65 times faster than you did yesterday, where you've got AI-generated content. You've got things that are created purely for the algorithms to index. I think people are looking to cut through that to make sure they're really getting the information that they need. People still want trust, they still want brand, they still want a promise delivered by that particular organisation. I'd much rather we have our creative directors really making work that's in the popular culture, that's for people, and not worrying about making 50 different variants of an ad. You have to take time to slow down, sharpen things up, focus on the things that really make a difference.
Earnings growth is driving S&P performance, and you want to be where the earnings growth is.
It's hard for us to kind of see a downside catalyst.
The downside risks here is AI is, I maintain it's a bubble.
The market's starting to get a little bit worried.
The market seems pretty happy to whistle by that cemetery, as they say, and until then, markets are going to rally.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Bubble, what bubble? Heading to close a third straight weekly gain. Big tech delivering big time. Amazon and Apple shares rising ahead of the open as spending plans and revenue continue to deliver. Next week, it's Palantir, Uber, and Qualcomm on deck. Those earnings incredibly important given the fact that government data about the health of the economy really has not materialized, probably will not materialize. It still is, Danny, a government shutdown, leaving us in the dark about the non-AI names out there.
But it almost feels that as long as we're not getting the data, we can ignore the macro, that we can focus in on the wonderful company earnings and the AI spend that continues and just how much that is boosting companies. But underneath the surface, you talked about Torsten Slok's note. There are some signs of economic weakness in company earnings, be it Shake Shack or Chipotle. There is some pullback in spending. Is it just on the margin? Is it larger? All of those questions at the moment getting masked over because the tech players have done so well.
And frankly, the Fed's just bailing on the question because there's so much dissent and a lack of some sort of consensus among Fed governors, Fed members, that essentially they're in the dark and they are reluctant to move too quickly. And this is the reason why there's a hard question around what the reaction function is at a Federal Reserve that's facing off with a blank slate with respect to data at the same time that you're getting this K-shaped delivery from companies, some reporting blockbuster earnings, others talking about a consumer in distress.
Right. What we heard from Chair Powell, was it him just trying to digest really divergent views? Or was it a Fed where the onus is to prove that you need a cut, not that you need to prove that you should pause? And Lisa, does it also just show that this is a Fed that's become irrelevant right now?
Yeah, and especially given the fact that there's going to be a compensation shift early next year. In the meantime, one thing that the big tech players delivered on was the CapEx. When you take a look at just how much the CapEx rose over the past year, how much it is expected to rise next year, you just see an incredible exponential escalation in the spending, a question of who's going to finance that going forward. And I think that that really is going to be an increasing question heading into 2026.
It's just amazing how easily this bond market absorbs the amount of debt coming from these companies, debt to the levels, especially from tech, that we have never seen before. Does that mean it is smooth sailing, that these companies are really well rated? Or is it just because there's so much money that needs to be put to work, that some of the issues maybe are being ignored because that money has to go somewhere? There is real demand and that supply is getting eaten up easily.
Just going to let you know that if we had been a little bit more forward thinking, I would have come as a cockroach today and you would have come as pest control. I think that we picked out the outfits that we would have otherwise picked out.
Absolutely. It's not too late, Lisa. We could do it tonight. I'll show up to the family not Thanksgiving.
Yeah,
that would be weird for Thanksgiving. Halloween event. And we can go trick-or-treating.
Yeah, I'll be in that cuddly cockroach outfit. Right now we're looking at markets that are not seeing cockroaches. They are up. They are up pretty much across the board. You're looking at S&P futures that are rising and continuing to build on gains that we've seen. Now up 0.8%. You're seeing just marginal lift in bond yields, and oil prices lower by 0.3%, $60.38 for a New York crude. Coming up this hour, Jim Caron of Morgan Stanley Investment Management. The stocks eye another month of gains. Vivek Arya of Bank of America Securities as NVIDIA is ramping up its chip rollout with fresh deals. And Ryan Wong of HSBC as the lack of economic data is adding to the Fed's December doubt. We begin this hour with stocks rebounding following a rough day on Wall Street. Jim Caron of Morgan Stanley Investment Management writing, "We expect turbulence in Q4 as we gain more clarity on what the initial conditions will be for 2026. Jim joins us now. Jim, we're always supposed to see turbulence. Why have we not seen any turbulence in the face of so much doubt and yet, frankly, AI companies that just keep on delivering?
Good morning and happy Halloween. So, look, I mean, the markets, I don't think the markets are experiencing the turbulence for a lot of the things that you were just discussing, is that the big leaders, the narrowness of this rally that we've had, which is a large cap tech, are printing really strong numbers. Now, those might be just a handful of stocks. When we look at the rest of the stocks in the S&P 500, there are some cracks, and it is reflecting some of the weakness in the broader economy. I know we haven't gotten any of the data yet, but we understand that things aren't necessarily accelerating. What we have to recognize is that the market is not the economy, and the economy is not the market. So when you think more broadly about the S&P 500, say the S&P 493 x the Mag 7, what you're really looking at is a broader picture also of the economy. So therefore, if the economy is moderating at some point, then you're likely to see those broader equities also somewhat moderate. But the dominance of those Mag 7 is so strong, and the earnings and the numbers that they're printing are so monstrously strong, it's carrying the rest of the markets. So that's why we're not really seeing the turbulence. It really just depends where you look. If you look in other broader sectors of the markets, you might see some of that turbulence. And that's really where we think some of the opportunity is going into 2026.
Can you build on that? Where do you think we're going to see some sort of rebound, given the fact that some people are speculating you could see a growing amount of this pain, given the fact that prices are expected to continue to rise, albeit not necessarily at the levels that we saw in 2021 and 2022. And there is this feeling that this weakness in the lower income sphere is just continuing to build.
Yeah, so we have to look at the full picture here, right? So one of these things goes back to the tax package that, one big beautiful bill that got passed, and effectively starting to think about the consumer and what stimulus package they're going to get next year in the form of bigger tax deductions. That number in terms of what the consumer, what taxpayers are going to pay less is somewhere on the order of $160, $170 billion. So that's money that's going to be in the pocket of the consumer. As we know, consumption is 70% of GDP. That can keep consumption relatively robust, even though the labor market picture, which is weak right now, it's currently weak right now, might start to improve as we move into 2026. Most economists' forecasts into 2026 is that we will have better economic growth versus 2025. So if you have a growing economy, likely in 2026, and you have enough slack in the labor market at this point to keep wages at a reasonable price, then the profit margins and the earnings margins for many of these companies can stay somewhat afloat. So we have to recognize that whether it's accelerated depreciation, all of the various things that came out of the tax package, this is going to be a tailwind as we move into 2026.
And Jim, I know you, and it's the old adage of many people saying that the stock market is not the economy. Is that kind of changing, though? Because nearly half of all households own equities. It is a record exposure from everyday people to this equity market. Have we entered a scenario where this time around, the put from take your pick from the Fed, from the president, has gotten all the more important just because of household exposure to equities?
Yeah, so it's a good point, right? So the way I think about this is that conditions have become increasingly fragile. As this market has moved up, people's overall equity exposure has also moved up too, meaning that their wealth effect is tied to what's happening in the markets. And like any other time in markets, there tend to be drawdowns and corrections and things like that, and that can have a more of an outsized impact on consumer spending and consumer psychology, because as you point out, that there is an attachment to the markets. But that being said, most people, I would hope, when they're investing in the markets, have a diversified portfolio that if we do see this correction that may happen in the future, at some point in the future, I think it's likely to happen amongst the leaders currently right now. It's really probably a large cap tech correction. Maybe that comes. I'm not forecasting that, but maybe that comes at some point. But if you have a diversified portfolio, I think that people's broader portfolios, well-diversified portfolios, will hold up better than what the actual headline of an equity drawdown might actually show. So it really gets down to that. It's a hard question to answer because I don't know how everybody's positioned, but I would expect that most people are pretty well diversified.
A lot of the diversification, though, Jim, this year has come in the form of gold, and we've seen incredible volatility starting this week out with a 3% decline. Is that a concern? Is gold a good way to diversify, especially at these levels where some serious volatility is being introduced?
Yeah, look, I mean, it's one of these subjects here where the price has gone up quite a bit. So anything that you say against that is like, well, you've been wrong in the markets and whatever. We don't have a position in gold in our portfolios. Do I think it's a reasonable way to diversify? Sure. If you have a longer term view and a broader portfolio, absolutely holding some gold is always going to be a good idea. But are there other things that you could also own too? Could you own high quality U.S. Treasuries? Could you own high quality investment grade bonds? earn some income and at least get some positive carry, that should be able to preserve capital and preserve income and things like that. So when I think about a portfolio for people who are broadly investing, they generally need some liquidity in that, and they also want to get some income. So that's why we think about the more of the broader equity market, including large cap tech, but then also thinking about other items, but really at the margin, gold. And I think gold has become very speculative at this point, and I think people are chasing a lot of those returns.
Yeah, we saw that certainly in the past couple of weeks with the volatility there. Jim Caron of Morgan Stanley Investment Management, always wonderful to speak with you. Thank you so much for taking the time. This upcoming week should be jobs week. We should be getting the labor market report on Friday. We should be getting JOLTS. We should be getting a host of different information. Instead, we are not. We are getting ISM manufacturing. That should be helpful with respect to what's going on in the industrial space. Earnings from Palantir, earnings from Qualcomm, earnings from, of course, we can also get Uber on Tuesday. We get the elections in New York. We get ADP employment data, how people are looking to all of these other peripheral measures to take the place of the official data. And then, of course, University of Michigan consumer sentiment data. But it really is interesting, Danny, that everyone is talking about this bifurcation in the economy, how the labor market holds the keys to that. We should be getting the October report on Friday next week. And instead, we're getting crickets.
And part of the issue right now is we're also hearing about all these layoffs from different companies, be it Amazon, be it UPS. It runs the gamut in the sectors we're hearing from. It so far hasn't shown up on the headline level, which has been a head scratcher. Would it be showing up now? That we don't have an answer to.
And Neil Richardson of ADP yesterday was saying the reason why it hasn't shown up is because smaller employers are the ones that account for the greatest amount of job creation. How much can you get a read on those? That's the reason why things like the Beige Book have taken on import as well. Right now, what we're getting from companies is a myriad picture. It's a bifurcated picture. It's that K-shape. And that is the reason why it has been so incredibly interesting. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. President Trump is urging Republican senators to scrap the filibuster in order to bypass Democrats and reopen the U.S. government. The filibuster is a tactic used to delay or block votes by keeping debates running. 60 votes are required to overcome a filibuster. Republicans currently have just a 53-seat majority. It's been 30 days since the start of the government shutdown. Meanwhile, Vice President J.D. Vance is warning a prolonged U.S. government shutdown will impact travel during the holiday season, telling reporters it could be a disaster if the shutdown extends into the Thanksgiving travel season. The comments come after Vance held a roundtable with the CEOs of United and American Airlines. And it's marathon weekend here in New York City. The 54th edition of the world's busiest run is expected to draw more than 50,000 participants from around the world. Temperatures are expected to be in the mid 40s to low 50s with partly cloudy skies. The race begins at 8 a.m. on Sunday morning. That's Bloomberg Brief. Lisa?
Thank you so much, Yahira. Have you ever run the marathon?
I have not, and I never will.
Oh, yes, that was pretty definitive.
I feel like you might have. You're a big runner.
I admire people who run in the marathon. I have the wherewithal to go 13 miles, maybe 14. You start getting into the 2021. That's just,
it's just too much time to train. Like, you have to train like hours on the weekends. I don't have the time for that.
I don't think my knees have the time for that either. Up next, the morning calls, plus Vivek Arya of Bank of America Securities as NVIDIA is ramping up its chip rollout with some fresh deals. That's coming up next. This is Bloomberg Surveillance.
This year, AI became profitable. And when something becomes profitable, you want to manufacture more of it. Just like when you're manufacturing chips and wafers and DRAM, if the manufacturing of those chips were profitable, you want to build more factories to create more chips. Now that the AI is profitable, we want to create more factories to generate more AI.
That was NVIDIA's CEO Jensen Huang speaking at the Apex CEO Summit earlier today, and he was not wearing his leather jacket. He was wearing a regular suit, which is notable. Right now, you're seeing stocks higher. You do have to wait till November 19th to get information from NVIDIA in the form of their earnings. People are not waiting, though, to pile into the tech names after the earnings that we have gotten this week from Microsoft, Alphabet, Amazon, Google, Meta. Right now, you're seeing NASDAQ futures up 1.4% above that S&P return, or the S&P gain on futures of 0.9%. Time now for the morning calls. First up, Piper Sandler raising its price target on Amazon to $300, saying Amazon seems on the cusp of an AI product cycle. Those shares, as we talked about earlier, up almost 13% in pre-market trading. Next up, JP Morgan raising its price target on Apple to $305, seeing its product cycle momentum sustaining as that Apple iPhone 17 really does seem to generate a lot of demand. And finally, New Street raising its price target on NVIDIA to $307, expecting the company to exceed its base case for AI deployments in 2026. Sticking with NVIDIA CEO Jensen Huang is still hoping to sell the company's Blackwell chips to China as it continues to forge new AI deals elsewhere. Vivek Arya of Bank of America Securities maintaining a buy rating on NVIDIA and upgrading its price target to $275. Vivek joins us now. Vivek, thank you so much for being with us. What do you think is the most important takeaway from the Asia tour that we have seen with Jensen Huang and his push to try to sell more into China?
Sure. Good morning. So a few days ago, we had a chance to attend their GTC conference in Washington, D.C. So I think there were three important points that came out. First is that AI is absolutely an ongoing industrial revolution. It's very important for the government to stimulate and nurture it. It's the next productivity tool, and it is not just the government here in the U.S. I think we see this as a global phenomenon. You mentioned he was in Korea, he was in China earlier. So every government in the world, I think, understands that this is a very important tool to nurture. Second is that NVIDIA's full stack approach is seeing applications in a lot of end markets. You know, there's not just some chips that are deployed in a data center somewhere. They're having real world applications and implications in markets such as industrial, such as healthcare, such as cybersecurity, even emerging markets such as quantum and such as robotics. And then finally, the company's visibility extends out till the end of next year, at least $500 billion of orders for its new Blackwell and upcoming Vera Rubin platform. And I think what you're seeing with the CEO's travels and engagements is to make sure that the supply chain is ready. You know, Korea is an important source of memory chips and some foundry capability. You know, it's one thing to say that you have orders for $500 billion, but the supply chain has to be there to adopt it. And then finally, when it comes to China, we have it at zero in our model. I think it's just too hard to predict where the geopolitical nature of these engagements is going to go. It's an important market. We think it's about 10% of the overall market, but I think NVIDIA can do just fine without engaging with China in the near term.
Vivek, we can get to the supply chain securitization that they're working on, as well as this discussion around how much they are connected to the geopolitics of the moment. But I am curious about why NVIDIA is not threatened by any of the other chip makers that seem to be really pushing to try to get in on the game. And we've seen AMD do well. We've seen Qualcomm do well. We've seen the shares of a number of these companies surge, and yet it hasn't dented NVIDIA's lead. Why?
Sure. You know, the very simple visual I can give you, it's the competitors are essentially creating a sitcom at a time, whereas NVIDIA is like the Netflix of the market. You know, that they have developed a full stack approach. Their CUDA software, came into place in 2007. So I think they're in the 14th generation of that. They will soon start their third generation of implementing racks. So what you get from the company is essentially a lot of integration of their hardware and software. There are over 5 million developers who can work with their platform. It's available in every public cloud, whereas a number of their competitors are still developing their first rack scale architecture, and the software is still in infancy. You know, some of the custom chip suppliers that you mentioned have no software. The customer has to develop that. And in other cases, the merchant suppliers, have a decent hardware platform, but they've never actually implemented rack scale. So I think it's important to, put them on a level playing field. And from that perspective, NVIDIA is several years ahead of that.
Vivek, it feels like the rules of the road when it comes to China. We still don't know, even in things that were supposedly agreed upon. The H-20, a glaring example of this agreement reached with the White House where the U.S. would get 15% of the revenue. They have yet to establish a legal framework for it. How do you think it ultimately shakes out?
Yeah, I think, look, China is an important market for two important reasons. One is that their software community is extremely innovative. Unlike a lot of the West, which is, in many cases going after artificial general intelligence, going after the biggest models, the most comprehensive models, there's a big part of the Chinese software ecosystem that is going after a lot more practical applications. And I think in some ways, not having resources has become part of the innovation cycle for them. So it's very important to engage with China. But having said that, if you look at the spending by their top hyperscalers, it is still less than 10% of overall spend. So it's important to engage with China. It's important to stay, competitive. But NVIDIA, we think, can grow their top line over 50% next year without having much contribution from China. I think on the geopolitical side, I think the U.S. wants to make sure that, there is some scrutiny, there is some limitation on what technology is exported. The H-20 is a product that is, at this point, basically 3 years old. I think what China is probably interested in is the Blackwell variant of what NVIDIA can supply, but it's hard to know whether that specific new variant will be approved by the U.S. government. So that's why we are assuming no contribution from China data center in our model.
Vivek, you mentioned the hyperscalers, of which we got their earnings this week. Spending of $72 billion for the year for Meta. Alphabet, it's $93 billion. Amazon, it's $125 billion. As long as the hyperscalers are putting up those kinds of numbers, do you remain bullish on NVIDIA?
Yeah, I think that's absolutely the right point, that it is really capital spending by these top customers. And what I would also mention is that in each of those earnings reports, you heard them say that they are starved of capacity. Right? That it is not demand, it is capacity, it's supply constraints. Otherwise, they could have grown even faster. And you saw most of them exceed expectations for their cloud computing revenues. That's why we think this thing is a lot more real than sometimes people give it credit for. And as NVIDIA comes out with the new generation of their platform, it provides a lot more computing power per unit space, per unit power. And that, I think, is the real constraint. How fast can data centers be built out? How fast can power and water be available to them? And that's when I think the governments, the U.S. government can be extremely helpful in approving these data centers, providing them with power. But I think as power becomes available, you will see a lot more AI deployment. And then finally, I did want to mention that NVIDIA, the stock itself, if we are right about the visibility they shared with us at GTC, it's essentially trading at a market multiple for a company that is able to grow 5 times as fast as the market and grow earnings 7 times as fast as the market. And it's basically trading at a market multiple. So we do think that the stock still remains very compelling.
Vivek Arya of Bank of America Securities with the best analogy all day, the idea of Netflix, the Netflix of the world being NVIDIA and the others just simply being sitcoms. Thank you so much for that. I will just say, heading into the open, we did get Exxon and Chevron earnings, and we're getting some headlines from the Exxon call. This is pretty interesting. Exxon seeing California chasing flawed ideology like Europe. California causing forced speech by companies, a real pushback there.
Wow, and a real willingness to express political opinions, but clearly not against this administration on the other side.
Really interesting. Anyway, we will follow that throughout the day, I'm sure. Coming up, Ryan Wang of HSBC, as the lack of economic data is adding to the Fed's December doubt. This is Bloomberg Surveillance. Getting a lift to end the week. We are seeing futures across the board higher with about an hour to the open, led by that Magnificent Seven cohort that did deliver earnings that beat expectations and continued to indicate incredible capital expenditure spending over the next 12 months. We're seeing NASDAQ futures up 1.5%, S&P up 0.9%. Bond markets are getting a little bit softer here as people try to imagine what it looks like if the Fed doesn't cut in December. 10-year 10-year yields, although now just basically flat here around 4.1%. Turning to the Fed, Kansas City President Jeffrey Schmidt giving his reason for the reason why he dissented in favor of no rate cuts at the October Fed meeting. Bloomberg's Michael McKee joins us now with some more insight. Mike, what's his rationale?
Well, Jeff Schmidt is putting out his reasoning behind his dissent, which was kind of unusual to not cut during the month of October meeting, the Fed's blackout period ending last night. And Schmidt is saying basically he disagrees with the way the Fed is looking at the balance of risks. He says in his statement, I do not think a 25 basis point reduction in the policy rate will do much to address stresses in the labor market that more likely than not arise from structural changes in technology and demographics. However, a cut could have longer-lasting effects on inflation if the Fed's commitment to its 2% inflation objective comes into question. And while Jay Powell dodged my question about market valuations, Schmidt takes a bit of a sideways swipe at it today, adding in his statement that financial market conditions appear to be easy across many metrics. Equity markets are near record highs, corporate bond spreads are very narrow, and high-yield bond issuance is high. None of this suggests that financial conditions are particularly tight or that the stance of policy is restrictive. So you could probably put Schmidt down for objecting to a December cut as well. And I point out that, as I mentioned, the blackout period is over. Lori Logan speaks at 9:30 this morning, and we have Beth Hammack and Raphael Bostic speaking at noon today. So this is the chance to get on the record if you are one of the people who disagrees with the way the Fed is going.
And Mike, we have heard from Beth Hammack before that she does seem more concerned about inflation than other members on the Federal Reserve. Do you get the sense that anyone else on the Fed agrees with Jeff Schmidt and does think that the balance of risks signals they need to be more aware of inflation than perhaps structural labor market issues?
Well, there were people on the Open Market Committee who did suggest that they thought that going much further with cutting rates would be a mistake. Alberto Musalem of St. Louis and the folks from the Minneapolis and Dallas Feds both had suggested that that might be the case. So it'll be interesting to hear from Lori Logan this morning. And we don't have Neil Kashkari on the calendar yet, but we'll see if he comes out with something. We know that Musalem's going to speak next week.
Thank you so much, Michael McKee. Great insights, especially given the fact that we've been talking about how, in general, the Fed doesn't care about markets unless they're going down. It does seem like Jeff Schmidt cares about markets that are flying pretty high, and we are seeing plenty of deals getting done.
Yeah, one of the few to talk about financial conditions is Jeff Schmidt. There is a scenario which we were talking about with Jim Caron where households own a record amount of equities. So there does seem to be an ever more interlinked connection between what the Fed is doing, what stocks are doing, and how good households feel.
Particularly the upper end of households that have a greater proportion of assets in markets. Turning to the economy, the lack of data make earnings reports from consumer brands all the more important. Chipotle shares sliding as much as 22% on Thursday, the largest intraday drop since 2012 after the restaurant chain lowered its full-year outlook. Bloomberg's Michael Halen joins us now. Mike, thanks so much for being with us. I'm just curious whether Chipotle is an anomaly. It's a question of how much chicken and beef they put in their burritos, or whether this really is what you're seeing across the sphere when it comes to consumer discretion and dining out.
You know, look, the low-income consumer continues to be pressured. You know, October, seems to have slowed a bit, especially around the D.C. area due to the government slowdown, right? But the companies that we cover that have reported so far, Chipotle's been the weakest, right? So yesterday, Shake Shack put up a 5% comp. Domino's put up a strong comp. Burger King put up a 3% comp in the U.S., right? So a lot of this is self-inflicted on Chipotle's fault. In the restaurant business, what we're seeing is the gap between winners and losers widen. People are more discerning, so when they do go out, they want to make sure they have a great experience. And Chipotle's numbers would indicate customers are not having a good experience.
So, Michael, more broadly, is it fair to say that you're not seeing this weakness, and you're not seeing the same kind of pushback that we heard in the commentary that spooked a lot of people, at least in markets?
The restaurant data we get, the sales are better than they were last year, which they're not, they're up 1%-ish this year, a little more. So they're not crushing it. Traffic's down. They're taking a little bit of price, and that's boosting sales. So they're not knocking the cover off the ball. Low-income consumers, like I said, continue to struggle. But this is not the end of the world in the restaurant space by any means.
Michael Halen of Bloomberg Intelligence, thank you as always. Maybe they just need to make the scoop a little bit bigger. Ryan Wang of HSBC joins us now, and he's going as an economist with no data for Halloween, which we all find very scary. I'm just curious how much you're digging into some of these earnings reports to edify your analysis in a data vacuum.
Well, that's definitely part of the picture. We have to listen to what the companies are saying. Of course, the Federal Reserve also does still have its beige book reports. So those are the anecdotal comments that can come from businesses of all sizes, big and small. That's even more important in the current environment because, yeah, we're getting a few private sector economic releases, but obviously we are not getting the traditional releases, and this week is no exception. We should have gotten the third quarter GDP number yesterday. We should have gotten the PCE inflation this morning, but it's a data vacuum.
One of the things that is notable, which our Bloomberg Intelligence was just talking about, was for Chipotle and Shake Shack. It's the exposure to the younger customer base, which saw a 4.4% unemployment level in August for those aged 25 to 29. Is that a problem that expands more broadly into the economy? Is that age group a canary in the coal mine when it comes to joblessness expanding?
Well, I think what we've really seen is a small increase in overall employment over the past year. And, you know, the national unemployment rate, or at least the latest one that we have, of 4.3%, is still relatively low. And then when you break it down into those age cohorts, I think it does fit with this idea that, okay, hiring rates are somewhat slow. And so the lack of hiring disproportionately impacts that age cohort. So I think in a way, the signals do make sense. But also it's important to note, again, the unemployment rate overall is fairly low. That's partly because of the impact of reduced labor supply, a huge theme that we heard from the Fed Chair Powell this week and consistently. And that is raising the question of what is the break-even level of job creation, which is, you know, by all accounts, is much lower than it was in the past.
Well, Powell this week also said that there was a strong case to pause if the alternative data, in light of not getting official releases, remain solid. Is the alternative data enough to get a clear enough picture to base a Federal Reserve rate decision around?
I think it just makes things a little bit more confusing. There are some pieces of data. So Chair Powell this week did mention the state unemployment insurance claims data, and Bloomberg, amongst others, is doing a great job of adding those numbers together. So in a sense, we still can say that there hasn't been a sharp acceleration in firing over recent weeks, right? So it just takes a little bit more interpretation. Next week, we will get a private sector release on employment growth from ADP. And going into this government shutdown, it appeared that employment growth had slowed to around 50,000 per month. So we'll be looking at those numbers next week to see, is there an acceleration from that rate? Are we still staying around that 50,000? But again, it's against this context of much slower population growth this year, much slower immigration. And so we have to take that into account when we evaluate these numbers.
Has the Fed rendered itself irrelevant right now? And I say this because ultimately it seems like the market, and I say collectively, and perhaps the consolidation at the top and the lack of diversification with names is a feature, not a bug when it comes to the returns, seem to be climbing regardless of a Fed rate cut in December. So does a Fed rate decision matter at all right now to markets that are flying on some other indicators?
Well, it also goes back to this question of what is a neutral policy rate, right? So what is holding back? What is a rate that doesn't hold back the economy, doesn't hold back markets? And I think it's all rolled into together, right? We have to look at equity markets, but also the rates markets. And at the end of the day, the Fed only has one instrument. So it's hard to find a single number that's going to balance all of these different elements. This came up also in the press conference where, you know, Chair Powell basically said, look, all of the investments, all the AI investments that are happening right now, they're not particularly interest rate sensitive investments, right? So, of course, the policy rate doesn't really have a big impact on that structural trend.
At this point, though, can't you just say that the economy is doing fine with interest rates where they are, and this overlay of CapEx spending has just turbocharged certain points of it? But wouldn't that suggest that we're closer to neutral, sort of to Jeff Schmidt's point?
Well, yeah, I mean, there certainly is a case for that. And our own view is actually that, at least in the near term, the current policy rate, which is now below 4%, may actually be relatively close to neutral. And we know there's a spectrum of views. We know that Chair Powell considers the policy rate only modestly restrictive. So that means less restrictive than other peers on the FOMC who think it's moderately restrictive. That makes a big difference because it's what's going to determine how many rate cuts going ahead, the speed, and our own forecast actually is that we will get a December rate cut, but nothing in 2026 or 2027.
Which flies in the face of the potential composition shift and what they can do based on the economic activity. Who is going to lead the Fed? Ryan Wang of HSBC, thank you so much for being with us. Have a wonderful weekend. Danny, that to me is really the key question, right? Is this going to be a Fed with a very different reaction function next year that might not look at the data in the same kind of way that the current Fed Chair Jay Powell Fed does?
And is it a Fed that allows inflation to stay around 3%? Do they look the other way? Do they unofficially adopt more of a band approach than specifically targeting 2%? And what does that mean for economic acceleration? You and John have talked a lot about this. Are they going to be cutting into an acceleration, especially with the capex coming from the tech giants?
And this has been a pretty dovish Fed. I mean, we've had inflation above 3% for 5 years now. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahaira Anand. Yahaira.
Hi, Lisa. U.S. oil majors Chevron and Exxon out this morning with earnings. Exxon posted an earnings beat. The company is pressing ahead with a raft of expansion projects despite slumping oil prices. Meanwhile, Chevron beat earnings estimates by a wider degree as profits from the Hess acquisition were included in the results for the first time and provided a boost. Chevron's global production rose 21% to the equivalent of 4.1 million barrels a day. Meanwhile, according to the Wall Street Journal, JP Morgan is running a group investing about $90 million in the Texas Stock Exchange. The TXSE Group is expected to launch the Texas Stock Exchange next year. The Journal reporting the JP Morgan investment brings total fundraising above $250 million. And in sports, Lamar Jackson returned from injury to lead the Baltimore Ravens to a decisive 28-6 victory over the Miami Dolphins on Thursday Night Football. The two-time MVP threw 4 touchdown passes as the Ravens defense forced 3 turnovers and held Miami to just 6 points on 2 field goals. Baltimore rises to 3-5 and Miami falls to 2-7 on the season. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahaira, and have a wonderful weekend. Up next, Emily Rowland of Manulife John Hancock Investments as AI demand continues to fuel the market rally. Plus, Yahaira back with your morning movers. Getty Images surging on a new licensing deal. This is Bloomberg Surveillance.
When it comes to big tech, I mean, $1 trillion in the balance sheet, generate $300 to $400 billion a year. So that's why the reality is they are fueling this AI revolution. Investors continue to underestimate the scale and scope, and that's the fuel in the engine. That's what's fueling all of this in terms of the CapEx cycle. You need to own the winners. You can't just own an AI play because they have great PowerPoints.
That was Dan Ives of Wedbush. Still bullish, definitely though trying to pick the wheat from the chaff, trying to figure out which AI plays are the right ones, which aren't. Right now you're seeing everything being the right play in markets. Equity futures up higher across the board, 0.7% gain on the S&P, more than a 1.5% gain. When you take a look at the NASDAQ, you are seeing a bit of a bid into bonds as the session grows older and a bit into oil as well. Meanwhile, under an hour away from the cash open, here are your morning movers with Yahaira Anand. Yahaira.
Hi, Lisa. We have to repeat Amazon because it is our big mover of this morning. If this rise of 13% holds, it is set to add $300 billion to its market cap at the open. The company's profit engine, AWS, was the star. It saw revenue jump 20% year over year, its fastest growth since 2022. And moving on to our next stock, which is Getty Images. That is a small stock, but it is soaring 76% after the company struck a multi-year licensing deal with AI darling Perplexity, basically allowing Perplexity to use Getty's photos across its AI tools. It's a big shift for Getty, which at one point saw AI as a threat, but If you can't beat them, join them, right? And we end on Roku. That stock is falling nearly 4% in the pre-market, despite the video streaming company posting strong results due to ad growth. Analysts say the results were good, but not gangbusters, which is a problem for a stock that has run up 35% year to date. Lisa.
Thank you so much, Yahaira. Great work, as always. Counting down to the opening bell, here's a trading diary heading into next week. Today, as Mike was saying, we do get Fed speak from Logan and Hammock. Watch for further descents to the potential for a December rate cut Monday. Manufacturing PMI and ISM data, plus earnings from Palantir. Tuesday, elections in New York City, New Jersey, and Virginia, plus AMD coming out with earnings. Wednesday, ADP employment data, new import, given the fact we're not getting official payrolls data at the end of the week. Earnings from Qualcomm. Thursday, a Bank of England rate decision. Friday, we get the University of Michigan consumer sentiment, which may also be more important to some people based on the fact of just simply an absence of anything else. Turning back to markets, S&P 500 is set for another month of gains, fueled by tech optimism. Emily Rowland of Manulife John Hancock Investments writing, almost everything right now across global markets is a derivative of AI. We are following the earnings growth in our overweight high-quality tech, comm services, utilities, industrial sectors. Emily joins us now. And Emily, I think that's perfectly put, the idea that even Caterpillar is an AI trade at this point. How much does that give you confidence versus make you concerned?
Well, it's both, Lisa. We have this love-hate relationship with U.S. mega cap tech stocks right now. We love them because the earnings are there. The earnings engine in the United States is on. The challenge, of course, is that they're overloved, they're overconcentrated, and the valuations are getting pretty egregious here in our view. So, we like a combination of sectors here that are benefiting from AI. Obviously, tech is experiencing the demand. Comm services are big users of AI. We've got industrials really developing the infrastructure here around data centers. And of course, utilities really providing the power. So there's a lot of different ways to play this, but we do want to be mindful of the concentration risk that's inherent in markets today.
So if you're not overweight some of these AI names at the moment, Emily, is it too late to join the rally? Are the valuations such that you don't want to be selling, but you can't be buying more?
Well, no. I mean, valuations can stay extended for some time. And in our view, they're not necessarily a catalyst for a market correction. It's just a really tough starting point. So what we want to do is find the higher quality parts of the market. We look at things like PEG ratio, so how much you're paying for future earnings growth. We want to focus on sectors that have great return on equity, great balance sheets, lots of cash, good free cash flow. What we're not chasing right now are the sort of momentum and technical darlings, the retail favorites, the unprofitable tech companies, the meme stocks that are now back in the headlines. It's really about finding that intersection between high quality and not overpaying for that earnings growth. And then diversifying with some mid caps that are going to give you some differentiated exposure to things like industrials and mid cap banks that are benefiting from M&A activity.
Bank of America, though, pointed out underneath the surface, despite a calm on top, that individual stocks have lost or gained more than $100 billion in market value 119 times, or 119 instances with that level of swing happening. And that is the highest annual total on record. They noted that it was a fragility event, a sign of fragility. Emily, is there some real fragility underneath the surface?
Yeah, Danny. I mean, the concentration risk is a huge issue right now. You wake up every morning, the top 10 stocks in the S&P 500 are a greater portion of the index. Right now, we're at 41%. It's a big challenge, and there is some weakness under the surface. You look at small caps, for example, 40% of the Russell 2000 index is comprised of companies that don't make money. So we want to be mindful of the risks in some of those areas. We want to be mindful of the concentration risk. Looking overseas, in particular, we're looking at international growth stocks, which have some earnings catch-up potential. China, for example, on the tech side is another area that we're emphasizing in portfolios. So a diversified approach. There's some broadening in international markets that we like to see that's healthy. So you've got to be mindful, certainly, of some of that risk in the United States.
When you talk about diversification, Emily, how much is is it diversification away from the AI trade versus diversification from stocks to bonds to commodities?
Well, I can always count on you, Lisa, to bring us to the fixed income discussion, which I'm happy to do. And we still think that there is a lot of value in the income that's available in bonds right now. We've seen a notable backup in bond yields, back, of course, above 4% on the 10-year Treasury yield. And while stocks are priced for perfection and frankly a far from perfect world, we still think bonds are mispriced here. They offer a lot of value on this at these levels. Bond investors just aren't sniffing out the disinflation that we see coming, particularly from the housing market, as well as the cracks that we're seeing in the labor market. So, of course, this week, Powell was a bit hawkish, not committing to that December cut. We saw rates go up. We think this is an attractive entry point to lock in that elevated income and build a return stream here that could last for years.
You're talking about treasuries in particular when you talk about the sort of gold standard, the benchmark fixed income instrument. I wonder what you think about gaining exposure to AI-related names that do have investment-grade credit ratings, but at the same time are selling the likes of $30 billion of debt or even more. And you're seeing just the glut of that coming into the market. Are you a buyer? Would you rather have exposure to the fixed income side of the tech story than the equity one?
Yeah, we like anything that has the word income in it, Lisa, right now. And we think that can be a more important driver than capital appreciation into 2026. And investment grade corporate bonds, single A, yielding around 4.5% right now. We think that that's a really fantastic time to lean into that income. It is higher quality. Investment grade to us is like the new high yield. You don't even need to go down in the credit spectrum anymore to generate elevated yield. Investment grade corporate bonds right now are still trading at about 95 cents on the dollar. They're typically trading above par. So we're always looking for bargains in the market. Bonds are still digging out of the worst bear market in modern history right now, and they offer value. So we would be slightly overweight fixed income here and letting bonds do more heavy lifting in portfolios into next year.
Emily Rowland of Manulife John Hancock Investments. Thank you so much. Have a wonderful weekend. Danny, you are going to sprint over to the other set and carry us forward because you want to spend more time on air. And I am just curious, what do you have in store for us?
I think a lot of it is going to be about this big tech rally that continues to be underway. The market opened, the enthusiasm over Amazon, just how much that fuels this market higher, despite the fact of all the event risk littered throughout the week, be it the Fed, be it China, the concentration for this market is the AI spend.
What's fascinating to me is that the event risk has been to the upside. And that is what we continue to see, that people have all of these concerns. They're worried about cockroaches. They dress like them for Halloween, but they aren't necessarily seeing it borne out in the numbers. Is CapEx spending now viewed as a positive and a sign of just how much demand keeps stripping supply?
And I'm really excited. We're going to have the CEO of Blue Owl on, who just did a deal with Meta and gave them more debt, allowed them to do off-balance sheet financing for one of their data centers. So for him, he's all bulled up.
I cannot wait to watch that. It is going to be a really interesting trade, something that a lot of private investment firms have been trying to get in on. Coming up on Monday, we have Steve Chivarone of Federated Hermes, Amanda Lynham of BlackRock, Mike Wilson of Morgan Stanley, and Bob Michael of JP Morgan as we do face off with the data desert that should have been the jobs a week. This was Bloomberg Surveillance.
वही गाइस, क्रूड ऑयल देखो सपोर्ट के आसपास आया है, यहाँ पर एक बाइंग का प्लान करते हैं। इंडियन मार्केट तो हो गया क्लोज। नेचुरल गैस उसी लेवल पे रुका हुआ है, इसमें कुछ और बीच में कोई नया लेवल बन भी नहीं रहा है, नहीं तो कुछ प्लान करते। निफ्टी अच्छा गया आज, निफ्टी फ्यूचर कह सकते हैं। ठीक है, यहाँ पर एक बाइंग का प्लान इन क्रूड ऑयल। ऊपर ऑयल रेजिस्टेंस से जाके नीचे गिरता तो बेटर होगा। ये पॉइंट ऑफ इंटरेस्ट से कल भी फॉल कर गया था, आज भी उसी लेवल के अराउंड ही से फॉल कर गया है। बाकी इस कैंडल को देखोगे एग्जैक्टली यहाँ पर ये सपोर्ट पे ओपन इक्वल टू हाई बनी थी, नहीं तो यहाँ पर भी बाइंग का प्लान करते। बट ऑलरेडी वहाँ पर 2-3 बार बाइंग आ चुकी थी। एक बार यहाँ से आई थी, दूसरी बार यहाँ से, तीसरी बार यहाँ से, चौथी बार ये फिर सपोर्ट पे ओपन इक्वल टू हाई एंड देन फॉल। कोई नहीं, नीचे वाला सपोर्ट भी है, दो सपोर्ट साथ में बने हुए हैं। ठीक है, यहाँ से एक बाइंग का प्लान एंड इसका कितना है। बाकी ये सपोर्ट ऊपर का जो ब्रेक हुआ है, दैट नाउ एक्ट लाइक एज अ रेजिस्टेंस। सपोर्ट का ब्रेक डाउन हो गया है तो कि वो ऊपर वाले लेवल पे फॉरेक्स में भी नहीं गया एक्चुअली। एमसीएक्स में देखोगे, फॉरेक्स में देखोगे ना, फॉरेक्स में भी नहीं गया ऊपर वाले रेजिस्टेंस पे कल, हमारा मार्केट क्लोज होने के बाद भी। ठीक है, ऊपर जो सपोर्ट है नाउ एक्ट लाइक एज अ रेजिस्टेंस, यहाँ से वापस हम सेलिंग का प्लान करेंगे ओवर हेयर अगर मिलता है तो। एंड नीचे से एक बाइंग का लास्ट टाइम यहाँ भी प्लान करते हैं। यहाँ पर भी ऐसा नहीं कि पहली बार आ रहा है, बट यहाँ अभी भी होल्ड करके थोड़ा बहुत तो रुकेगा। रीटेस्ट के लिए जाना है अगर तो इसको यहाँ डाल दो। हाँ, आने दो। इसको टारगेट यहाँ तक रख लेते हैं। ठीक है, ये आपका सपोर्ट हो जाएगा अब। एंड ऊपर आता है तो अब यहाँ से ही वापस सेल कर देंगे एज अ रीटेस्ट। रुकने की कोशिश तो कर रहा था काफ़ी देर से ये प्राइस, फिर सडनली ओपन इक्वल टू हाई बनी, ब्रेक डाउन करा दिया। इसका मतलब चाह नहीं रहे थे यहाँ से लिक्विडिटी लेना प्राइस के लिए। यहाँ से नीचे तो नहीं जाना चाहिए अभी विदाउट कोई न्यूज़। ये लेवल ही है हमारे पास अभी फ़िलहाल के लिए, क्योंकि इसके नीचे कोई सपोर्ट दिख नहीं रहा है नियर बाई में, फिर सपोर्ट काफ़ी दूर ही है। सो लेट्स होप ये इस लेवल को एटलीस्ट होल्ड करे। Trump tries old tactic with China on fentanyl on new working group. Star eating black hole unleashes record setting energetic flare. बाकी मैंने मॉर्निंग में बताया था आपको निफ्टी फ्यूचर के बारे में, वहाँ पर एक सपोर्ट था 25,800 से 25,790 के बीच में। वहाँ पर जब मॉर्निंग पे फॉल किया था 15 मिनट टाइम फ्रेम पे, उसके बाद काफ़ी देर रुका जरूर प्राइस, बट अल्टीमेटली वो भी ब्रेक डाउन हो गया। ब्रेक डाउन के बाद रीटेस्ट किया एंड देन फिर नेक्स्ट सपोर्ट पे आके स्टक किया, क्लोजिंग हुई है। इसका रीटेस्ट तो नहीं है खैर अब। बाकी गोल्ड कल मैंने बताया था आप लोगों को 1 आवर टाइम फ्रेम पे वहीं से एग्जैक्टली सपोर्ट लेने के चांसेस हैं अगर नीचे आता है तो। अभी भी रेंज के अंदर ही है 1 आवर टाइम फ्रेम पे, मैंने आप लोगों को कल दिखाया था एक आइडेंटिकल रेजिस्टेंस बन गया वहाँ पर। ये 1 आवर टाइम फ्रेम का चार्ट है, इस पर्टिकुलर जोन पे देखोगे ना, ये 1 आवर टाइम फ्रेम का चार्ट है फॉरेक्स में गोल्ड। मल्टीपल टाइम इसी लेवल को हिट किया जा रहा है और नीचे से बार बार सपोर्ट है वो अपसाइड जा रहे हैं। लॉजिकली तो ये ब्रेकआउट होता है इस तरह से, बट ये जरूरी नहीं है कि डायरेक्टली ब्रेकआउट करे, ये हो सकता है एक बार बायर और सेलर दोनों को ट्रैप करे उसके बाद निकले, क्योंकि इसमें रेजिस्टेंस आप मान के चलो इस लेवल के आसपास कहीं होगा और सपोर्ट आप इस लेवल के आसपास वापस मान सकते हैं। तो दो पॉसिबिलिटी, या तो ऊपर जाए सेल ऑफ आए एक बार, या फिर नीचे आए पहले। यहाँ पर ये जो स्विंग बने हुए हैं छोटे छोटे, इनको टेकन आउट करे, लोअर एंड से लिक्विडिटी ले, देन मार्केट मूव अपसाइड। ये नेचुरल गैस में कुछ लेवल है ही नहीं, वही सेमी सिनेरियो है, सेमी पैटर्न चल रहा है। ऊपर रेजिस्टेंस है, एक और रेजिस्टेंस ऊपर एक और है, वो भी कंसिडर कर सकते हैं वैसे तो। कल सेल ऑफ आया था, रिकवर कर गया, फिर सेल ऑफ आया है, फिर रिकवर कर गया, एक छोटा सा फ्लैग जैसा बना रहा है शायद ये। कोई नया सपोर्ट रेजिस्टेंस भी क्रिएट नहीं है, नहीं तो बीच में कहीं प्लान करते हैं। शायद फॉरेक्स में बनाओ, एमसीएक्स में तो वही कल वाली ही लेवल है। इसमें रेंज लग रही है शायद थोड़ा सा एक बनती हुई नेचुरल गैस में, दोनों ही साइड पे, फ्रॉम 377 से 367 के बीच में। ये 10 पॉइंट की रेंज आई एम एक्सपेक्टिंग नाउ, क्योंकि इसमें और कुछ तो है नहीं करने के लिए। इस रेंज को ही शायद थोड़ा बहुत मार्केट प्ले आउट कर सकता है। इसको ना एक पॉइंट ऑफ इंटरेस्ट में डालना पड़ेगा। दो पॉइंट ऑफ इंटरेस्ट लग रहे हैं मुझे अभी तो फिलहाल। ये रेंज छोटी सी घूमे जा रहा है इसी रेंज में ये, क्योंकि इसमें दोनों साइड फेक ब्रेकआउट और ब्रेकडाउन हो चुका है, तो लिक्विडिटी यहाँ पर है, इसका मतलब दिस इज अ रेंज यू कैन एक्सपेक्ट एटलीस्ट जब तक ये रेंज के बाहर नहीं निकलता। तो नेचुरल गैस में प्लान करना चाह रहे हो तो फिर इस रेंज को प्लान कर सकते हो, नीचे से बाय ऊपर से सेल। इसमें और मुझे कुछ खास तो नज़र आ नहीं रहा है जिस पे प्लान किया जाए, तो इस रेंज को प्ले आउट कर सकते हैं अभी फ़िलहाल के लिए, इफ़ यू वांट टू ट्राई। बट थोड़ा सा रिस्क रहेगा, रेंज है। नॉर्मली तो रेंज के अंदर बाई सेल करना नहीं चाहिए, लेवल पे आए तो ही ट्राई करना चाहिए, बट या थोड़ा सा अगर रिस्क ले सकते हो तो एक ये सेलिंग का ट्रेड, बट याद रखना थोड़े से रिस्की ट्रेड रहेंगे। नीचे आता है तो यहाँ पर एक बाइंग का ट्रेड, ठीक है। एक स्मॉल सी रेंज है, रेंज की तरह ही प्ले करना, ज़्यादा रिस्क भी मत लेना। छोटे छोटे एसएल के साथ हल्का सा पुल बैक आता है, फिर से ट्राई कर सकते हो, बट याद रखियो रेंज है, लेवल थोड़े से दूर ही बनाए हैं, तो थोड़ा सा रिस्की जरूर रहेगा। बाकी अगर नहीं लेना चाह रहे हो, लेवल का वेट कर रहे हो, नीचे और ऊपर लेवल मेजर लेवल है उनका वेट कर सकते हैं। इस रेंज को प्ले आउट नहीं करना है तो अगर अननेसेसरी, बट थोड़ा सा रिस्क जरूर है इस रेंज में।
Exchanges on navigating macro uncertainty. Exchanges on the forces shaping global markets. For the sharpest analysis on finance, business, and the economy, count on Exchanges, the Goldman Sachs podcast. Listen now.
News when you want it with Bloomberg News Now. I'm Caroline Hepker.
And I'm Stephen Carroll.
The UK Chancellor Rachel Reeves has laid the groundwork for tax increases in her upcoming budget, blaming the previous Conservative government as well as global trade frictions for harming the UK economy. In an unusual set-piece speech at Downing Street, just weeks ahead of the budget, she said she was determined to bring down inflation and keep her lid on the UK government's borrowing costs.
Inflation is already much lower than the double digits seen under the previous government. And the choices I make in this budget this month will be focused on getting inflation falling and creating the conditions for interest rate cuts to support economic growth and improve the cost of living.
Reeves added that previous policies around austerity, Brexit and the handling of the pandemic left the UK with a worse inheritance than previously thought. She was determined that her budget would be focused on reassuring markets and reducing the government's debt.
LGT's investment solutions allow you to look to the future with confidence. Over its 100-year history, LGT has repeatedly demonstrated its resilience, proving to be a stronghold of stability in a world of change.
Global deal makers are on a tear with mergers and acquisitions on track for this.
LGT's investment solutions allow you to look to the future with confidence.
And then expand thereof, so that 38 billion could continue to increase. And we know that OpenAI has just got a never-ending need for compute more broadly. So once again, another deal coming from the cloud computing giants out there.
फ्रैंकली अरुण जी, एनी ट्रेड अवेलेबल इन क्रूड ऑयल? क्रूड ऑयल में दोनों ले सकते हैं। यहाँ से एक बाइंग का ट्रेड है छोटा सा, फिर ऊपर जाता है तो रीटेस्ट में सेल भी कर सकते हैं। ऊपर वो जो सपोर्ट है ना, ये ब्रेक हो गया है, तो नाउ इट एक्ट लाइक एज अ रेजिस्टेंस। ठीक है, यहाँ पर एक सेल भी कर सकते हैं। अभी के लिए तो ये दो ही ट्रेड ही अवेलेबल है इसमें। ऊपर आता है तो रीटेस्ट पे सेल कर दो, नीचे आता है तो बाई प्लान कर सकते हैं वापस। लगा देता हूँ मैं सेलिंग का वाला भी ना। बाकी नेचुरल गैस में ध्यान रखना, नेचुरल गैस में वैसे कोई ट्रेड है नहीं, लॉजिकल ट्रेड देखोगे तो कुछ है नहीं। एक मैंने लगा जरूर रखा है, रेंज आप कह सकते हो, मार्केट रेंज में बना हुआ है तो इसी रेंज को शायद फॉलो कर सकता है। इसके मेजर सपोर्ट रेजिस्टेंस तो इन लेवल पर हैं, ये सपोर्ट एंड रेजिस्टेंस। तो अगर प्रॉपर ट्रेड कर रहे हो तो इन्हीं लेवल पे करना। अगर रिस्क थोड़ा बहुत ले सकते हो तो छोटी सी रेंज को प्ले आउट कर सकते हो। यहाँ से एक सेल, यहाँ से एक बाई, बट रिस्क इन द सेंस ऑफ एसएल बड़ा मत रखना और क्वांटिटी ज़्यादा मत लेना। अगर इस छोटी सी रेंज को प्ले कर रहे हो तो नहीं करना है, रेंज लेवल का वेट करना है तो फिर लेवल का ही वेट करना। ठीक है, एग्जैक्ट लेवल जो यहाँ पर एरो लगा रखा है वही है, बीच वाले लेवल थोड़े से अलग हैं।
Numbers here, they're saying, look, I'm paying $5.8 billion, this is Iran, to Dell for the equipment. But then longer term, this is a more than $9 billion deal with Microsoft. You're starting to understand some of the margins, some of the operating costs more broadly.
Elsewhere, more debt. That seems to be the theme,
debt,
right?
yeah.
Have a deal with someone and take on more debt. This time, it's Alphabet. It seems like it's both European markets and U.S. markets that it's tapping, but this is a completely different model for these tech giants, isn't it, to do so much of the growth in CapEx through debt?
Because usually it'd been their own money. And actually, there's that $3 trillion figure out there coming from Morgan Stanley. And look, we're awash with numbers, so it can be hard to really understand. But $3 trillion is what Morgan Stanley thinks is going to be needed to roll out the AI data center spend to 2028. They think about half of that's going to come from these companies' cash flows, but the other half is going to come from interesting financing, whether it's Blue Owl that we see Meta turn to, or whether it's the debt markets, which Meta tapped $30 billion worth of last week. But now we see Alphabet go for 3 billion euros over in Europe. They already did their first European sale at the beginning of the year. And then they're tapping the US markets as well. And look, interest rates have been coming down a bit. This is an interesting way to continue to show your commitment to growing. And of course, remember, Alphabet, we rewarded for spending more on their compute last week. We're seeing the growth trajectory for Alphabet and for their Google offering.
And we are speaking to PIMCO President Christian Strack later in the program, who helped lead one of the Meta debt offerings. Caroline, thank you so much for joining us. Caroline Hyde of Bloomberg Tech, and she'll have more on the Amazon OpenAI deal later in her show, and we'll also have it more for you this hour with Bloomberg Intelligence analyst Anurag Rana. Some other big deal news on this Deals Monday. Kimberly-Clark buying Tylenol maker Kenvue for about $40 billion or more. We're joined by Bloomberg managing editor for global business, Eric Fanner. Eric, it was a company that J&J didn't have success with, so they spun it off. It didn't work as a spinoff, even with all of the activist investors circling around it. Why should its fate be any different with Kimberly-Clark?
Yeah, that's a good question. I mean, this whole consumer health area is one where we've seen a huge amount of activity in recent years, with a bunch of big pure play pharma companies like Johnson & Johnson getting out of the area, out of this area. We've seen it also with companies like GSK, Pfizer, and others, all kind of moving to separate or sell or spin off their consumer health brands. So that's created a whole bunch of new players like Kenvue and some others, Haley and over here, which are sort of floating around, and people are looking for new partners to attract scale. And so that's where Kimberly-Clark comes in here, and they immediately then get to rival the biggest player in that sector in consumer space, which is P&G. So you get to form a big new player that immediately vaults ahead of some of its close rivals. So you got more scale, which is key for these companies in an area that has a lot thinner margins than the traditional pharma business that they were attached to with Johnson & Johnson.
It also begs the question, what's Kimberly-Clark's relationship with President Trump like? Because he has led a huge attack against Kenvue's biggest product, right? Tylenol. Acetaminophen is, of course, the drug that's the main ingredient there. Do you think this company is going to have any plan to deal with the president better than Kenvue did as a standalone?
Well, that is a really good question, and as you say, this is something that's weighed on the share price for Kenvue. Their sales have been falling, not entirely due to this, but it's definitely been under pressure from this attack from the Trump administration, linking acetaminophen, Tylenol's active ingredient, to these claims of autism, which haven't been proven, of course. And so it is a really good question. How do they deal with that going forward? There's a real risk here in these kinds of deals when you take on that kind of a liability. So definitely an element of risk, yeah.
All right, Eric, thanks so much for joining us. Eric Fanner there talking to us about one of the biggest deals that we've seen today. Of course, there have been a couple of more than $30 billion deals on this Monday. Let's stick in the healthcare sector and talk about Pfizer. It is suing Metsera and Novo Nordisk in an effort to block Novo's bid for the former obesity startup Metsera. Pfizer says Metsera breached its earlier merger agreement by declaring Novo's offer as superior. We know that last week Pfizer said it was reckless of Novo Nordisk to make the offer that it did. Bloomberg Health Team editor Cynthia Coons joins us now. So they're really getting aggressive here.
Yeah, so this is Pfizer's second lawsuit going after Novo and Metsera in 4 days. Clearly, Pfizer's trying every grounds to stop this. On Friday, they tried to get a temporary restraining order to stop that deal from moving forward. But while that's being worked out, they're going in with an antitrust angle, and they're arguing that they would be a better owner for Metsera, that Novo already has a dominant market position, and that it would basically hurt consumers. So that's their latest play in this.
Underlining it, is it just a Pfizer that's behind in obesity medication?
Yeah, Pfizer needs a good deal. I mean, Metsera is not the only company out there, but they did strike what they see as a good deal. Metsera agreed to the deal with Pfizer, even though it wasn't the highest offer they got. So there were, I guess, a sense that perhaps Pfizer had a better position from an antitrust perspective to get the deal done.
And they're closer to the Trump administration.
Yeah, so that on Friday, Pfizer said that they had gotten through a big step in the regulatory process on the antitrust front. And that was surprising because actually those kind of clearances haven't been granted during the shutdown. So Pfizer does have a better hand to play here, you would think. But Novo's deal is higher. And Metsera's board so far has said that they perceive that to be the superior offer.
Interesting. Cynthia, thank you so much for joining us this morning. Bloomberg's Cynthia Coons, and a quick check on futures this morning. After 3 weeks of straight gains, will this be a fourth 6 months of gains for the equity market too? That's the longest winning streak since 2021. Tech has been outperforming all October. It continues this first day of November, outperforming too, up 0.8%, while the Russell 2000 declines 0.1%, Matt.
All right, let's get a look at some of the other movers on our radar. Amazon and NVIDIA both jumping on Amazon's $38 billion deal with OpenAI to supply NVIDIA chips. And that's only one of the deals we've seen this morning that involve NVIDIA chips.
And I'm most excited about this because that insane graphic we have of the interwebbing links of everything can now just get even more complicated.
Yeah, we can update that. I don't know if Dell was in there. We can put a Dell circle in there.
Yes.
Joe can hook that up for us.
Yeah, I can't wait. It'll be even more confusing for everyone looking at it. Also, some other deals this morning. U.S. precious metals producer Coeur is buying new gold for about $7 billion. That will bolster its Canadian operations, with gold still trading around $4,000.
And another big deal, Eaton agreed to buy liquid cooling specialist Boyd Thermal, different than Boyd Aviation, for $9.5 billion to capitalize on AI data center demand.
And all of this putting deal makers on course for $4 trillion of deals this year. And more U.S. shale consolidation, SM Energy will be buying rival Civitas in an all-stock deal. That one's worth $2.8 billion.
Coming up, Berkshire Hathaway rising pre-market after announcing a record cash pile. But is that really good news that they have no idea what to do with their money and apparently don't want to use it to buy their own shares? This is Bloomberg Open Interest. Let's get out of high interest. Look what's making headlines around the world. OPEC Plus will boost oil output slightly in December, then pause hikes through the first quarter as it braces for a supply glut. The pause reflects an expectation for a seasonal slowdown and comes during a period for uncertainty for oil traders thanks to additional sanctions on Russia. The IEA warns global output may outstrip demand by over 3 million barrels a day this quarter, deepening fears of a record glut next year. Now, despite tariffs, deficits, Fed clashes under President Trump, money continues to pour into U.S. government debt. Treasuries are up about 6% this year. It's the best run since 2020 as falling inflation, just barely tinily falling inflation, and Fed rate cuts draw global buyers with other economies facing their own strains. The U.S. remains the safest, most liquid haven, but risks still remain, including tariff fallout, a weaker dollar, and political fights over fiscal policy, if any of those things happen. Berkshire Hathaway's cash hit a record $381.7 billion last quarter as Warren Buffett stayed on the sidelines in terms of M&A. Operating profit jumped 34%, led by booming insurance results and unusually low disaster activity. Investors are paying closer attention as the company nears a new era, with Buffett handing off the role of CEO to Greg Abel at year-end. Danny?
Let's discuss those results further. Joining us now is Alex Rajmandari. He covers Buffett and Berkshire for Bloomberg News. Alex, it's the size of a cash pile equivalent to P&G, equivalent to Home Depot. Today underscores that deals are happening. There clearly is stuff out there to buy. Why is Berkshire Hathaway still on the sidelines?
That's the big mystery. There's nothing in Buffett's eyes, it seems. He hasn't been buying any equities on the market. I mean, he has, but is a net seller of equities of $6 billion. There's been a string of quarters like that. And he hasn't been buying by his own shares, even if, the shares have been down 12% since he announced his retirement at the end of the year. He's stepping down as CEO. He will still be chairman. So that raises the question, is that a good thing? Really, the net investment income of the company has decreased quarter over quarter because of short-term interest rates falling over the period. So it's not really yielding more money for the company in terms of investment income. And it kind of raised the question. I was talking to an analyst yesterday. She was saying, look, if they have so much money that's yielding less and they don't buy their own shares, why should you?
Yeah, it seems to make the case quite well that their shares aren't at all undervalued, right? Otherwise, they would be buying them back themselves. And that the rest of the market is pretty fairly or even highly valued, because otherwise they'd be playing in this M&A extravaganza that we're seeing. What is it, $4 trillion?
Yeah, 3.8 at the moment this year.
In deals this
just
year.
Almost there.
Yeah.
So to be sure, Buffett has not done nothing in the past quarters. He's done, he bought this stake in United Health for $1.6 billion. He's buying Oxychem for $9.7 billion. That's in the fourth quarter, though. So we need to see, in a few weeks, we're going to know exactly what happened on his investment in equities. But it's true that when he doesn't buy shares, it means that he thinks that the intrinsic value of the company is below what it's trading at. And he's been saying that he doesn't see a lot of opportunities on the market, and the markets have been growing even more since he made that comment.
All right, Alex, great to get some time with you. And, of course, we're going to continue to watch what he does with this cash pile. I want to take a look at some of the movers on our radar this morning. Semiconductor jumps after a third quarter revenue beat. Estimates, you can see well, I don't know if that's a jump.
Yeah,
really,
that's more of like an inch.
Yeah.
Inches
higher.
Crawls higher.
Yeah.
Palantir's moving even much higher than that, even though it hasn't reported results. Will report after the bell. Investors see revenue growth of 50%, so the bar is high.
Memory stocks are climbing as earnings and AI deals point to a demand upcycle for their products. These are actual jumps here.
Especially SanDisk. 5% counts as a jump.
Yeah, SanDisk, which you may remember from before phones had cameras built in, up 5%. Micron up 3.5%. Western Digital gaining 1 1/3.
Coming up, we'll get back to the broader equity market. Citi's Stuart Kaiser on the S&P 500 6-month winning streak, plus volatility risk from economic data once the government shutdown ends. All of that to come on Bloomberg Open Interest.
Abu Dhabi is a rising global hub of business, culture, and tourism. In 2024, the Emirate welcomed 40 million visitors, generating $24.5 billion in tourism-linked GDP.
As Abu Dhabi Global Markets, our role is to make sure that we give people a safe, transparent, well-regulated, rule-of-law-based society. We offer, I think, world-class infrastructure. And effectively, the only thing that I tell everyone, Abu Dhabi is open for business.
As I reach a milestone in my life, I'm humbled by my good fortune, yet well aware that I still have much to learn. And if I stay true to myself and follow my instincts, my legacy will be looked on kindly by my friends, my family, and hopefully generations to come.
One of Wall Street's biggest optimists is getting concerned about the bull rally, saying the S&P could fall 5% by the end of the year, which, by the way, would still be a pretty good rally for this equity market. Ed Yardeni says that he's getting worried that so much bullishness around equities is a contrarian red flag. He told Bloomberg, quote, "The crucial question is whether this rally has already gotten ahead of itself. Just one unexpected event could knock stocks down from their highs amid poor market breadth." Joining us now is Citi Head of U.S. Equity Trading Strategy, Stuart Kaiser. And again, I think it's important to say, he's not saying we're like headed for a bear market. He's like, maybe like a tiny little 5% drop. Is it a concern that there's so many bulls in this market right now?
I mean, is it a concern? I mean, valuation's high. Obviously, the markets have kind of gone through a lot of event risk and managed to rally. But there are still people, I think, that need to be convinced to own equity. So I'm not sure I would call the market max bullish. I think there's certain investor groups that are. But you got to remember, I mean, as recently as a few months ago, you were still in the, U.S. exceptionalism is dead theme, and people didn't want to be in the U.S. So, look, a 5% pullback is always possible in any, 2 to 4 week period. So I wouldn't dissuade you of that. But I would say that I don't think that every investor we talk to is max bullish. And frankly, I think there's a lot of people that were cautious coming into the fourth quarter to begin with and probably could be convinced to get in the market into year end.
Got to be only institutional, right? Because what we hear from, for example, the St. Louis Fed is that American households have never been this exposed to the equity market. And ditto foreign investors. Like, even though they may have said they didn't want to buy America, they own more equities as a portion of their portfolio than they ever have. So where's the marginal dollar going to come from?
Well, look, I do think international investors, at least based on the ones we've talked to, have been playing catch-up probably since June to get more exposure to U.S. equity markets and more exposure to the AI theme, which, frankly, you can't own really outside of the U.S. Agree with you. I mean, retail investment volumes are setting new records every week, but it doesn't mean they're going to stop. stop, right? I mean, retail investors seem very active. They were buying the market in April. They were buying the market on the pullback over the summer, so I wouldn't necessarily see them pulling back. In terms of, who's underweight, I do think some macro-type investors are probably still a little bit underweight U.S. equities. They've been owning gold and owning other assets. I think they saw better risk-reward in bonds and in gold and in FX. And I don't think anybody really thought the S&P could be pushing on to 7,000 by the end of the year. So I do think there's a little bit of catch-up there. And frankly, look, seasonals look great into year-end generally. Buybacks picking up after earnings. There's a lot of reasons to believe that you're going to have flows come into the equity market by year-end.
Does the participation of retail, though, change this market? Does it make it more volatile? Or when you get the incremental fundamental information, does a larger adjustment need to happen if you've had this big cohort that's just been buying on anything?
I'm not necessarily of the view that retail makes it all that much more volatile. Yes, you have more zero-date options and things of that nature, but I actually would argue concentration on the institutional side and the way a lot of the pod shops invest with leverage and with favorite stock portfolios on top of their book might make things a little more volatile than retail necessarily. Like if you go back to DeepSeek, NVIDIA was the retail favorite. That sold down, about 15% of the DeepSeek news. The AI power gen utility stocks, which I would argue are more of an institutional trade, were down 30 to 40%. So retail actually stepped in and bought their favorites on the weakness, whereas institutions were kind of forced to de-risk. So is there a risk that retail suddenly pulls back? There is that risk. There's a risk of anybody pulling back. But I don't think that we've necessarily seen retail creating more volatility in the markets.
All right, we're going to take a quick break because when we come back, the opening bell, kicking off the month of November. Stuart, we're glad to have you here to kick off the month of November after 6 months in a row. 6 months of consecutive gains for the S&P. Can we continue? This is Bloomberg. We are moments away from the start of trading, kicking off the month of November. This is Bloomberg Open Interest. I'm Matt Miller. With gains in futures, you can see right now S&P futures are up 0.5%, so we're accelerating that gain into the open. NASDAQ futures up even more as NVIDIA rose more than 3% in the pre-market. The small cap's not doing anything right now. The bell on the New York Stock Exchange. Who is, I can't even see.
The slow reveal.
There, yeah, Q ringing the bell at the New York Stock Exchange, all in green, so I'm guessing that's a St. Patrick's Day company. And then here on the NASDAQ, Allegro Microsystems, which provides chips for power capabilities and sensor capabilities. Had a pretty good year, up 36%, although over the past 5 years, that's about what they're up as well, 45%. There's a lot going on in terms of M&A today, and you've got a board of a couple of those stocks in a deal.
It's almost as if it's a deals Monday, return to the market. Some big movers off the back of that. It is Kimberly-Clark and Kenvue. Kimberly-Clark will be buying Kenvue for an enterprise value of more than $48 billion. Kenvue, of course, makes Tylenol and other consumer goods. It also makes Kimberly-Clark the second biggest seller of health and wellness products after Procter & Gamble. Matt.
All right, we have even more deals today. Amazon and OpenAI struck a $38 billion cloud deal to help power its AI products. Microsoft made a deal with Australian data center operator IREN worth more than, or nearly, I should say, $10 billion. The U.S. is going to allow Microsoft to ship more NVIDIA chips to the UAE in coming years. That's an $8 billion deal. And I actually was taking a look, all these deals, right, and all this optimism, I wanted to look at the seasonality. Okay. So the Bloomberg has a function for that, SEAG Go, just to check out what's going on in November on average over the past 29 years, because that's as much as I can drag it out. It's the best month of the year on average. So it's like everything is going for us. We're back with Citi head of U.S. equity trading strategy, Stuart Kaiser. Is there any reason at all to be bearish?
Yeah, I mean, I think that there are reasons to be bearish. I mean, we have a federal government shutdown that's, going on a month now.
Seems like no one cares, other than Newark Airport, right?
Other than Newark Airport. I mean, I think there's some people in the greater Metro D.C. area that probably are a little more concerned about it than we are up here. So there's a risk there. If you look at Oracle credit spreads, I mean, that kind of stuff is definitely eye-catching, that the amount of investment-grade debt that is getting issued and needs to get issued is pretty stunning. And we're going to have to see how well the market digests that and how well the stocks react. Look at Meta earnings last week. One of the first first times that a company has announced large capex spending plans, not getting rewarded for it. So there's definitely, some things out there if you wanted to squint. But look, the seasonality, I think, is really positive into year end. Buybacks are going to pick up post earnings. You're getting a lot of these AI deals announced. So path of least resistance definitely higher, but we could probably come up with a list of 3 to 5 things that, might keep you up at night and ruin your Thanksgiving potentially.
Well, maybe all the good things are just happening for the S&P or for the Mag 7. In other words, the broadening out rally that's had fits and starts this year is currently having a fit. The equal-weighted S&P 500 fell last week. Tech outperformed. The Russell 2000 fell too. Is the broadening out trade over for this year now?
It's a good question you bring that up because if you look at year to date, it's actually the belly of the market, the S&P equal weight, that's massively underperformed. It's underperformed both small cap and S&P cap weighted. So basically what you've had is this huge demand for mega cap, and you've kind of had this low quality catch up. Our view is that that's probably not sustainable medium term. You can't have kind of the middle of the market underperforming both ends. I think that's more of an early 2026 story, to be completely honest with you. And look, that theme will get tested the next couple of weeks. We're past Mag 7 earnings. We're going to get earnings from kind of the quote-unquote rest of the companies, and we're going to have to see how they perform. But it's been a very odd year that way, that the mega cap and then unprofitable small cap have done well.
The chunky stuff has done pretty well, it feels like.
It's done stunningly well. It's up 20-30% in the last few months. So there is an issue there of, can this market rally sustain itself without the belly kind of getting filled? I would say probably not, but I think going into year end, at least the investors we talk to, if you're up this year, it's been a really difficult year. The odds of you getting creative with your portfolio going into year end, I think, are pretty low. So we think what's worked is going to continue to work, and that's probably high growth momentum leadership, kind of going into year end will outperform.
You have flagged, and we have touched on power generation. Clearly with the amount of capex that the hyperscalers are spending, with the amount of demand from all of us on ChatGPT or Gemini or Llama or whatever else, these places have to get power, and it's not going to be cool with the American people if it comes at the expense of tripling their bills. So who's going to fill that void? Like, what's your best bet?
I mean, it's a great question, Matt. I think what we've seen in the last few weeks is a number of states are now sort of carving out the hyperscalers and forcing them to pay a higher electricity tolling rate than retail investors.
How did it take them this long?
Well, I mean, it didn't become a political issue till now. I mean, if you watched a football game over the weekend, the number of New Jersey gubernatorial ads you saw that were targeted at utility costs, probably made you want to change the channel. I'm told the same thing's happening down in Virginia. So likely what we're going to be seeing is you're going to see alternative forms of energy get brought on, and you're probably going to see, the pricing dynamic shift a little bit to protect the retail consumer from hyperscalers kind of driving their utility costs higher. State of Wisconsin raised the ROE cap, for their local utilities. So my point is there are some beginnings of an effort to kind of balance this out and make sure that you and I are not paying, for Meta, et cetera, to develop more AI product.
One of the interesting twists of what's been happening just in the past week with the AI trade, too, has been the difference in treatment from the equity market and the credit market. I'm thinking very specifically of Meta here, where shares fall 11%. And then you have this big bond offering, and spreads for IG markets widened by like a whopping 2 basis points. The credit market has been acting more sanguine than the equity market in that case. Do you expect that dynamic to continue?
I'm not sure how that dynamic is going to evolve, but I think it's going to be in the crosshairs on a go-forward basis. I mean, we issued almost $80 billion of IG debt last week and over $125 billion of IG debt last month. Meta's fine, clean balance sheet, et cetera. Look at Oracle. They're trying to raise $38 billion to fund some of the stuff. Their credit spreads have risen consistently since they reported earnings. So I think you've got the large cap hyperscalers who have these incredibly clean balance sheets and massive free cash flow generation. They're going to be treated one way.
Yeah, but more of the debt's going off balance sheet, too. I mean, they have clean balance sheets. Why wouldn't they just continue to raise the money on their own by doing all this off balance sheet financing?
I believe the term is financial engineering, but no, honestly, it's a good question. And I'm sure these companies know what they're doing in terms of managing their balance sheet and income statement. But point is, there is a massive amount of investment-grade credit coming on. You have a group of companies with the cleanest balance sheets in the world, and then you have that next tier who have good balance sheet but not great.
This is the DDIS function for Meta, and it shows that they only have $60 billion in debt. This is not including the 30 that they sold last week, but and it's a $1.6 trillion company. So that's a drop in the bucket, but. As a shareholder, and this is, I guess, a basic CFA question, right? Do you care as an equity shareholder if your company is borrowing like tens of billions of dollars. Does that make you kind of want to sell some of the shares, or does it not matter?
Well, I mean, I think what you just showed there is with that cleanliness of balance sheet, when your balance sheet looks like that, most equity investors probably want you to issue more debt, right? Because you're borrowing at such a rate, and you can add leverage into it. For another company who might have more leverage, that math might be a little bit different. I think Danny raises an interesting question. If you have such a clean balance sheet, why are you getting creative? I'm sure they're getting creative for CFA reasons. Let's just put it that way. So look, I'd be much more concerned if these debt deals got announced and I saw my credit spread widening out, because then the market is telling me something about how this is being received. I think for a Meta, an Apple, a Google, a Microsoft, issuing $25 billion of debt, to your point, is kind of a drop in the bucket, and I don't think there's too much concern for those
Deals
companies.
are back. Financial engineering is back. We are so back. Stuart, thank you so much for joining us. That is Citi Head of U.S. Equity Trading Strategy, Stuart Kaiser. We are just 8 minutes into your trading session. A check on this equity market, the first trading day of November, and we are higher by 1/3%. Some not very good breath. We are up only 116 stocks are up, but that's enough to carry this market higher because the big dog Nvidia is up. A couple things going on there. Deals abound. Its chips are finally getting sent to the UAE by Microsoft. Amazon's also higher. That is a deal between them and OpenAI. So you announce an AI deal, and congrats, your shares will move higher. You can see it's very concentrated in tech and the gainers. The losers side, you got some of the tech players there too, Apple and Broadcom. Kimberly-Clark, though, down 11.7% after it announced that it will be buying Kenvue. Kenvue has been moving higher this morning. Looking at the sectors themselves, it's Amazon that is dominating what the sectors are doing because it's consumer discretionary at the top of the pile. Consumer discretion, as Matt would say. Amazon leading that sector higher, so it's up 1.9%. But again, Matt, we are back in this environment where the breadth is not good. It is tech carrying us higher. It's Nvidia and everything else not having that great of a day.
Yeah, that's a risk from a technical analysis standpoint, but everything else seems to be in favor of more gains here. We have a ton of deals. M&A is back in a big way. You've got agreements between the U.S. and China to let us buy more rare earths. They're going to buy apparently more of our soybeans, like they always did before, and it's November, so typically a fantastic month for stocks. Coming up, we're going to get more on today's M&A bonanza as Amazon's $38 billion deal with OpenAI adds fuel to the AI trade. This is Bloomberg Open Interest.
Day of November on the back of a 6-month gain stretch. Will we make it 7? At least off to a promising start. The NASDAQ 100 outperforms, up just under 0.7. The S&P up 0.2, with the Russell 2000 underperforming, down 0.8%. Some of the top calls this morning, the analyst action that we are watching. Cisco, that gets upgraded to a buy at UBS. The analyst there citing a multi-year growth cycle fueled by AI infrastructure demand. Shares up 1.5%. Next up, Morgan Stanley gets its price target, or they boost the price target for SanDisk. That goes to $230 from $96, so a huge price target upgrade. But drop the company as a top pick for whatever reason. The analysts say that the stock's rally means that there's little room for mistakes, though he remains positive on its outlook. Those shares up just under 1%. Finally, Loop Capital Markets, they raised their price target on Nvidia to a street high of $350. Wow. It's a figure, Matt, that would imply a market cap of over $8.5 trillion. They say we're entering the next golden wave of Gen AI, and Nvidia is at the front, kind of sounding a little bit like Dan Ives there. Here's a fun fact from our terminal producer, Dan Curtis. If you took all of the street high price targets for the Mag 7 from Apple to Google and Meta, the group's market cap would go from $22 trillion to $32 trillion.
And those are 12-month price targets,
yes,
right? So that's like next year.
Yes.
Wow.
I mean, and they've been trying to play catch up a lot, so I don't know. It's not the craziest thing.
I mean, if it's true, we really are in a golden era. Let's talk a little bit about Nvidia right now. Continues to rise, at least today, along with Amazon. Amazon's cloud unit signed a $38 billion deal to give OpenAI access to hundreds of thousands of Nvidia chips. For more, let's bring in Anurag Rana, senior analyst for Bloomberg Intelligence. And Anurag, can you help us to understand what 100,000 chips means. I mean, it could be potato chips as far as I'm concerned, right? Although far more expensive. How much compute do you get from 100,000 Blackwell GPUs?
You know, if you were to ask me that a few years ago, I would say that's a lot. But now we are, hearing about 500,000 chips clusters. So there is this is just getting bigger and bigger every day. But, frankly speaking, the Amazon deal, you would have expected that because of the revised Microsoft OpenAI Pact, under which OpenAI has the ability to go out to any cloud provider now. Before, Microsoft had to sign off on it.
Anurag, again, every day it's a new deal, be it Amazon and OpenAI or Microsoft and IREN. With these deals being inked, how much of them are actually in production? How much of the data centers is actually shifting to Gen AI use versus just general cloud?
So this is a very good question, and the answer, it really varies depending on who you are asking. So if you're thinking about, Oracle creating a data center for OpenAI, that's going to take some time. But the deal today basically says OpenAI will have availability of those GPUs under the Amazon Cloud's infrastructure, and that could be actually very near term. So if you remember, Microsoft had you could say, agreement with OpenAI to be the exclusive cloud provider. During that time period, OpenAI was able to go to a handful of them, such as Oracle or CoreWeave. But Amazon was not in that mix because Amazon's the biggest cloud provider with the highest market share. After the agreement was revised and OpenAI had the ability to go anywhere, we had predicted last Thursday that this is a very strong case this is going to happen because AWS has the largest scale distribution network and it has all the chips that people want. So this is a very logical step for OpenAI to go to AWS and add to what they're already doing.
We see so many deals with companies saying they'll get X amount of NVIDIA chips. And NVIDIA obviously doesn't have an endless supply of chips. So how does Jensen Huang decide, you get 100,000, you get 500,000, I'll give you $1 million? Because that seems to be very important right now.
No, this is always the case. So, I've talked to Kunjan quite about it, who covers NVIDIA for us. In his model, he doesn't think chips being a big bottleneck, which means they have the ability to create as many chips for this year as the demand is looking through. Now, how NVIDIA distributes it also depends on how big is the cloud provider. When it comes to Amazon and Microsoft, I don't think they will have a problem gaining a lot of the chips. I think another group of companies that will get a lot of the NVIDIA chips are the neoclouds, people like CoreWeave, because they are, you could say, a de facto distribution arm for NVIDIA. So I think chips is not the roadblock right now. It's usually power.
And that power demand, again, it's another thing that we hear deal activity swirling around, be it nuclear this or nuclear that. Anurag, that's also a timeline that takes a very, very long time to get up and running. So what happens when you have this mismatch of data centers coming online, but the power supply not yet there?
Yeah, I think that is a bigger problem just because it takes a lot longer to get them active. And, we have had one of our energy analysts explain to us that if you want to open a data center, for example, in Virginia, it's going to be very difficult because the power constraints are there. But if you want to go to Michigan, some of the other Midwestern states where there could be excess power at that point, there is a chance you can create some data centers there in a short period of time.
Anurag, thank you so much for joining us. Always really great to get your take. Anurag Rana of Bloomberg Intelligence. Coming up, Kenvue soars as it will be folded into Kimberly-Clark in a $40 billion deal. We have the details next on Bloomberg TV.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what stocks are doing to kick off November. And gains have really dissipated. We're only up now 0.1%. It's better than a loss, I guess, if you're long stocks, but 68.50 is the level we're looking at. 68.90 was the high that we reached on a couple of closing sessions last week. NASDAQ 100 gaining more as NVIDIA is still putting up some gains and worth more on that index than it is on this. Take a look at NVIDIA, now up 2.5% as we get a number of deals with companies claiming that they've clinched a certain amount of NVIDIA chips in the deal. Alphabet shares, one of those gainers right now, but only up 0.4%. Iron is up on the Microsoft deal to get compute from Iron. So Iron getting a 20% boost. Microsoft up 1% as well. And Kenvue getting bought. You can see the 18%, I guess the premium's more than that, but 18% gain there. And then Kimberly-Clark getting hit. More than 10% drop at Kimberly-Clark as it makes that deal in stock and cash. Danny?
And just again, on that deal, Matt, it's going to be given an enterprise value of $49 billion. So this is a chunky deal, maybe part of the reason why we are seeing some shares from Kimberly-Clark decline today. Liana Baker, Bloomberg managing editor for U.S. Deals, joins us now. She and her team lead coverage of these big movers. And Liana, this is something Matt and I have been grappling with all day. This is a company spun off from J&J, so clearly didn't work at J&J, didn't really work as a standalone company. Activist investors couldn't figure out how to right-size this company. So how is its fate different under Kimberly-Clark?
It's funny. Yeah, you're right. Kenvue wasn't long for this world as an independent company. Soon after it spun off from J&J, there was even drama with the actual spinoff. I don't know if you remember, there was like an arb play around that. But yes, Starboard's Jeff Smith, a feared activist, is on the board of the company. There was potentially other activists swarming. And then there was also the Tylenol headlines, which didn't help. You know, you can't forget those. So it is really interesting that it gets, snapped up by Kimberly-Clark. There were a lot of rumors, though, swirling for a long time that this wouldn't be an independent company forever.
So how well does it fit into, in an era of deconstructing conglomerates, right? How does it play into the Kimberly-Clark story? Because they already have a ton of different brands that are very diverse. Tylenol and diapers. How do those two go together?
Sure. Well, when you go to the drugstore now, when you're picking up your Huggies and your Kleenex, you could also get, Neutrogena products and Tylenol. So it definitely is an expansion.
If you're a Democrat, right? Certainly not if you're an expectant mother that voted for Donald Trump.
But Kimberly-Clark had been looking to expand in the U.S., but it's aggressive. You mentioned the share drop in Kimberly-Clark. So this is definitely a new direction for them. This is an acquisitive move. Certainly, there were other names around Kenvue that we never confirmed, but this is one that didn't make sense for J&J. So you do see a deconsolidation and then consolidation.
The right move not to answer Matt, by the way, in that specific comment. But okay, even you just saying you go into CVS or whatever store you go to, and everything is now Kimberly-Clark. That immediately, to me, rings alarm bells of competition.
So that is a great question, but Kimberly-Clark doesn't make over-the-counter products. They don't have a competitor to Tylenol or Neutrogena. So it's added in your shopping basket. But let's say a company like Unilever would buy, or P&G would buy Kenvue, then maybe there would be some antitrust risk. Although certainly now antitrust risk is something we're wondering if it's even a concern in deal making, since there's such a M&A boom and decreased regulation.
All right, Liana, great to get you on the program. On this M&A Monday, Liana Baker runs the deals team for us on the BN side. Coming up in the next hour, JP Morgan's Sitara Sundar joins us, and she's going to tell us where she's putting money to work now. Plus, we're going to speak with the president of PIMCO, Christian Strack, about credit markets amid a, quote, emerging default cycle. And Link Logistics CEO Luke Petherbridge joins us on the health of the last mile supply chain. This is Bloomberg Open Interest.
As I reach a milestone in my life, I'm humbled by my good fortune, yet well aware that I still have much to learn. And if I stay true to myself and follow my instincts, my legacy will be looked on kindly by my friends, my family, and hopefully generations to come.
We are 30 minutes into the trading day and watching gains dissipate. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Danny Berger. It is the first trading day of November, but even so, it's off the back of 6 months of gains.
Yeah, and as you pointed out, breadth was not good, right? In terms of the S&P 500, we saw only 100 stocks gaining, about 400 stocks were losers, and as a result, we have this little bit of a turnaround here. We've got breaking data on the economy. We got S&P Global U.S. manufacturing PMIs out earlier. They were pretty much in line with what we expected. Now we're getting ISM manufacturing, and it is a little bit worse than had been anticipated. Bloomberg's international economics and policy correspondent Michael McKee here on set to help us break it down. Mike, what do you see?
Well, it's kind of mixed news. The headline 48.7 is down from 49.1 last month, and it doesn't match up with the expected rise in the Economist survey. But prices paid a little lower, 58 even, down from 61.9. New orders are up to 49.4, still contraction, but better than 48.9 last month. And employment, 46. That's a little bit better than 45.3 that we had in the month of September. But again, it does suggest contraction. And of course, any information we get on the labor market these days gets absorbed pretty quickly by the markets. Imports, 45.4, up from 44.7. We're obviously watching that to see if companies are trying to bring in more stuff. And I guess they're bringing in a little more stuff, but we don't know what the price situation is on that. We're not getting import prices these days. So overall, kind of a mixed report, but still not good for the overall manufacturing economy. There was hope we saw a little bit of a rebound in October, but according to the ISM, we didn't.
And maybe for that reason, you are seeing yields come in. Some of the higher push in yields is starting to drop, though we are still down on the day. Michael, how much more important is this data, just given the fog that we are in the words
purple haze, as Amanda Gotti said.
I don't think Chair Powell called it a purple haze.
No, that's Amanda Gotti of PNC says the purple haze of policy, which I love.
But Powell called it a fog, hence why I'm calling it a fog.
But it's fair, he wears a purple tie all the time. So, I mean... When you go back to what he said at his news conference, they have enough information to get a pretty good picture of where the economy is, and this will feed into that. And the important thing is, he noted that if there's a turning point, they'll be able to pick it up. And this is not turning point kind of changes. It just shows you that things are still kind of chugging along at about where they were before the government shut down.
Yeah, just like the two-year yield before we got this data, just right back where it was. Michael McKee, thanks so much for joining us. Let's talk now with Sitara Sundar, J.P. Morgan Private Bank Head of Alternative Investment Strategy. And Sitara, it's great to have you on as we, try and decipher what's going on with an economy that looks so strong, right? And these cockroaches that are scurrying around on the kitchen floor. What do you think about the state of credit as we see a blow up here, a blow up there, and prepare for more and more defaults?
Yeah, definitely. I think it's the number one question that we're thinking about outside of what's happening with deal making in private equity is what's going on within broader credit markets and what that means for private credit. Holistically, the way we think about it is segmenting it into two different risks. One are the select idiosyncratic defaults that we're seeing within the credit market now, emblematic of a systemic problem. And then two, what is our outlook for private credit moving forward in a period of time where defaults might be rising while base rates are falling? On the first part, holistically, we do believe that while private credit has grown meaningfully, the whole assets under management within that market has grown at about a 14.5% annualized rate over the past 10 years. That's meaningfully more than what we've seen in corporate borrowing holistically. But we do not believe that the growth that we've seen within private credit markets is detrimental to the economy and posing of a systemic risk. Actually, if you look at private credit AUM, it is still only 9% of all corporate borrowing. So we still feel comfortable with that. Two, what we do believe, though, is with any situation in which you see capital flooding into a market, what you will likely see is there are going to be pockets of idiosyncratic risk that will bubble up, and we wouldn't be surprised to see defaults increase a bit within the market. We're actually projecting about a 2.5% default rate within broad private credit over the next 10 years. But that just means that manager selection is extremely important.
But to be clear,
yes,
capital is flooding still flooding into private assets, including private credit.
And it is. Like, overall, holistically, we are still seeing growth in capital within private credit, but within and private equity. But the flip side of that is that warranted? And we believe yes, because the opportunity set in private markets is increasing as well. Even, I mean, we talk ad nauseum, we all do, about artificial intelligence. And when you think about the growth potential within artificial intelligence, increasingly we believe that private markets are going to play a very meaningful role in that evolution. Just think about the median tech IPO. The median tech IPO now is at about 14 years old, and the size of revenues that are associated with that is 220 million. If you look at that during the last big tech revolution, when you think about .com and to a certain extent cloud, the age of a tech IPO was 8 years old and sub 45 million in revenue. There's a meaningful amount of value creation. So we think the capital coming into the market is to find those deals.
But even so, you do have, I don't know if distortions is the right word, but just kind of weird phenomenon where, for example, all of these tech giants coming to the broadly syndicate market get snapped up so easily. Meta puts all of this debt out in the market absorbs it with no problem, even while its equity is selling off. Is there, maybe it's still the right time to be buying this, but is there a situation where just the amount of capital means the risk and current risks aren't completely reflected in what people are willing to pay?
Look, there is a lot of parts of the market that are priced to perfection, which is why we monitor a lot at what's happening in earnings season, whether or not guidance is actually being revised higher, which it has been. But then, two, I think the important point to remember as well is if there's demand for the capital and utilization of that capital, then it should be okay, because that means the returns will come. And dissimilarly, in the best parallel is like the fiber optic build out in the internet time frame. What you actually saw there was too much capital and an over build out. There was a 97% of the fiber optic cables that were built during that period of time were not utilized. We are still now in a compute-constrained economy. We are still in a compute-constrained economy.
But next year, or in 2 years, it could be vastly different, right?
It could be different, but we still believe that the demand is only going to grow because corporate adoption is still growing. Even just this year, corporates are about like 10% adoption rate versus, a quarter of that at the beginning of this year, and we think that's only going to accelerate moving forward. So we think that we'll be in a compute-constrained economy for multiple years.
Is there anything that worries you right now? I mean, it's a market that has rate cuts delivered and maybe more to come. You have corporate health of America is still really strong. Is there anything that can derail sort of the bullish sentiment that's swirling around markets right now?
Inflation is probably one of the areas where we're hyper-focused. The reason for that, we're actually expecting that over the next decade, inflation is likely going to land above the Fed's target, call it 2.5% U.S. CPI projection moving forward. That's meaningful in terms of what that means for portfolio construction, because as we all know, longer duration and core fixed income bonds don't always provide the best hedge against inflation risks. So for us, we believe very strongly that portfolios are going to need to evolve to hedge against that risk. And that means things like gold, that means infrastructure, that means real estate, and providing pockets of your portfolio that are actually going to be able to embed inflation-resilient income or a hedge against geopolitical risk. Those are probably the two big things that we're monitoring.
We have a viewer listening to details of the flood and wondering, where is all this capital coming from? And I mean, you could ask the same question about global liquidity, right? It seems like it's off the hook. If I look at money supply, it has turned and continues to rise now. So where is all this capital into private assets coming from?
There's a mix between institutional and retail, but if you think about the inflection higher that we're expecting to see in growth rates of capital moving forward, a lot of that is coming from the retail investor. And part of that is emblematic of this idea that we're seeing democratization of alternatives, which we think to be a good thing as long as it's done prudently and selectively, because all of a sudden, all of this growth that's happening within the private markets is now accessible to a broader group of people, which has meaningful ramifications for return potential and portfolios moving forward.
Sitara, thank you so much for joining us this morning. Always a pleasure to have you on. Sitara Sundar of JP Morgan Private Bank. A quick check on your markets this morning. We are heading higher, but increasingly losing some of those gains, only up 0.1%. The latest was that ISM data maybe coming out a little bit weaker. You are looking at yields on the 10-year still up by 2 basis points. The NASDAQ outperforms up 0.5%, Matt.
Let's get a look at some of the single stocks on the move this hour. Amazon's cloud unit has signed a $38 billion deal to supply OpenAI with computing power, providing access to hundreds of thousands of NVIDIA chips at AWS. So you can see both of those stocks are up.
And another AI deal, Microsoft inking a $9.7 billion one to buy cloud capacity from Australia's IREN. That gives it access to, you guessed it, more NVIDIA chips.
And Kimberly-Clark has agreed to buy Kenvue for roughly $40 billion, providing a lifeline to the struggling maker of Tylenol and Band-Aids.
Coming up, a conversation you don't want to miss. We will speak to PIMCO President Christian Strack. He joins the show as tech giants continue to fund their AI spend through debt. This is Bloomberg Open Interest.
Let's get now to high interest. Look what's making headlines around the world. Bank America CEO Brian Moynihan faces a tough crowd this week. The stock has trailed every major U.S. rival for 5 straight years, and he's hosting his first Investor Day in nearly 15 years to explain why responsible growth still works. The drag traces back to 2021 when the bank poured deposits into low-yield bonds just before rates spike. Moynihan argues the bank is catching up. Net interest income should rise up to 7% next year as those old investments mature. And Izzy Englander sold about 15% of his hedge fund Millennium Management to a mix of institutions, wealthy investors, and top executives in a deal that values the firm at $14 billion. The $2 billion stake marks a step towards succession for the 77-year-old founder who has a long way to sail. The move signals a new era for one of the world's biggest multi-strat hedge funds. And Alphabet is tapping the bond market for an additional $15 billion in debt in a deal that's split into as many as 8 tranches with maturities from 3 to 50 years. The proceeds will be used for general corporate purposes, including debt repayment, although it barely has that much on the books. The offering adds to a flurry of tech debt recently as firms race to fund massive AI investments. Of course, Meta last week issued $30 billion in bonds. Danny?
And some big funds are getting in on the action, including PIMCO. They took a pretty paper profit from the $27 billion debt package that it led for a Meta data center. I'm pleased to say PIMCO President Christian Strack joins us now. Christian, I mean, big tech has been raising a lot of money in these IG markets, $75 billion for AI data centers. How much does it change the contours of this debt market to have tech players who traditionally shied away to be participating in a very large way?
Yeah, well, thanks, Danny, and great to see you again. It changes it, but look, these are ultimately very strong investment-grade credits, and yes, they have a moment, and they have a moment which is where they do need to drive fixed investment. They need to build out the AI infrastructure for all of the growth that's coming, and to do so, they need to borrow. Now, in some cases, some of the opportunities are interesting, but not necessarily all that compelling. In others, where you are doing secured project finance lending backed by the data centers that are getting built out with a strong lease to the strong IG tenant, that, in our view, is a very compelling opportunity set. And we've seen some of those opportunities in recent months. We expect that there will be more to come.
And of course, you're perhaps referring to your Meta deal there, Christian. So you are looking for these high quality tenants in data centers and when you participate in these debt deals. But as you're getting inbounds for different deals, as you're sorting through different things, are there pockets where you say this is a deal we would never do and kind of raises concerns of froth?
Sure, yeah, no, there's definitely some of that. Anything that's built on spec, so data centers that are built on spec where there's not clear line of sight into who is going to be the tenant or how is the tenant going to use it, that is froth. And there will be money wasted in that space, and there will be stranded assets in that space. And so, in our view, much better to take a little bit lower return, but still very compelling returns relative to other secondary options in investment-grade credit, where you're close to the project, you're close to the asset, but you also have a very strong tenant coming into the opportunity. But yes, there are those deals out there that are much more spec-like, and there will be more of those to come, and there will be losses in a lot of this space.
Bloomberg put out a story today. Our data shows nearly 100 new zombie companies last month that haven't been able to cover their interest expense with revenue. Are you worried that this could be the start of a default cycle?
Look, the default cycle is already underway. I mean, we've been talking about that for the better part of this year. We've got defaults in bank loan space, so that would be below investment grade bank loans that are running around 4% over the last 12 months, and that will probably be the case over the course of this year. And some of the big examples of defaults that we've seen in recent months are part of that default cycle. So the default cycle is underway, and it will continue into next year. And still, companies are struggling, as you mentioned, with high interest costs. Yes, rates are coming down. The Fed is bringing rates down, but still they're a lot higher than they were when a lot of these deals got done. And at the same time, the growth is not there in a lot of these sectors that where people expected growth would be. Tariffs are part of that. The slowdown in labor force growth is part of that. Slowdown in housing and property is part of that. There are a lot of different reasons why the growth isn't there, but that combination of rates higher than you expected and growth lower than you expected is creating these zombie companies, and those defaults will continue. But it's going to be pretty manageable. A 4 or 5% default rate in bank loans is higher than you'd like to see, but manageable. And if we see something on that order again next year, again, higher than you'd like to see, there will be winners, there will be losers, but ultimately nothing that rises to the level of systemic or really challenging the dominant narrative out there in markets.
Christian, it hasn't hurt treasuries. We just showed the 10-year yield, at the beginning of the year at 4.80, and now we're down at 4 even. A couple of days last week, even below that level. Even though we've had these sweeping tariffs from the Trump administration, tax cuts for the wealthy, budget deficits that are, continuing to grow and grow and grow, as well as attacks on the Federal Reserve independence. You would have thought that created a sell America trade, and yet it hasn't happened. Is it still to come?
Well, I think what we're seeing is that inflation is problematic this year. Certainly, there is a tariff pass-through into inflation. But over time, we have strong line of sight to inflation coming down, maybe not to the Fed's target of 2% by the end of next year, but getting closer to it by the end of next year. And so that will allow the Fed to continue to cut rates, and that allows the longer end of the curve, the 10-year part of the curve, to continue to come down like we've seen this year. And what we've also seen is that a lot of the world is underinvested in fixed income, overinvested in equities, as equities have done extremely well. And so a lot of the world is looking at rates around 4% in the U.S. That offers really high-quality return, high-quality income. And then it's not just about treasuries, of course. It's all of the high-quality fixed income opportunities that you see in fixed income, whether that's securitized credit, whether that's agency mortgages, whether that's some investment-grade corporate credit as well. There's a lot of opportunity out there. And a world underinvested in income, a world underinvested in fixed income is adding at these levels. Yes, inflation remains a concern, and that is something that we're very focused on, and one cannot be complacent about it. But it is our fairly strong view that over the course of next year, you start to see inflation continuing to come down, helping the Fed to cut rates over the course of next year.
So, Christian, just listening to you, is it fair that all this hype about a debasement trade, that's the reason everyone's flocking to gold and Bitcoin, that narrative was just wrong?
Well, gold and Bitcoin are much, much, much smaller than the stock of fixed income out there. And so, it doesn't take much buying to drive gold and Bitcoin to higher levels. I think what's much more relevant is the fact that there are very strong flows into fixed income, given that there are very interesting opportunities in high-quality fixed income. And, there were fears around, as what you said, debasement, fears around sovereign credit, and certainly deficits are high, deficits are problematic. But we've seen is that there should be some stabilization in the deficit at a high level over the course of this year and into next year. Not a great place to be, but certainly better than one might have feared earlier this year.
Christian, just talking about the flows into fixed income, this is something Matt and I have discussed a lot, that you can get these huge bond offerings from the tech giants and IG markets barely change, that you can have days where there's broader concern in equity markets, but spreads are unmoved. In private credit, you have this whole new swath of wealth investors coming in too. The sheer amount of capital coming in to credit markets, does that mean that there are some pockets where fundamentals and risks aren't exactly reflected?
Yeah, I mean, it's certainly the case that there is a lot of complacency in credit markets, and there has been for the last couple of years. What you see is that people who are underinvested in fixed income are, in some ways, in some cases, being relatively indiscriminate in coming into credit markets. You see that particularly in the passive space. In passive credit investing, the more somebody borrows, the more you lend to them. That is the definition of passive in credit, and there is a fair amount of that. Then you also see it in below investment grade, where there's been a demand for higher yields, higher returns, and there we're starting to see those defaults come in, and that's shaking up some of that complacency. So yes, this has definitely been a theme over the course of this year, as we've seen this emerging default wave that was likely to continue into next year. That said, if you step back, the broad universe in corporate credit, IG, is in pretty good condition.
Christian, great to get some time with you. Really appreciate it. PIMCO President Christian Strack talking to us from London. This is Bloomberg.
Let's get a check on these equity markets. S&P 500 futures turning negative this morning after a positive October, the sixth consecutive month where we have seen that. It is narrow breath. It was always narrow breath to start this market, but it's really taking its impact now. NASDAQ 100 stocks are up by 0.33%. Coming up, we take a look at how the easing tensions between U.S. and China are impacting industrial real estate. The U.S. and China, after last week's meetings between President Trump and Xi, seemingly, at least for now, hitting the pause button on escalating trade tensions. Both countries agreeing to halt certain tariffs, including Trump's plan of an 100% tariff on Chinese exports to the U.S. and a downgrade when it came to fentanyl tariff. For a look at how that's impacting businesses ahead of the crucial holiday season, we welcome Luke Petherbridge, CEO of Link Logistics. Link owns warehouses across the U.S. with over 8,000 customers across all facets of the economy. And what was the stat of how much of U.S. GDP your warehouses are equivalent to?
About 4 to 5% of U.S. GDP, our 8,000 customers operate. So it's pretty incredible.
It's an insane amount, and it's such a good look into this economy. So we're about to head into the season where everybody's buying holiday gifts and deciding what to shop for. How do inventories look, and what is the sentiment among retailers that you work with?
Yeah, I mean, it's a really interesting time. We're just talking about the economy. What we're seeing is general resilience. And when you think of supply chain, our customers, and we're with our largest customers, they think a very long term. So they're seeing robust inventory levels. They're actually prepared well. And I think what we've actually seen is we've actually leased more space this year than we did last year. And you think about what the economy we've been dealing with and some of the tariff noise, they're looking right through that at the moment.
That tariff noise, I would imagine, creates volatility for a business like yours, because if I hear that I'm going to get a 100% tariff on the place where I import all my goods next month, I'm going to import as much as I can right now, right? And then after next month, none. So do you see that as well?
Matt, sounds like you're a supply chain person. That's exactly what they've been doing. I think it's a really good point. I think uncertainty is the issue. Like, if you think about it, we've had tariffs before. We had tariffs a decade ago. We've been having tariffs. The change in tariffs, I think, is the issue. What we're seeing is tariffs are settling. We saw that again over the weekend. That obviously provides greater certainty, and our customers react that way. So, yes, it's been a little lumpy this year, but when you think of supply chain, you really are sort of building out your supply chain for not just 1 year, 2 years, 3 years, it's 5, 10 years. The other thing that's happening is e-commerce continues to be a bellwether for the country and for our business, and we continue to see that growing with the traditional e-commerce providers. But then also retailers continuing to grow their e-commerce presence. And then finally, I would say speed is what's happening. I mean, I have teenage kids. They're not waiting a week for things to be delivered. It's 24 hours or less. What that means is you need to be closer to the customer, have more inventory to deliver and fulfill the promises to your customers.
There was this whole narrative that after COVID, Amazon spent too much on last mile logistics, that they had to pull back in that spending. But just hearing what you're saying, it seems like you can't really have spent too much, that the demand is really there. Where do we stand in the build out of last mile logistics and aiding some of the digital retail trends that you're talking about?
Do you know, I think it's a really good point, Danny. The first phase was really Amazon taking share. Now it's all the other retailers catching up. I mean, you look at Walmart and the growth of their e-commerce business, double-digit. Amazon last week, double-digit e-commerce growth, which is really incredible for a business that size. I think the second wave of e-commerce now is speed. What used to be totally adequate to deliver in 5 days, you now need to deliver in 24 hours. So what that does to your network, you need more warehouses closer to consumers.
And more tired drivers? I just feel bad for the people behind that are having to put out stuff in a day after being ordered.
And so then what happens is, because you've got such a large network, you're able to actually use whether your store or the facility to be able to do that. But that is now the expectation of the customer. The customer is always right, and businesses are working around that.
Well, and you're going to have in your warehouses, in a lot of cases, I imagine, robots or automated systems. You've got a lot of warehouse space that needs to be climate controlled, lights, water, etc. Probably not the same power needs as an AI data center, but you're getting there in a lot of places, right? How do you deal with that?
Yeah, do you know, power is a huge topic. We just had as I mentioned, our largest customers together. That is now one of the biggest concerns they have, is accessing power. We really have built out a fulsome solution for our customers. We're a very large landlord. We try to access the grid for them. But it is becoming a challenge.
You're a gigantic landlord. 500 million square feet of space, right? 3,500.
It's 3,500 buildings, 8,000 customers. There's a lot, but our customers, whether you're a big landlord or a small one, you are still dealing with the same challenges. The one thing you talked on, data centres, another area that we're seeing real growth is this reindustrialisation of the country. You're seeing manufacturing. We've seen, over 200 announcements in the last 5 years, $500 billion of factories and starts. That provides another buoy towards our business. But again, there's an increasing need while there's diminishing new supply. We're not building enough warehouses going forward.
The thing that seems incredibly complicated to me, you're talking about how your customers are planning 7 to 10 years ahead. But that one will be a different administration, so who knows what the policy mix will be like? Who knows what immigration will look like then, too? How difficult is it even to plan for the long term right now?
Yeah, it's really hard. But when you think of these very large corporations or big 3PLs, they have a really long-term strategy to provide network support and supply chain logistics for a country that's going to grow, consumption's going to grow, but they need to think through that. So there is a lot of near-term noise. We don't discount that. That is important. We try to work with our customers, provide them flexibility, the benefit, Matt, of having 500 million feet. We can help expand and contract customers when needed. But customers are thinking, if you think of the largest retailers or manufacturers, they think very, very long-term to get component parts into the country and into the widgets or the supply chain that they're running.
Well, and regardless of the policy changes, you can't go wrong with supply chain localization, right? I mean, no one's going to raise tariffs on ourselves. Well, I don't think they're going to do that. So how big a part of that is your business as well?
Like, you mean the localization?
Yes.
I'd say we really have tried to skew towards last mile. We think that is a growing area. We think being close to rooftops, close to workers. Remember, we talked about automating the facilities. Most of our facilities have millions of people turning up across our entire portfolio every day, being close to the workforce. And again, as we talked about, speed is now the final frontier.
Be close to the customer.
Yeah, and speed is the final frontier. You are trying to chase speed. I mean, Amazon has set a pace, Walmart is chasing it, and then others are following through. So, and it's not just to the end customer, it's also supply chain inside any sort of manufacturing network, having component parts there when you need them immediately to keep the supply chain moving. We continue to see that chase for speed as one of the key components for all our customers, and we continue to try to own real estate in the path of that growth.
Hey, Luke, just quickly before you go, I'd be remiss if I didn't ask about Core Giving, the charity that you co-founded and are chairman of, about food insecurity. Because it's part of the conversation right now with the government shutdown and the SNAP benefits running out, how big of an issue is food insecurity in this country right now, especially with the government shutdown?
Well, thank you for asking about that. It's something that's very close to my heart and the heart of all our firm. The stat from Feeding America, 1 in 5 children don't know where their next meal's coming from. And that's a shocking statistic for this country. It's something that we in Core Giving and all our portfolio companies work on. 2 weeks ago, we had called Giving Day, where 3,500 colleagues across 20 different portcos around the world gave back. But it is a real issue. And I would say even before what's happening right now with the snap, it's still an issue, and it's something that we need to solve. And it's in every single community that's around the country, and we're trying to do that and help that wherever we can.
All right. Great to have you on the program. I think an absolutely fascinating business. So fun to hear from Luke Petherbridge. He's the CEO of Link Logistics. Now let's get a check on what's going on in markets right now. We saw big gains at the top of the session, and now we're looking at red arrows here. The S&P down about 0.2%, with the NASDAQ going 0.2 the other direction. The 10-year yield right now at 4.1046, so still fairly low, but at a 3-week high.
And then meanwhile, some of the single stocks that are moving in this hour, we're still keeping an eye on NVIDIA shares. Loop Capital says the chip maker can hit $8.5 trillion in market cap, a huge amount. Reminder, it's at 5 now. Loop raised its price target on NVIDIA to a street high of $350. That's up from $250.
I'll say 400.
Sorry?
I'll say $400.
Okay, I keep
What do you say, Danny?
You know what? To the moon, 1,000. I don't know.
Okay. Palantir is expected to see revenue growth of about 50% when it reports after the bell today. This, according to Bloomberg estimates. But concerns about Palantir's valuation remain. It hasn't stopped the stock's run thus far.
Meanwhile, Pfizer has sued Metsera and Novo Nordisk in an effort to block Novo's bid for the obesity startup. They say Metsera breached their earlier merger agreement.
Coming up, we are live in Sao Paulo ahead of the COP30 Climate Summit. UN Assistant Secretary General Marcos Nito joins us next. This is Bloomberg Open Interest.
In the run-up to COP30 in Brazil, business and financial leaders are gathering in Sao Paulo to discuss navigating climate risk and investing in innovation at a time when flattening the emissions curve is getting more and more critical, and former climate leaders like the U.S. are retreating. Vonnie Quinn now joined by the Assistant Secretary General of the United Nations Development Program. Vonnie.
Danny, thank you so much. Mr. Marcos Neto, welcome and thank you for joining. One of the main points of business is to update the NDCs. It's been 5 years since the last one. What will be new about these new nationally determined contributions, which are so important for countries?
Good afternoon. It's a pleasure to be with you. This is fundamental, as you said. I think in Belém we're going to have a third generation of national determined contribution, the NDCs, and those NDCs are much better. They are more ambitious. They are 100% have energy transition in them. 87% of them is dealing with adaptation. And more important, as we're having a conversation about private finance and private capital, the NDCs now, most of them have a budget for the first time. They have the beginning of financial plan, and they will be able to be used to break down supply chains and find the pipeline country by country that which the domestic and international private sector can start to mobilize.
Because there was concern that only a third of countries had actually submitted them in time for the UN report. The EU hasn't even got around to submitting. It's expected to tomorrow.
Indeed. But what happened was there was the Secretary General of the UN called a meeting, a climate summit in September in New York. And for example, in there, 121 governments have actually presented the NDC targets. So we know that the actual official submission to the UNFCCC, only 67 have gone in, but we know there's 121 that have their targets done. So I think we are going to, my colleagues at the convention are going to be able to issue an annex synthesis report later after the COP. But we know that we as UNDP have actually supported 102 countries in getting the NDCs better, more ambitious, more inclusive, something that is the whole of economy and deals with poverty as well.
Exactly. How significant is the US retreat from the climate goal globally? Will it be hanging over COP30 this year? And for example, just in terms of trying to flatten the emissions curve or reduce the green premium, will it have an impact?
Look, the United States is a very powerful country. Of course it has its impact. But I think this is not the first time around that the US left the Paris Agreement. I think the world has learned how to move forward the agenda without the US. It is the US's choice. It is regrettable, but at the end of the day, every country makes their choice. The important point is the rest of the world is going to come to Berlin, are doing the indices, and the agenda goes forward.
Speaking of the rest of the world, China is coming, a vice premier is coming, and China did submit an NDC, maybe a modest one, but all the same. How much do you expect China to step up to the plate and maybe take on the climate battle, become one of the leaders in place of the US?
Oh, I think China is already a leader. I think no country in the world domestically does more on the energy transition than China. Production of EVs, right? The production of solar panels, winds. So China is really at the forefront in that transition domestically. I think the Chinese NDC is an indication that he's ready to, hopefully, together with the European Union, to lead the world in the next few years on managing the climate crisis.
You were, in fact, born in Belém, the gateway to the Amazon, so you've seen the crushing cycle of poverty and deforestation that happens in communities like Belém, and the need for global growth to decouple maybe from taking down the emissions curve. Now, Bill Gates has written a letter on this saying that if there's a certain amount of money, perhaps some of it should be diverted now, that we shouldn't be talking about just climate, we need to be talking about human welfare. What are your thoughts, given that you come from Belém, where more than half of the population lives in favelas?
Well, I am a son of Belém. I'm going home. But more important, I've spent a career of 30 years in development. I think it is a false dichotomy to now say that, you have to invest in health, not in climate. We are investing in climate and health, right? Climate change is an accelerator of development challenges. The important point for us is to actually look at how a dollar can take, for example, we know that implementing the indices can take 175 million people out of poverty, just by implementing the indices. We know we can add the economy of Sweden, right, to the global GDP if we implement the indices. So I don't understand this notion that, the money needs to go in one place and the other. The money needs to go to the convergence between climate and development.
Briefly, NASA has confirmed that last year was the hottest on record. And if all of the countries that have pledged these NDCs keep to them, that still only reduces emissions by 4%. We're not anywhere near the Paris climate goals. It would take another 28% of a drop to get to where we wanted to be for 2030. How concerned are you about extreme weather?
It is, extreme weather is going to fundamentally affect every community, from the rich to the poorest, across the world, right? Floods in New York this week before I flew over down here. So we have to invest on the adaptation side. Even if we come down to 28%, we've already put enough CO2 equivalent in the air that we're going to have to invest on adaptation for a century or more. And I think that's part of the Brazilian presidency of the COP, is the focus on adaptation. And we as UNDP are very much behind that.
So many conversations to be had over the next 2.5 weeks. Mr. Neto, thank you so much for joining Bloomberg TV. Danny and Matt.
Bonnie, thank you very much for that excellent conversation. Bloomberg's Vonnie Quinn reporting live from COP30 in Brazil. Coming up, Visa releases its 2025 holiday spending outlook. We speak to Wayne Best, the company's chief economist, on it. That's coming up next. You're watching Bloomberg TV.
Visa releasing the results of its 2025 holiday spending outlook. It found that while holiday shopping is expected to grow, there are major differences in spending by generation. Gen Z, millennials, and Gen X are expecting modest growth, but the baby boomers expect to spend 21% more on gifts, which is probably good news for the rest of us. Joining us now is Wayne Best, Visa chief economist. And Wayne, I've heard insane estimates of how much wealth the baby boomers have. I think $75 trillion is one that Sally Krawcheck told us, but I've heard even bigger numbers. So I guess they're just planning on giving away more of that in terms of gifts this holiday season.
Well, they have more kids to give to, grandkids specifically. I certainly fall into that category. So they're going to be sharing a little bit more of those holiday spending associated with that. They're obviously aware of the prices that we're seeing and the inflation that has taken into effect. But this is that stage of life when we see boomers and, largest generation to come along until the millennial generation. Yes, they have that wealth and they're going to spend it.
I hope your grandkids are listening, and if they are, they're probably very excited about what's to come for Christmas, Wayne. When it comes to younger generations, though, we've heard some of corporate America start to express concerns. Chipotle and Shake Shack stand out as two, saying our results weren't as good because people under the age of 30 just aren't spending as much. Are you also seeing that trend that younger people, especially with a higher jobless rate, are pulling back on spending?
I think that there is some moderation that's definitely going on. The good news, if they're working and if they have a house, they're certainly doing very well in terms of their picture. And also, we have to look at the level of indebtedness of consumers. And when you look at that as a share of income, it's actually also pretty positive. It's lower than where we were pre-COVID. So there is the might behind it. It's just that consumers have to have the confidence that moving forward, they're likely to remain employed and be able to spend in that regard.
We have, a kind of a bullish outlook in terms of holiday spending. I think you expect a 4.6% year-over-year rise. At the same time, I got a note from Torsten Slok of Apollo today saying that 25% of Americans are subprime. And we've been talking about for weeks now the fact that 42 million Americans are on food stamps. How do you sort of juxtapose those two sides of the coin?
Sure. So I think I'll start first with the holiday sales number. You asked 4.6% versus 4.3% last year. And it's important always when you talk about holiday sales to understand what the definition is. We're looking at November and December retail sales less autos, gas, and restaurants. That's specifically, and it's a non-seasonally adjusted number. So that's a common metric that's used there. But if we break that down into the real spending, taking out the inflationary component, the growth is much slower. Obviously, 2.2% is what we're expecting. That's down from 2.5% last year. So we have adjusted some of our forecast given the challenges that remain with regards to subprime audiences as well as the government shutdown. That'll be an important factor as we lead into the season.
Wayne, when you look at the upper echelon of consumers, the people that we've seen reflected, for example, in the airline earnings and travel, how price sensitive are they at the moment? Across the board, are consumers still willing to pay more, or are you seeing softness there?
I think what you see is that obviously the wealthy are going to be looking for a bargain also. And let's remember, for all consumers, we've got more tools available to us now than we ever have before. Not only consumers, but also small businesses. If something's going up in price, I can price shop it now, sort by price, and I can find something online that's much better. And at a cheaper price. So I think the sensitivity is absolutely there, even for the wealthy. And that's going to play importantly, especially as we continue to look into the holiday season. Consumers, again, are expected to spend, about 10% more on gifts overall, but the boomers are going to see about 21% lift. So again, a lot more spending that can occur in this holiday season.
Wayne, great to get some time with you. Hope we have you back soon. Wayne Best there, who is the chief economist over at Visa. As we come to the end of the hour, let's get a check on what's going on in markets. We started out with some gains and now are a little changed on the S&P 500. We've been fluctuating back and forth, but the NASDAQ continues to remain strong.
Maybe some of the weaker ISMs taking a chunk out of the gains for the S&P, and maybe it's that we don't have tech earnings this week to lift us up, but we have plenty of AI deals that seems to be making this market happy.
Yeah, coming up tomorrow, Kristen Bitterly of Citi joins us, as well as a big bull, John Stoltzfus of Oppenheimer. In fact, he's the biggest bull on Wall Street. Plus, Galaxy Digital co-founder David Namdar joins us to talk crypto after the fall of Bitcoin. Still pretty high, though. This is Bloomberg Open Interest.
गाइस 5:30 हो चुका है लंदन सेशन के बाद न्यूयॉर्क सेशन इज ओपन नाउ ठीक है बाकी नेचुरल गैस एज एक्सपेक्टेड रेंज बाउंड ही हो रखा है बहुत छोटी सी रेंज है मैं पहले ही बता चुका हूँ दिस इज़ अ रेंज आई एम एक्सपेक्टिंग जब तक अब इस रेंज के बाहर निकलता नहीं ओरिजिनल सपोर्ट रेजिस्टेंस पे आएगा नहीं तो इसी रेंज को प्ले आउट कर सकते हैं एंड इसमें भी ज़्यादा रिस्क लेने की ज़रूरत नहीं है कम रिस्क में ही ट्रेड करो इस रेंज के अंदर प्लान कर रहे हैं तो क्रूड ऑयल ऊपर आता है वापस सेल कर सकते हैं थोड़ा वॉल्यूम डाउन हो गया है बट एक्सपेक्ट करो वॉल्यूम आना चाहिए नाउ फाइव थर्टी की कैंडल है थोड़ी सी वॉलेटाइल हो सकती है लंदन सेशन ओपन हुआ है जस्ट अभी बाकी कोई और न्यूज़ तो आ नहीं रही है न्यूज़ आती है तो फिर देखते हैं मार्केट को कुछ इम्पैक्ट करेगी बाकी कोई क्वेश्चन होगा तो कमेंट बॉक्स में पूछ लेना Wall Street CEOs flag high market valuation, pullback risk. Expected ही है almost. If AI bubble is there, big fall is possible in upcoming time if there. India pushes government clean energy agencies to sign purchase agreement for standard power projects. तक जैसा हो गया ना मार्केट मूव ही नहीं कर रहा है
I'm here at OFI in the Netherlands, sampling different brownies with different levels of cocoa powder in. My favourite is the one with 20% less cocoa. Cocoa prices have been for a wild ride recently. After spending years around $2,000 a metric ton, prices shot up to $12,000 last year.
To cope, chocolate makers have adapted in two main ways. 1. Shrinkflation, where the bars get smaller for the same price. 2. Companies mix up the recipe.
These white chocolate cookies aren't actually chocolate at all. They're covered in imitation chocolate, which is a mix of sugar and vegetable fat.
And that brownie I tried earlier? The cocoa powder in it had gone through a process called Dutching. This is where the cocoa is treated with an alkalizing agent which slightly changes the flavour and enables manufacturers to use less of it. I also did a blind taste test of 2 chocolate ice creams, one with Dutch cocoa, but less of it, and one with regular cocoa. I could barely taste the difference. The first packed more of an upfront cocoa hit, while the second had a richer, longer finish.
With climate change, aging trees and disease causing problems for the cocoa industry, prices aren't likely to make a full recovery anytime soon. The chocolate sector is now thinking about how to protect itself from future volatility.
Some companies are even going completely chocolate-free. There's lab-grown chocolate, barley, rice and carob-based chocolate, and even sunflower seed chocolate. That last type is already cheaper than the real stuff because the main ingredient is so widely available. The reviews, however, are mixed. While chocolate pioneers like OFI and Planet A Foods deserve credit for their ingenuity, there's also cocoa farmers to think about. If the big brands embrace chocolate alternatives, then how do growers make money?
These high-end fine chocolates aren't going anywhere. But your bog standard supermarket candy bar might be in for some changes. For me, it's a sad world when chocolate starts disappearing from the shelves. What do you think? Let us know in the comments.
ये इस नेचुरल गैस रेजिस्टेंस पे आ गया, नेचुरल गैस सॉरी क्रूड ऑयल रेजिस्टेंस एरिया पे आ गया, इसमें एक सेलिंग का देखते हैं यहाँ पर, ठीक है। नेचुरल गैस भी आता है नीचे को, तो वी विल सी दैट। लेकिन नेचुरल गैस भी देखोगे स्टक है बिल्कुल वहीं का वहीं रुका हुआ है, मोमेंटम ही नहीं आ रहा इसमें। ऐसा क्यों लग रहा है प्राइस सडनली स्टक हो गया, पता नहीं किसी न्यूज़ का वेट है या फिर क्या हो रहा है। 5:30 हो गया है, कोई डेटा भी नहीं आने वाला आज तो।
What's driving the markets this week? What's on investors' minds as they look ahead? Find out in 10 minutes or less on the Markets Podcast from Goldman Sachs. Listen now.
News when you want it with Bloomberg News Now. I'm Nathan Hager.
And I'm Karen Moscow.
Karen, we begin with breaking news from Punchbowl News and CNN reporting that former Vice President Dick Cheney has died. Punchbowl is citing a statement from his family saying the 46th Vice President of the United States died last night surrounded by his family. They say the former vice president died from complications from pneumonia as well as cardiac and vascular disease. Again, reports from Punchbowl News and CNN. Former Vice President Dick Cheney dead this morning at the age of 84.
Polls in New York City will be open soon. The race for mayor has taken on a national spotlight. We get the very latest with Bloomberg's Lisa Mateo in Manhattan. Lisa, good morning.
Now one of the candidates getting this last-minute endorsement from President Donald Trump. So in a social media post, the president said, quote, whether you personally like Andrew Cuomo or not, you really have no choice. You must vote for him and hope he does a fantastic job. He is capable of it. Mamdani is not. Now, President Trump also called Democratic Socialist frontrunner Zohran Mamdani a communist, also threatened to withhold some federal funds from the city if Mamdani is elected. Now, the Post, well, it didn't seem to bother Mamdani as he campaigned across the city yesterday.
The MAGA movement's embrace of Andrew Cuomo is reflective of Donald Trump's understanding that this would be the best mayor for him.
Both Cuomo and Mamdani have promised to defend the city from President Trump. Cuomo made that evident when he was talking to voters yesterday.
I can stand up to Trump. Trump will go through Mamdani like a hot knife through butter.
Well, meanwhile, Republican candidate Curtis Sliwa still on the ballot despite calls to drop out of the race. President Trump saying a vote for Sliwa is a vote for Mamdani. Elon Musk actually agreed with a post on X saying, quote, a vote for Curtis is really a vote for Mamdani or whatever his name is because he spelled his name wrong in the post. And he ended by saying, vote Cuomo. Lisa Mateo, Bloomberg Radio.
All right, Lisa, thank you. Well, staying in the tri-state area, there's a key gubernatorial race in New Jersey with Republican politician and businessman Jack Ciattarelli facing off against Democrat Congresswoman Mikey Sherrill for the seat that's held by term-limited Governor Phil Murphy. For more on the race, we go to Bloomberg's Denise Pellegrini.
The stakes are high in New Jersey, where the governor's race is seen by many as a test for just how much ground Republicans can gain in a once very heavily Democratic state. Sherrill has been slamming Ciattarelli's support for President Trump.
On every single occasion, Jack has decided I'm going to defend Trump.
Ciattarelli has heavy praise for the president.
We're very thankful for all that he's done to secure the border and enhance national security. We're very thankful for all that he's done to improve the economy.
President Trump in New Jersey campaigning for Ciattarelli.
Mikey will send New Jersey into a death spiral.
And former President Barack Obama has been campaigning for Sherrill.
We need leaders like Mikey, public servants who are in it for the right reason.
And this race has tightened appreciably in the past few weeks as voters express dismay over rising electric bills and the overall cost of living. Denise Pellegrini, Bloomberg Radio.
All right, Denise, thank you. We're also tracking one more governor's race in Virginia. Democrat Abigail Spanberger and Republican Winsome Earl Sears are vying to become the Commonwealth's first woman governor. Earl Sears would be the first black woman to lead any state if she wins. But University of Virginia Center for Politics Director Larry Sabato says the odds are in Spanberger's favor.
You have to search hard in Virginia, the state in which I live, to find any analyst who thinks Earl Sears has any real chance of winning. Most people will bet that it's going to be a Spanberger landslide.
That's Larry Sabato with the UVA Center for Politics. Spanberger has been running as a center-left candidate focused on living costs and the impact of President Trump's tax cut law on health care. Earl Sears has given high marks to the president, but he has not actively campaigned for her.
Well, Nathan, the other major race to watch is in California, where voters are deciding on Proposition 50. It's a ballot question that would take the state's independently drawn congressional map and replace it with one from the Democratic-controlled legislature. Democratic Governor Gavin Newsom is spearheading the effort.
Prop 50 is not about drawing lines on a map. It is about holding the line to what makes us who we are.
California Governor Gavin Newsom's push could erase up to 5 Republican-held districts and offset redistricting efforts in Texas and other Republican-led states. More than $100 million have been spent on TV and cable ads in the Prop 50 campaign. More than two-thirds of it came from supporters.
Karen, this election day is also day 35 of the federal government shutdown. It is now tied for the longest funding lapse in U.S. history. And now, after suspending federal food assistance at the start of this month, the Trump administration says it will comply with a judge's order to resume the benefits, but only at half the level that households normally receive. Senate Minority Leader Chuck Schumer says that doesn't go far enough.
Everyone can get full benefits. The only person standing in the way is Donald Trump.
Senate Minority Leader Chuck Schumer says the administration could draw from tariff proceeds to pay for SNAP. Agriculture Secretary Brooke Rollins says that could lead to a shortfall in other programs like school meals for low-income students.
Let's turn to the markets now, Nathan, where stocks are selling off on this Tuesday morning. Wall Street chief executives say investors should brace for an equity pullback and that such a correction may be a positive development. Goldman Sachs CEO David Solomon spoke at the 2025 Global Financial Leaders Investment Summit in Hong Kong.
Of course, it is likely there'll be, a 10 to 20% drawdown in equity markets sometime in the next 12 to 24 months. And I'd say there are very few people in this room that don't think that that's a meaningful possibility. It doesn't mean that the general direction of capital flows, investment, portfolio allocations changing. It just means things run and then they pull back so people can reassess.
And Goldman Sachs CEO David Solomon's sentiments of a possible stock pullback were echoed by Morgan Stanley CEO Ted Pick and Mike Gitlin, who helps oversee about $3 trillion at Capital Group. The S&P 500 index is trading at 23 times forward earnings estimates. That's above its 5-year average of 20 times. Time now for the Bloomberg Sports Update, and we bring in John Stashower. John.
Thanks, Karen. Monday Night Football was in Dallas. Arizona ended a 5-game losing streak, beat the Cowboys 27-17. The NFL trade deadline comes today. Washington quarterback Jayden Daniels has another injury. He's already missed time with injuries to his knee and hamstring, and now he's got a dislocated left elbow. Walt Weiss named the new manager of the Atlanta Braves. He finished his playing career playing for the Braves. He's been the bench coach under Brian Stitker. He formerly was the manager in Colorado. That's your Bloomberg Sports Update.
Thanks, John. And that's news when you want it with Bloomberg News Now. I'm Karen Moscow.
I'm Nathan Hager, and this is Bloomberg.
Exchanges, the Goldman Sachs podcast featuring exchanges on navigating macro uncertainty, exchanges on the forces shaping global markets. For the sharpest analysis on finance, business, and the economy, count on exchanges between leading minds at Goldman Sachs. New episodes every week. Listen now.
Bloomberg Daybreak is your best way to get informed first thing in the morning, right in your podcast feed. Hi, I'm Karen Moscow.
And I'm Nathan Hager. Each morning, we're up early putting together the latest episode of Bloomberg Daybreak U.S. Edition. It's your daily 15-minute podcast on the latest in global news, politics, and international relations.
Listen to the Bloomberg Daybreak U.S. Edition podcast each morning for the stories that matter with the context you need.
Find us on Apple, Spotify, or anywhere you listen.
R7 क्रूड ऑयल अप डाउन प्लीज गाइड लगा रखा है सर. ऐसा कुछ अप डाउन नहीं है. लेवल है वहां पर, एक सेलिंग प्लान है, एक सपोर्ट था कल का, वो ब्रेक हो चुका है मॉर्निंग पे, तो उसका एक रीटेस्ट एक्सपेक्टेड है. यहाँ से नीचे आएगा तो वापस बाइंग का प्लान करेंगे फिर. बाकी नेचुरल गैस तो रेंज बाउंड है, साइडवेज कह सकते हो. मेजर सपोर्ट लेवल कल का ही है और उसके ऊपर एक लेवल और है 400 वाला. नीचे सपोर्ट पर कल एग्जैक्टली आया नहीं, दैट इज़ द सपोर्ट एरिया. फिलहाल ये छोटी सी रेंज है, इस रेंज के अंदर या तो अवॉइड करो या फिर अगर प्ले आउट कर रहे हो, बाई सेल कुछ कर रहे हो तो कम ही क्वांटिटी छोटे एसएल के साथ करना, बड़ी क्वांटिटी मत करना. ये कोई सपोर्ट रेजिस्टेंस के लेवल नहीं लगा रखे हैं, दीज आर जस्ट अ पॉइंट ऑफ इंटरेस्ट लेवल. तो ये इजीली ब्रेक हो सकता है. कल से देखोगे ना एक रेंज के अंदर फंसा हुआ है प्राइस, तो ट्राई कर सकता है रेंज को ब्रेक करने का. तो लेवल जहाँ पर एरो लगा हुआ है, दोज आर द ओनली लेवल्स वी हैव. वॉल्यूम ही नहीं आ रहा उसमें। क्रूड ऑयल बिल्कुल ऐसा हो गया, स्टक जैसा रुक गया वहीं पर। अब तो सीधा 7 PM पे यूएस मार्केट ही ओपन होगा, लेट्स होप उसके बाद मूव करें एटलीस्ट क्रूड ऑयल। अभी तो 5960 के अराउंड ना। स्टिल नेचुरल गैस रेंज के अंदर, अभी भी रेंज के अंदर ही है नेचुरल गैस। यहाँ से थोड़ा सा सेलिंग एक्सपेक्टेड है क्रूड ऑयल में, ध्यान रखना। ये सपोर्ट था, ब्रेकडाउन हो गया, तो रिटेस्ट यहाँ पर एक होना चाहिए। मॉर्निंग पे कल वाला सपोर्ट ब्रेक हो गया था यहाँ पर, मैंने मॉर्निंग पे बता दिया है। अब सीधा आधा घंटा और है, यूएस मार्केट ही ओपन हो जाएगा, तो फिर देखते हैं। भी करते रहो गाइस, जिन लोगों ने नहीं किया है लाइक कर दो सभी लोग। 100 लाइक्स का टारगेट रखते हैं। कल वाले में था ना, फॉरेक्स चार्ट में है। नेचुरल गैस को देखोगे बस ऊपर नीचे ही हो रहा है मोमेंटम, बहुत ज़्यादा वॉलेटाइल इन अ स्मॉल रेंज इवन दो। तो इसका मतलब वो नीचे वाले लेवल पे था ना। Hey guys, 13 मिनट लेफ्ट यूएस मार्केट ओपनिंग से पहले। थोड़ा क्वांटिटी का ध्यान रखना, 13 मिनट ही रह गए हैं सिर्फ। गाइस यूएस मार्केट ओपन हो गया है ऑलरेडी। लेट्स सी कुछ मूव और करता है तो ये नेचुरल गैस के ट्रेड का ध्यान रखना अगर अभी भी रुके हुए हो तो। इसमें रेंज बाउंड मार्केट है, सपोर्ट रेजिस्टेंस दूर हैं। ये सिर्फ एक रेंज का ट्रेड लगाया हुआ था। प्राइस कल ही आया था रेंज पे, अच्छा खासा सेल ऑफ देखने के लिए मिला। एग्जैक्ट सपोर्ट पे नहीं आया, आता तो वहाँ भी बाई करते, पर ठीक है नहीं आया तो कोई नहीं। ऊपर आता है ओरिजिनल रेजिस्टेंस पे, वहाँ का वेट कर सकते हैं। लेवल के अंदर ट्रेड कर रहे हो तो भाई एसएल कम रखना, क्वांटिटी भी कम रखना। जरूरी नहीं है रोज वो रेजिस्टेंस सपोर्ट को हिट ही करे 15 मिनट टाइम फ्रेम पर। वन आवर टाइम फ्रेम पे गोल्ड का व्यू मैंने कल बताया था एक बार, और मैं दिखा देता हूँ गोल्ड के व्यू को फॉरेक्स चार्ट में। क्रूड ऑयल में कोई न्यूज़ तो नहीं है, आई होप मेरी वॉइस आ रही होगी। अब नहीं आ रही वॉइस? वॉइस कम आए तो बता दो, मैं थोड़ा धीरे ही बोलता हूँ एक्चुअली में। गोल्ड में फॉरेक्स के चार्ट में वन आवर टाइम फ्रेम से कल से वो रेंज के अंदर ही फंसा हुआ है ना, वो सपोर्ट पे आ रहा है, रेजिस्टेंस पे आ रहा है। मैं एक बार चार्ट ही आपको दिखा देता हूँ। ये गोल्ड का चार्ट देखोगे ना फॉरेक्स में, काफ़ी टाइम से एक फंस गया रेंज के अंदर। तो अपर लेवल पे देखोगे यहाँ एक आइडेंटिकल रेजिस्टेंस बनते जा रहा है प्राइस में, जहाँ पर कंटिन्यूसली लोअर एंड अपर लेवल की ओर शिफ्ट हो रहे हैं। नॉर्मली तो इसमें ब्रेकआउट होता है, बट जरूरी नहीं है डायरेक्टली ब्रेकआउट ही करे। दो चीज़ पॉसिबिलिटी मुझे सबसे ज़्यादा लग रही है, या तो ये अपर लेवल पे जाके यहाँ कहीं ऐसा हिट करेगा सेलर्स के और फिर नीचे आएगा, या फिर ये जितने भी यहाँ पर नज़दीक के बायर बैठे हुए हैं इनका ऐसा डंप करेगा लोअर एंड पर अराउंड दिस जोन, एंड देन पॉसिबिलिटी है कि उसके बाद फिर इस सपोर्ट एरिया से वापस ऊपर जाएगा। तो अभी के लिए देखोगे हमारे पास मैं अपर लेवल की अगर बात करूं तो अपर लेवल पे मार्केट के पास ठीक है ये रेजिस्टेंस अभी भी इंटैक्ट ही है जब तक ब्रेक नहीं होता। लोअर एंड पे ये कल भी नहीं आया था, मतलब लेवल के आसपास आया, एग्जैक्टली हिट नहीं किया था, देख पा रहे होगे यहाँ पे वही कंटिन्यू कर रहा है। तो या तो ऊपर जा सकता है या रेजिस्टेंस अभी भी इंटैक्ट मान के चलो इस ऊपर आए लेवल को। वन आवर टाइम फ्रेम पे नीचे लोअर एंड की अगर मैं बात करूँ तो लोअर एंड पे हमारे पास जो मैंने जैसे बताया यहाँ पर देखोगे ना स्विंग कंटिन्यूसली शिफ्ट हो रहे हैं। ये पहला स्विंग है, दूसरा स्विंग है, उसके बाद ये तीसरा स्विंग अपर लेवल पे बना हुआ है। तो कहीं तो ऐसा उड़ाएगा जरूर, सीधा सपोर्ट लेके चला जाएगा तो फिर फ़ायदा क्या है, लिक्विडिटी नहीं मिलेगी। तो बेटर है यहाँ से आए 3900 से 940 के बीच में, यहाँ से एक सपोर्ट ले, या फिर अपर लेवल पे जाए तो 4040 से 4080 के बीच में सेल ऑफ। तो ये रेंज मैं एक्सपेक्ट कर रहा हूँ इन दोनों में से। वन आवर टाइम फ्रेम पे सपोर्ट रेजिस्टेंस कहीं तो जरूर लेगा, तो ये रेंज है। बाकी देखोगे तो ऐसा नहीं है, मोमेंटम कर रहा है, 2-3 दिन से इसी रेंज के अंदर चल रहा है। लेट्स होप आ जाए सपोर्ट या फिर रेजिस्टेंस जोन पे एटलीस्ट। ठीक है, फॉरेक्स का चार्ट था बाय द वे वन आवर टाइम फ्रेम पे। लाइक भी करते रहो गाइस जिन लोगों ने लाइक नहीं किया। यूएस मार्केट ओपन है, थोड़े वॉलेटाइल है मार्केट, ध्यान रखना। क्रूड ऑयल में एक छोटा सा सेलिंग का ट्रेड, नेचुरल गैस तो रेंज के अंदर ही है। ये क्रूड ऑयल आ रहा है ठीक ठाक, लेट्स सी, ये आना चाहिए नीचे तक थोड़ा सा, साइडवेज ना हो जाए बस। हाँ वो रेजिस्टेंस था, फिर ये ब्रेक यहाँ पर रेजिस्टेंस ले रहा था, ब्रेकआउट हो गया था बाद में ना। 2020 के आसपास का चार्ट है वो। उन्होंने रिटेस्ट कर दिया था 2020 के आसपास। 1972 से चल रहा है 1972 में भी आया ओवरऑल टाइम फ्रेम पे भी देखोगे ना गोल्ड को बिल्कुल ही वॉलेटाइल बड़ी कैंडल बनने वाली लग रहा है चार्ट ही कुछ इस तरह का बन रहा है बाकी अब ऑल टाइम हाई जाना तो मुश्किल लग रहा है मुझे गोल्ड में, अनटिल अनलेस कोई न्यूज़ नहीं आती बड़ी ऊपर। 4140 से 4200, ये 60 पॉइंट की काफ़ी स्ट्रॉन्ग रेंज है हायर टाइम फ्रेम पे, एटलीस्ट एट 4 आवर टाइम फ्रेम। एम पैटर्न बना है उसका जो ब्रेक डाउन हुआ है। $3,850 के आसपास। गोल्ड थोड़ा सा बेरी सी लग रहा है यार ओवरऑल तो। ऊपर भी रेजिस्टेंस स्ट्रॉन्ग है, नीचे वैसे सपोर्ट है एक, लेट्स सी 3870 के आसपास डायरेक्टली आता है या फिर थोड़ा ऊपर जाके वापस रेजिस्टेंस को हिट करके आता है। बाकी नेचुरल गैस डांस कर रहा है सेम लेवल पे, इतना मूव कर गया है। इस लेवल पे आया था अभी 330, ऑलमोस्ट 730 हो गया है। हाँ उसको देख लो, 1 मंथ में दिख जाएगा उसका। बिटकॉइन भी मुझे लग रहा है शायद थोड़ा सा करेक्शन देने के चांसेस हैं। पिछले महीने ऑलमोस्ट 4% की नेगेटिव थी, अभी इस मंथ टिल नाउ अभी तो काफ़ी टाइम बचा हुआ है, 5% से ज़्यादा डाउन है इस मंथ ओपनिंग के बाद। एक हाई पॉसिबिलिटी लग रही है नीचे एटलीस्ट 97,900 से 94,000 तक, इस लेवल, या फिर एक राउंड नंबर लो तो 95,000 के अराउंड, ठीक है, प्लस माइनस 2,000 पॉइंट ऊपर नीचे कर सकते हैं। 93 टू 97,000, राउंड नंबर 95,000, तो यहाँ तक आना चाहिए लग रहा है इसको प्रॉफिट बुकिंग दिखाने के लिए। हो सकता है थोड़ा और भी गिर जाए, बट एटलीस्ट यहाँ तक तो आना ही चाहिए। एक नेक्स्ट वेव स्टार्ट करनी है अगर इसे। प्रसाद सत्य जी, यूएस मार्केट ओपनिंग डिलेड नहीं है। यूएस मार्केट की ओपनिंग डिलेड नहीं है, 8 बजे ओपन होगा अब। डे लाइट सेविंग ऑन हो गया ना परसों से, डे लाइट सेविंग कल या परसों से, कल से, हाँ सॉरी, कल से डे लाइट सेविंग यूएस में ओपन हो गया है, तो टाइमिंग चेंज हो गया है सब चीज़ का। उस वजह से थोड़ा सा आपको डिले दिख रहा है वहाँ पे, और कुछ नहीं है। जो यूएस मार्केट है पहले 7 इंडियन टाइम के अकॉर्डिंग 7 PM पे ओपन होता था, अब 8 PM पे ओपन होता है। सिमिलरली लंदन सेशन जो 12:30 पे ओपन होता था 1:30 पे ओपन हो रहा है। न्यूयॉर्क सेशन जो 5:30 पे ओपन होता था अब 6:30 पे ओपन हो रहा है। और जो कमोडिटी मार्केट है उसका टाइमिंग भी 11:30 से इंक्रीज होकर 11:55 हो गया है, तो डे लाइट सेविंग ऑन है, उस वजह से थोड़ा सा ऐसा आपको फिलहाल के लिए देखने के लिए मिल रहा है। ठीक है, और जो फॉरेक्स मार्केट है उसमें भी आप कह सकते हो टाइमिंग चेंज हो गया है। फॉरेक्स मार्केट जो नॉर्मली क्लोज हो जाता था, हाँ, ठीक है, ठीक है, नॉर्मली जो ओपनिंग होती थी फॉरेक्स मार्केट की, दैट इज अराउंड 3:30 इंडियन टाइम के अकॉर्डिंग, 3:30 AM अर्ली मॉर्निंग ओपन होती थी, अब वो 4:30 AM पे ओपन होता है, तो 1 घंटा शिफ्ट हो गया हर चीज। इस वजह से थोड़ा सा आपको वहाँ पे दिख नहीं रहा है कुछ मोमेंटम। 8 PM पे ओपन होगा। क्रूड ऑयल और नेचुरल गैस की इन्वेंट्री भी जो आती है वो भी अब शिफ्ट हो गई है, 8 के बदले अब 9 बजे आएंगी शायद कल से। हाँ ये देखो, नेचुरल गैस क्रूड ऑयल की इन्वेंट्री कल है 9 बजे आएगी। आज तो खैर कोई डेटा नहीं है। तो कंफ्यूज मत करना।
LGT's investment solutions allow you to look to the future with confidence.
Participating in this effort from the outside, contributing ideas to what a set of shared principles will look like. And these are shared principles to signal under what circumstances corporates can purchase carbon credits. And the principles, actually we're underselling ourselves by calling it principles. It's actually a set of guidelines. If you go through it, you'll realize that it is probably the most detailed and specific set of guidance offered to corporates and businesses on the purchase of carbon credits, especially in the voluntary carbon market. So that's where we are. Coalition is less than a year old, but we've got a first product out, and there are a whole range of other issues that we want to work with. I just close off by saying all this is being done in response to business feedback. Businesses are saying, corporates were telling us, we want to buy credits, but we're not sure how. They're in a bad state. There's a lot of reputational risk. We need governments to tell us when and what kind of credits we can buy. Of course, we're not going to be prescriptive about those things, but we've given sufficient specific guidance through the shared principles that will give confidence. And early indications from businesses who have been part of this process, who have been contributing ideas to these shared principles, have told us this is important, this is good, this is going to help us.
And you mentioned some members of the coalition are public, obviously Singapore, UK, Kenya, France, Panama. Others have been contributing behind the scenes. Do you have a target in mind for how many countries are going to publicly endorse these principles, and who's next?
Well, a few have endorsed the principles publicly. Several others have welcomed it, and yet others have contributed to the process, but are still waiting to get their formal approvals internally before they can signal the support and joining the coalition, which you can imagine is a political process. You need to get endorsements from various ministries and so on, and that takes time through various countries. But we are actually quite hopeful that with this product now out in the public domain, a tangible expression of what we're doing, that we will get more traction on people joining the coalition.
So we've got, endorsing and welcoming and working with us, we've got Indonesia, Peru, South Africa, Luxembourg, Netherlands, and I know I'm forgetting somebody, and it's one of those wedding speeches that you never want to give, where you forgot your favourite aunt, but it's growing, and I don't think we have a target number in mind. The point is, in all of these kinds of ways of working, you get to a tipping point at well below 50% of the world's countries, right? So all it takes is a percentage of the world's economy, and then people start to see how we're going. And we're not being prescriptive, because different countries will choose different ways of regulating, setting guardrails, or incentivizing their corporates to engage with the voluntary carbon markets. And so there's no one way of doing it. What the UK is doing is different from Singapore, but with the same end goal in mind. So that's why we've come with these principles now, and then after COP we'll start getting into the nitty-gritty of maybe some more work on the how-to at a granular level.
And Rachel, this is a notably fractured time for climate diplomacy, let's put it that way. Is it safe to assume the US will not be endorsing the principles at this point?
Anybody can endorse the principles if they like them, so we'll see.
And I guess a somewhat related question. At the same time, some of the biggest historical players in the voluntary carbon market have been US companies, Delta, Chevron, Microsoft, etc. Do you think that will remain the case?
Yeah, I don't know about individual companies, but the need is still there, right? So the transitions that companies are going through, in particular for hard-to-abate sectors, it's very difficult to imagine how they're going to manage their transition without access to the voluntary markets alongside other instruments. And I think the other thing is, if Ali were here, Ali Mohammed, our triplet from Kenya, the desperate need for the voluntary markets to grow quickly, to scale quickly the finance that developing countries and emerging markets need, that can't be underestimated. I was at the Africa Climate Summit just about a month ago, and I was completely taken aback by the laser-like focus on growing the carbon markets by all African countries, no matter what state of development. So, I don't think we can be King Canute about voluntary carbon markets or about the carbon markets more broadly. And at this COP, you will see the Brazilians talk, as Minister Haddad did earlier this morning, about taxonomies, the compliance markets, and the moving down, ratcheting down the sort of transaction costs between different approaches. We've got Article 6 coming underway. We've got Article 6.2 transactions of high integrity beginning to come forward. And then we've got the voluntary markets. And we need all of the above. And we need countries need the capacity to be able to engage in these markets in a way that makes sense for their growth, their prosperity, their nature and industrial processes if they're on the supply side, and for demand-generating countries like ours in order to speed up the momentum of the transition. I mean, we've made a 81% reduction over baseline levels NDC. It's extremely ambitious. We've been out and consulted on the voluntary carbon markets, our own corporate sector. How we manage this is going to be a very important part, not only of how we manage our domestic transition, but how we engage with the rest of the world to help them manage theirs.
Actually, maybe I'll pick up on that, Ravi. As Rachel just said, there's multiple strands of work going on in carbon markets at the moment. There's Article 6, there's the Brazilian Open Coalition for Carbon Market Integration. For the uninitiated, this can seem a little confusing. So, Ravi, how would you explain what your coalition is doing as distinct from the other programs?
Well, what we're doing
दोनों ही जगह देखोगे सडन कैंडल है ओपन इक्वल टू लो क्रूड में भी और नेचुरल गैस में भी
an ecosystem as complex as in carbon markets will have multiple players doing different things. What the coalition is trying to do is to
सडनली बनी है एक तो गैप अप ही हो गया इसमें तो नेचुरल गैस में बट क्रूड में देखोगे तो भी इसमें भी
the infrastructure issues,
exactly open equal to low and then market moved upside.
And then to actually work with parties who are already engaged in this space. On the supply side, I must say, on the integrity front, there's been very good progress. Today, the market is a lot more discerning about high-quality, high-integrity carbon credits. High-integrity carbon credits typically fetch more than $6 to $8 per ton. Low-integrity credits, or of an older vintage, are going for less than $2. The market is making that distinction. The efforts made by meta-standard setting bodies like ICVCM, for instance, I think have considerably advanced the confidence in the integrity of these credits. Vera has estimated that there are about $375 million worth of 375 million credits in the pipeline for CCP label. That's huge because the existing stock is about 48 million. So there's a lot more high integrity credits coming into the pipeline to be certified, to be validated, and forming this supply. And on the demand side, like I said, there's a lot of willingness, and you asked about the US companies. Actually, the US companies are still very keen on carbon credits because they have climate goals they need to meet.
इसमें ना ऊपर एक और रेजिस्टेंस है ध्यान रखना ये जो दो रेजिस्टेंस एक तो कल वाला ही रेजिस्टेंस है इसके ऊपर भी एक और रेजिस्टेंस है तो इन दोनों को फोकस में रखना पास में हो सकता है एक साथ ही लिक्विडिटी ले ले वापस से रेंज के बाहर निकल जाए तो बेटर ही है मेरे अकॉर्डिंग
I think there's a lot of work
चाहे
now
कहीं भी
being
निकले
done on the
अदरवाइज
demand
फिर इसी
side
रेंज के
to
अंदर
provide
साइड में चला
clarity.
जाएगा
This is where the coalition has
फिर
focused
कुछ
its
खास
efforts
कर नहीं पाएंगे
because
वैसे
there's
ऐसे
kind
ही
of lacuna here.
थोड़ी बहुत
the
सेलिंग
voice
आएगी
of
थोड़ी बहुत बाइंग
governments.
आएगी देन सडनली मोमेंटम
There is also work underway on the infrastructure side. Efforts being made to have greater transparency across registries so that you don't have the old problems of double counting and so on. The World Bank is involved in this space, GCMU. So actually the different parts of the ecosystem are now congealing together in a nice way. And the coalition wants to play a facilitative role, adding the voice of government to these valid efforts to grow this market. And the tide is turning. The tide on carbon markets is turning. The last 1 year, I'd say. To date, for this year, more than $10 billion has been committed to carbon projects. That's 3 times more than the same period last year, first half of this year and first half of last year. So I think we're seeing a lot more momentum. This is a market that can build up to $5 billion, $10 billion perhaps by 2030 if we do all the right things. So we got to keep working at it. And I think there's another point I'd like to raise is that this is not just about decarbonization. I think it's a compelling tool for decarbonization. But there's growing recognition now that carbon markets have broader economic and social co-benefits. In both the advanced economies of the high-income countries, which is a source of demand for the credits, as well as in the global south, the emerging economies, which are largely the suppliers of these credits. There are larger developmental benefits for the communities in these countries in terms of attracting foreign investment and capital as part of carbon projects. There are improvements in, if it's forestry, improvements in that space. In the high-income countries, and I think both London and Singapore would be good examples of this, a vibrant carbon services ecosystem is taking shape.
ये जोन में ज़्यादा कुछ सेल ऑफ आया नहीं, थोड़ा बहुत ही
carbon credit ratings,
जितना expected था, कहीं तो break जरूर करना था
third-party verification services, affirmation services.
वापस आता है level से वापस sell कर
So
सकते
new
हो.
jobs, new value added being created because a new financial market is emerging to address a global problem. So I think it looks complex, but if you look at it carefully across ecosystem, things are falling into space. Still too early to declare victory. We need a lot more effort, but I think the next 3 to 5 years will be quite critical in turning this market decisively around.
So as you just said, Singapore and London are both finance hubs. So this is partly a bet on growing your competitive finance hubs with a new product. Is that a fair way to think about it?
It's a necessary thing to do for climate. It's also the smart thing to do for economies and jobs. And it's also the right thing to do because you are helping communities in the global south improve their lives and livelihoods.
And this is meant to be an execution-focused COP, and you are certainly trying to execute quickly on this project. So, Rachel, if we look forward, let's say 2 years from now, what does success look like? Where do you want to have got to?
So I hope that at this COP, despite all the sort of noises off, there's going to be a real focus on the at-scale investability of our future, right? So in past COPs, we've had big diplomatic arguments, and there's been a sort of he said, she says about, who pays for what and who contributes to what, and that will continue. But I think the necessity of this moment is that we scale the ways in which we can multiply the flows of finance into countries to build their resilience, to protect their nature, which is their lifeblood for the future, and to move their transitions more quickly. That means market scale, right? To get to scale, we've got to be able to build new markets, deploy new markets, and find new revenue streams. So carbon markets tick all of those boxes, and we have to believe that we are capable of not letting the perfect slow down the good. We have to believe that there are counterparties that want to work together to make this work, and that everybody needs and wants integrity. And that we are capable of regulating voluntarily or through compliance markets in the process in which we know how to regulate, which is you try something, you amend it if it's not having the intended benefit or if it's having a negative impact that you weren't predicting. And so we are good enough to do this. We've done it on other things. And what I'm hoping is that when we look back, let's say in 2030, in COP33, which will be the end of the next cycle of evaluation, that we will see carbon markets in their different forms, producing a steady flow, and almost a predictive flow of finance into countries that desperately need it. And more countries will have regulated or set guardrails or administered the conditions for their private sector to speed up their transition. And that takes more things than just voluntary markets, but that we've done that. This is the COP where we're supposed to pivot from 10 years of negotiation to 10 years of accelerating implementation. I can't think how we can do that without a robust set of market tools, looking at carbon, but also then looking further beyond at some point to biodiversity and other forms of credits.
And Ravi, what do you expect from COP30? Even Bill Gates is starting to question the value of some climate spending. I'm not sure if you have read his memo. But what is your view on where the emphasis should be in terms of mitigation versus adaptation, and what the conversations should be in Berlin?
I think both are equally important. The world is heading towards a future that is both carbon constrained and climate impaired. It's already too late to stop some of the effects of climate change. They are already upon us. And so adaptation, I think, will have growing importance going forward. And I'm glad that this COP is beginning to put some emphasis on that aspect. We all have to think very seriously about adaptation financing and resilience building, because climate change, even if tomorrow we stopped all greenhouse gas emissions, climate change will still run its course because of the emissions that are already in the atmosphere, the global warming process that's underway, and the planetary limits that are being breached, even as we speak. But it's never too late, because we can avoid the worst effects of climate change if we have decisive decarbonization in the next few years and decades. And so we need to be focused on mitigation just as much as we are on adaptation. So you can't throw up your hands in the air and say, it's only adaptation. Nor can you ignore adaptation, thinking that we can stop all aspects of climate change. It's already beginning to affect economies and livelihoods, and it's going to get worse. So I think we need efforts on both fronts.
And Rachel, you touched on this in some of your answer just before, but given the global environment, do you still see a place for this traditional COP process? How does it stay relevant in the years ahead, and can one ask the same question of the Paris Agreement?
Well, the Paris Agreement is relevant because it's working. It's not working fast enough and it's not working far enough for too many, but it's clearly working. And, the leaders that are coming in 2 days' time to Belém are coming because they're going to defend multilateralism, which is undeniably under attack from different places. They're going to defend it because it is the best and only way we have to work together on a global problem. How on earth do we do this in small groups in isolation? So I think that we have to make clear that message comes through. But when it comes to the COPs, the United Nations, we the peoples, is an intergovernmental space. And the climate discussions have been pushing at the edges of what does that mean for a long time. And here we have Bloomberg through, investing in this forum and events in Rio, and then there will be other events going on involving the private sector and sub-sovereigns in these cities over the next few days, while governments and those who hold them to account will be in Belém. But now it's not everybody keeping their eyes on the negotiations. Yes, we'll still be negotiating, but the biggest emphasis now is how do you accelerate implementation? And how do you hold us all to account, not just for what we agreed to in the convention, not just to what countries have signed up to and agreed to in each of the action calls that have subsequently come through each of the COPs, but when you stand up on a stage and you make a methane pledge as a large oil multilateral, or as a large industrial company, or as a large city, or as a large region, or as a country, or as a large NGO, how do we engineer a system where we hold ourselves to account for that pledge? Because it's not just that when we measure the NDCs, we're not quite on track yet, and we need to see the leaders say that they will strive to do more where their NDCs are below the line of getting to 1.5. But it's how are we holding ourselves to account for the voluntary commitments that we've all made? And I think this is something that can be worked out kind of in the ways that we're working in this coalition, between government, between civil society, between the private sector, finance, and this is what the Brazilians, I think, are trying to help us focus on over the next 3 weeks in different forums in different places, because the public has a right to know that when you stand up on a stage and you say, I am going to double down on this, or I'm going to triple this, or I'm going to try harder on this, that there's some expectation that that isn't just PR. And so I think there's a much higher standard now of what is acceptable. And so the question then flows from that. The question of how do we organize COPs flows from, and how are we going to be holding ourselves to account for achievement and acceleration of implementation? Do we need a COP every year? I don't know, we could take a poll. Some people would say yes, some people would say no. The point is, what do we do when we come together? And I think there has to be a step change in what we do when we come together over the next decade of implementation.
And we are almost out of time, but Ravi, maybe I'll give you the last 45 seconds to just share your key takeaways on carbon markets for this audience. What do you want people to walk away and think about?
Well, I think for all its faults and all the problems that it's had in the past, carbon markets are indispensable to closing the climate financing gap. It addresses the needs of companies in the high-income countries to meet their targets. It addresses the needs of decarbonization in the global south. I think this double coincidence of wants coming together to create a market is a very compelling proposition. There are broader economic and social benefits arising from this, and so I would advise all corporates to seriously consider carbon credits as part of your overall decarbonization plan. You're having maximized your direct decarbonization. What can I do for decarbonization elsewhere? The last thought I'll leave with everyone is this. NDCs force us to think about our own country's mitigation, and that's important. Corporates think about their own mitigation, but let's not forget, a ton of CO2 released into the atmosphere in Brazil or in the UK or in Singapore or in China or in Mexico has the same effect on the climate and affects us the same way. Carbon markets are a wonderful way to synergize efforts so that we can contribute to that global effort by making possible decarbonization in another location that would otherwise not have happened. You're making something happen which would not otherwise have happened by buying these credits. And so I think that's the last thought I'd like to leave, that we need to invest in this market, make it grow, make it vibrant, and create not just a sustainable planet, but also economic and social development.
Rachel, Ravi, thank you very much for joining us.
Thank you, Sarah.
Thank you. Thanks.
We do this. We're good at this. And we make all of these. We don't make energy. We make you save it. We connect and power just about everything around you and make the most of our energy and resources. We're open. Humans of all sorts from all over, all passionate about making an impact. We're here to be your digital partner for sustainability and efficiency.
Please welcome to the stage Roberto Hassi, President of Schneider Electric Brazil, for a conversation with Bloomberg's Felipe Veloso.
Well, good morning, everyone. I'm pleased to be joined on stage now by Roberto Rossi, President of Schneider Electric Brazil, a company that's at the forefront of energy management and automation. And as Brazil accelerates its industrial transformation, Schneider Electric has been driving innovation, electrification, efficiency, and digitalization, all essential, as we know, for a low-carbon future. So, Roberto, thank you for being here.
Thank you for being here with me, and thank you for the introduction of the company. Yes, you're right. The movement in the last year has been impressive. So Schneider is an old company, already 180 years alive, and we have seen over the time a lot of industrial and energy disruptions and revolutions. And then back in time, we defined a concept around electricity 4.0 to showcase what is moving forward in terms of energy transition and digitalization. What we do see is a movement in which we are more electrical and more digital moving forward. And on top of that, what we bring is a more connectable product and more connected solutions. Then this is more or less what we are looking for.
Well, let's start by exploring a little bit about how greater electrification and digitization can really drive industrial decarbonization and competitiveness.
Yeah.
Right? There's a lot of technologies out there, but I wanted to understand from you, what are these technologies already helping the industry kind of move into that direction?
Yeah, as I said, the concept of electricity and digitalization coming together is reshaping the market. We do see more connectable products. We do see a smarter, more connectable, or more efficiency in the energy system. Why? Because from one side, electricity is reshaping the market. It's the better source of energy because in terms of performance, and it can also be generated in a clean way. And in parallel, the easy adoption of it is making transformation in mobility, is making transformation in process, is making transformation in heating. That means today the share of wallet of energy for the electricity in energy is 22%, and it will reach 40% by the 2050, 2055. In parallel, what we do see is what in time was segregated system, energy management and industrial automation. Over the time, with more and more digitization, they start to combine together to be one unique backbone, sharing information, sharing resources, and bringing more information that we didn't have in the past. With this information, we start to connect production with demand, with generation, and along with that, we used to have these two systems formerly segregated, now together, but moving forward to what was hardware-defined automation into software-defined automation. In the past, all the controllers define the way in which we do the automation, either for energy or either for the part of production. By now, more and more, all these controllers are not making sense anymore, and in the future, software will define the platform to make it happen. Then we have a good platform to top up with all the solutions, whether artificial intelligence, machine learning, digital twins, or whatever solution for energy stability across the board. And this is applicable to all the segment, building, data center, industry, etc., etc. And we have already some solution implemented here in Brazil, in Vale, with a Aviva Pi system to monitor the weather condition for risk response, to be sure that they will reduce the carbon footprint. We have solution with Melia hotels, with our resource advisor, to reduce also the consumption, and other solutions that have been implemented. Then, long story short, we do see the conversions of electrification along with digitalization moving forward, removing 70% of the carbon footprint in an easy way. The topic is how to implement.
And speaking a little bit about Brazil, because we're obviously all here for COP, based on your experience leading Schneider Electric in Brazil, what would it take for Brazil to really become a global leader in sustainable industrial development?
So, at the end, Brazil today, as everyone knows, is super well positioned in some domains, in generation and maybe in the future business of the carbon market. In terms of generation, we are the leader by far, because we can achieve 84% of our generation in a clean way. Then, what is happening now is on the other side of the equation. When you see the result of World Economic Forum in terms of Energy Transition Index, we are in the position 15, mainly because it's not only the generation, but also the consumption. It's energy efficiency, energy equity, and sustainability. And on the other side, the CNI local entity is qualifying our productivity like position 18 out of 18. That means a lot of things to be done. Our focus should be on the demand side. Our focus should be to train the future generation and the current generation, and to create policies to create a platform for sustainable business and predictable business.
So you just mentioned something really important, which is, the implementation of these strategic kind of demand side solutions, right? and really to have these solutions to support this industrial decarbonization. What are those opportunities?
So to give you one example is the one that was presented, I guess, today of Redata. So when you look back, I used to be the president for Indonesia, and I arrived here 1 year and a half ago. And the data center market was promising but blocked. Blocked why? Because from one side, the plenty of energetic solutions in a clean way and affordable way, plus the land available in Brazil, make the perfect scenario. But the rest of the policies, taxation, regulation, we are not there to make it happen. And as it was showcased today, this was a good collaboration in between private sector and public sector to make it happen. And now we can see moving forward almost 2 trillion reais coming on investment, because now Brazil could be a hub for data center, also for Brazil incorporating the data that is today processed out of Brazil, or maybe because we can bring from outside data to be processed. In parallel, more generic, what I would like to highlight that Schneider Sustainability Research Institute is working with the Ministry of Development for Industry and Commerce in one white paper, one contribution for the country to decarbonize the industry. This will be released now in the COP, and this is fully aligned with the intention of the government for the Nova Industria in Brazil, as well as the increase of the industrialization while reducing the carbon footprint. And then what we are bringing there is the experience of our research institute that have done this in India and in China with remarkable results.
So this study and project that you mentioned, what concrete pathways does the study really propose for you to achieve that decarbonization?
Well, there is a report that includes 3 chapters. Okay. The first chapter is already released, where we showcase worldwide the energy transition toward 2050, what it will happen with electricity, electrification, energy efficiency, circularity, and other domains like biofuels, etc. The second and the third chapter will be released soon in the COP, and are more focused on all the policies that will bring actionable actions toward bioeconomy, better jobs, all the value chain around this the value creation, subsidies, policies, improvement on the way value chain is recognized by consuming less resources. And then totally it will be connected to something that from one side it will be feasible from the technical standpoint, viable from the economical standpoint, in line with the focus of the country toward the 2050 commitment. Then we have the third chapter that is more or less all the scenarios that we will have depending on the acceleration of these policies, because at the end these policies could be applied or not, could be faster or slower, and then we will have several scenarios of how the 25 will look like according to this evolution.
I know that we're out of time, but I don't want to let Roberto go without asking him a little bit about COP. A very simple question. What are your expectations for COP30 being hosted in Brazil, and what do you hope that the impact is?
Well, by now, Schneider has been participating in COP for more than 10 years. As the most sustainable company in the world, we consider that we have a voice to share there and solution to be shared there. Being practical, the COP of 2015, the Paris COP, is still remembered for iconic to define the maximum of the rise of the temperature and to put the topic on the center. I do hope that moving forward, the COP of Brazil will be remembered as the COP of implementation. As per today, we know more or less how we can get financial scheme, but still we don't know how to implement, how to roll out, and how to rule this. So I do hope the COP of Brazil in 10 years' time or 20 years' time will be remembered as the COP of the implementation toward a better future by the end of the century.
Well, thank you. Unfortunately, we're out of time, but I want to thank Roberto Rossi and also Schneider Electric for supporting our event. Thank you all.
Please welcome to the stage Odile Renaud Basso, President of the European Bank for Reconstruction and Development, for a conversation.
ओके गाइस, यूएस मार्केट ओपन हो गया. ध्यान रखना थोड़ी सी वॉलेटाइल कैंडल रहेगी. ये डेलाइट सेविंग टाइमिंग चेंज हुआ है. 8 p.m. US market now open. This candle may be volatile in both crude oil as well as in natural gas. दोनों जगह volatile. वैसे natural gas तो super volatile है, बट हो सकता है क्रूड भी थोड़ा और volatile हो जाए इस पर्टिकुलर कैंडल पे. ध्यान रखियो स्पेसिफिकली इस 15 मिनट की कैंडल का. US market is open now.
Dollars
in new investments that multilateral development banks have to do more with perhaps less. How is the EBRD faring in the current moment?
So we are clearly a growing bank. So we are well capitalized. We got additional support from our shareholders in the form of the capital increase, which has been decided a few years ago, in particular in relation to our activity on Ukraine. But we are optimizing the resources we have in the form of our capital in order to increase our activity and our investment in the countries in which we work. We are also enlarging the scope of countries in which we work, enlarging our geography, because we are just starting investing in sub-Saharan African countries, in 6 new countries, and Iraq. So we are really stretching our balance sheet and stretching our capacity in order to provide investment, and we focus very much on the private sector. The bank mandate is to support the private sector, so 75% of our investments are in the private sector in different forms, from SMEs to foreign investment and so forth, and each country has its challenges, its priority, but we are very much there to support their growth and development.
You have very concrete challenges as to what to supply and where to send your capital, particularly at a time when we're seeing wars. You're very active in Ukraine. How do you decide how to balance your mandate to, support cleaner energy and the transition, as well as those countries that need it most?
So we are very much demand-driven. Being private sector, we really work first on the demand of our clients and what they need, what kind of project they want us to support and to finance. But we also have broad priorities in terms of allocation of capital between the most advanced countries we support, the least advanced countries, because we work from countries like very different scope between Poland or Baltic countries to now sub-Saharan African countries. So we try to have a sort of overall allocation of resources and capital in terms of preserving, ensuring that we have the right focus on the countries that need us most. And one of our very important criteria for investment is additionality. So we finance projects where we believe that we provide something that others, the private sector, private banks, could not provide, so where we are really additional. That's a key driving element for us, as well as a demand. And we have some sort of strategic priorities, which are supporting the green transition and the energy security, greening of the economies and so forth, supporting good economic governance, so transformation of the countries and the business environment in which we work in order to facilitate private sector investment, to have an environment which is conducive to growth and job creation and investment, and also inclusion. Women participation to labor market is a big challenge in a number of countries in which we work. So this is a focus. We have human capital. And in a country like Ukraine, for example, we invest a lot in energy security, keeping the basic infrastructure running, but also a lot in human capital, because helping people coming back from war, or to reintegrate labor market, or businesses to deal with the challenges in the labor market, mobilization needs and so forth, is a big challenge. So this is something where we are quite active.
Can I ask you about ODAs, the official development assistance that you get? How do you continue to replenish in an era where it does feel like there's palpable backlash, particularly when it comes to the climate agenda from some countries? And if I can add on to that, how much is the US a barrier right now?
So we are not, as a multilateral development bank, we do not depend directly too much on ODA. We have our capital, we invest, the investment generates revenues. This helps us. We do not distribute dividends to the shareholders, but the revenues, the benefits we have allow us to increase our capital, to build up reserve, to increase our financing capacity, and part of it is allocated to subsidies to prepare projects and so forth. But we have donor funding also from a bilateral or international organization like the EU. So this is an important element, and this part is indeed related to ODA. But we don't have a big fund like IDA or African Development Fund to generate a concessional funding at scale, because we are private sector, so we work on the condition of the market. This being said, for a number of activities, we need this donor support. for example, to finance project preparation, to finance project where the risk is too high for us and we need some kind of guarantees or risk sharing with donors, donor funding, and this is still working quite well. We managed to get some important donor support, I think, because the impact we can show, the leverage of the funding, for each euro we are provided, we can show big important leverage. But this is likely to become, I think, a challenge, and we need to be, I think for me, the key lesson I draw from that is that we need to be very
नेचुरल गैस भी
where we are.
नेचुरल गैस भी देखो रेजिस्टेंस को हिट करने वाला है वापस से कल के रेंज के बाहर निकल गया वेल एंड गुड काफ़ी देर से रुका हुआ था रेंज के अंदर फाइनली गिव्स अ रेंज ब्रेक ऊपर कल के रेजिस्टेंस पे वहाँ से वापस सेल का प्लान कर सकते हैं इसमें भी दो रेजिस्टेंस साथ साथ हैं तो थोड़ा सा ध्यान रखना
Shockwave, I think, in the economy where, you know, Bill Gates was saying there is a certain amount of money, and at this point we need to maybe pull back some of that money from climate in order to make sure that particularly children's welfare is taken care of. What did you think when you read that argument?
I think it's a bit simplistic because in a way, of course, you have some trade-off and you have to allocate some scarce resources in the most efficient manner. I think when you think about impact of natural disaster, impact of heating waves on healthcare and so forth, you have this is not unrelated. So what's going on the environment, pollution, increase of temperature, increase of flood and so forth, this has a huge impact also on health. So I think that it's not one or the other. We need to find ways to support both. But as I was saying, we need also to rely more, and to use these very scarce resources in a very efficient manner. When we can bring the private sector, when there is no need for concessional funding, we can go for, pure market funding. And I think the good news, in a way, is that in the mitigation agenda, for example, to support green transition, reduce emission and so forth, there is such a big progress in terms of price, in terms of affordability, in terms of competitiveness, that this is, allows to develop market approach, merchant approach, without any, which facilitate the deployment of these new energy sources, contributing to energy security, but also at a low cost and much lower cost than 3 years ago, 5 years ago. So I think this technological transition, which is really taking place at a rapid pace is facilitating this kind of trade-off.
We talk about Baku to Belém and the roadmap that we hope will get fleshed out during this COP. Have you any suggestions for how that might happen? After all, $1.3 trillion does sound like a lot of money, but as we heard from Bloomberg NEF, $1.4 trillion was spent just cleaning up natural disasters and climate-related disasters last year alone.
So indeed, no, it looks a lot of money, but indeed not doing anything and not investing in this area would cost a lot also. What I think is important is that there is a very broad range of contribution to, from local investment, domestic market, government funding their own investment, developing and emerging countries financing their own investment, to MDB's role, to private sector. So I think the key element for me to be successful in this area is partnership, to work together and to combine and to have a clear strategic vision, strategic objective, clear policy framework at the country level. That I think is absolutely key to bring the different partners from MDBs to private sector together and know where they can invest, what are the opportunities, and facilitate investment. And that's where how we will make progress. So in a way, we have to liaise between this, what appears as this very big figure, very aspirational, and what we can do on the ground, project by project, country by country, to support the right level of investment, working with partners in the public sector, but also in the private sector, because a lot of work we are doing, for example, in the bank, is working, and it's very closely related to the previous speaker you had, which is working with business partners in the manufacturing sector, agribusiness, to facilitate, to help them invest in decarbonization, more energy efficiency, and so forth. And there you also have clearly a business case. You need to find the right solution. Sometimes you need to increase the awareness of the small businesses, for example, about the opportunities they may find and the technologies they may find in the market, allowing them to be more efficient, to save, to be more competitive in the way they use energy, and then be able to sell, to export, and to develop their businesses. So I think it's, I mean, the link, very often we speak about this big aspiration, in COP in particular, we speak about this big aspiration, but also looking at very concrete, positive projects that are developed and can be scaled up in order to bring progress in the ground and for people.
And indeed, you do a huge amount of work with small and medium-sized enterprises in all of these countries. You mentioned before that you've been able to bring on some insurers, and that has helped with risk sharing and so on. How do you bring on pension funds and more long-term money? How do you attract those so that perhaps you can get involved in bigger ticket items?
Yes, so mobilizing private sector is one of our top priorities. First of all, we invest in the private sector, but we also want more share some of our investment with more private sector investors. And for that, we use a multiplicity of sort of instrument, from traditional A/B loans, where we have institutional co-investing with us, to unfunded risk participation with the insurers who are looking for diversification of risk, interested in taking some risk on emerging market and developing countries. We are working also on market transaction for securitization, and we do that, all MDBs working together in order to really learn from each other, but also, build a market where you have, different MDBs offering different or similar type of product to the market. Pension funds are a very important partner for us. We work, for example, with partner ILX, who is a fund gathering funding from pension fund, in particular in European countries like Netherlands, Nordic countries. Pension funds are very interested in long-term sustainability impact investment, and this fund, built upon pension fund, with an allocation of resources from pension fund, is co-investing with us through B loans in a number of projects in emerging markets. And it can be from projects in Turkey, but also in Uzbekistan, in Egypt. So quite a wide range of countries with different level of risk. And it's, I think, a very efficient way, because it's for the pension fund, it's a very small allocation of their own investment, but bring them impact. And I think it's for their pensioners, it's also a way to bring value. So
Yes.
that's a scheme, a kind of theme we would be happy to expand.
And I know you've been doing a lot of work on risk assessment, which is particularly important because, as you found, some of these projects aren't quite as risky perhaps as some investors would think, or as maybe the perception is.
Yes, so there have been a lot of work on that. And in particular, we, with other MDBs, published our data on risk of default, recovery in case of default, and so forth, which is called the GEMS database. And I think it gives a very interesting picture, because it shows that on the investment we are doing in the private sector, the level of default, the level of risk is much smaller than the general risk perception. And we had yesterday an interesting roundtable where Standard & Poor's were participating, and they were saying that for them this database and this data, and the more granular data we can bring, the better it is helpful to reassess the risk. And they updated their methodology in order to take into account the fact that projects prepared by MDBs, which benefit also from the sort of preferred creditor status because of MDB participation, are, really less risky than the general perception can be, and then it unlocked a lot of potential capital from investment according to their methodology. So this is something we need to continue to work upon in order to increase our capacity to fund, and also to, more importantly, to attract more private investors together with us.
Yes. Now, I know that you are going to give us some announcements on maybe country platforms at COP30. I don't know if you can give us a little preview today, perhaps not. Either way, what is your best hope for this particular COP?
So I think developing country platform is very important because, as I was saying, the policy environment, a strategic commitment from a country to do this, to commit to some objective, have a clarity on what is long-term, medium-term, long-term investment plan in the energy sector, for example, or in the water sector. This is very important to drive investors. It's also a very effective tool to coordinate within the government. You know, sometimes you have Ministry of Finance, of Equipment, of Energy, having a joint view, very clear, and bringing together all MDBs and bringing together the private sector is the best way, I think, to deliver results. We've been doing that with a number of countries already, in Egypt, North Macedonia, Turkey, and we hope to be able to deploy this model. And I think this will be one of the outcome of this COP, to have more of this type of approach, as well as, I think, a further focus on resilience and adaptation, and moving globally from commitment to implementation.
Well, thank you so much, Madame la Présidente. I wish you a very successful COP30 with lots more announcements to come. Thank you.
Thank you.
Please welcome to the stage Dana Barsky, Global Head of Sustainability Strategy and Net Zero at Standard Chartered; Giselle Lopez, Executive Director of Global Sustainable Solutions at JP Morgan; and Helen Mirovich, the Managing Director for Climate and Environment at IDB Invest, for a conversation with Bloomberg's John.
Great. Well, thank you so much for joining me here today. It's great to see three such prominent members of the finance community at an event on the sidelines of COP30. So let's start. The economist Herman Daly famously said that the economy is the wholly owned subsidiary of nature and not the reverse. But we've seen that governments are reluctant to put a price on nature. How exactly can banks in this environment build an investment thesis in such a fragmented policy landscape? Let's start with you.
Thank you, and thanks for having me. There is a race to put an economic price on nature, and the reason is because often, I mean, you look at this beautiful picture, standing forests have great short-term economic value, and we need to convert that to long-term economic value. We need to put a price on making that shift. And, you know, it is unfortunate because the moment in time now that puts valuations on forestry or on fishing stocks is short-term in nature, and we have to shift that. And so to do that, we need to come up with, and the finance community needs to come up with innovative ways to do that. That could take forms of carbon credits that was discussed earlier. It could be innovative financing mechanisms such as impact bonds, financing acceleration of carbon credit creation, the TFF facility that has been launched or will be launched here at COP30. So there's a lot of mechanisms that we can use to help shift that value. I mean, you know, it's be it forestry, be it fishing, having finance mechanisms put value on that is just so important. I mean, just one example comes to mind. We worked on a debt swap for Bahamas, and that really created a marine protected area that stopped short-term fishing and put value on creation of protection of that area for a longer term perspective. And so I just think there's so many different mechanisms that we can use to make that transition.
Indeed. And Giselle, you've been involved in building up a lot of these projects at JP Morgan. Can you just talk to us a little bit about your experience, some of the projects you've worked on, and how you think we can make these projects both bankable and scalable.
Thank you, John. Look, I think to set a price on nature, we first need to look at the components of one, demand, supply, and then if you have these two components, then financing will follow. So on the demand side, we have very clear signals from large technology companies such as Amazon, Microsoft signing long-term offtake agreements for nature. And so that is a very strong demand sign. The second one on supply, we see a lot of developers. However, not all have the same quality. But for those developers that can secure a high-quality credit and that can make the project profitable without any concessionary support, then the project economics make sense. Once you have those two components, then financing will follow. And one company that has done this pretty well is Chestnut Carbon. Earlier this year, we announced an innovative project finance for a carbon removal project in the US. It was the first of its kind, it was the largest of its kind, and without no concessionary support, it was done in standard financing terms.
And we were right there by your side.
Elaine, if I could turn to you, I mean, obviously one of the overriding factors when you're trying to build up these projects is the notion of risk. And the risk can take many different forms, right? And one of those forms is that we're seeing increasingly extreme weather. We're seeing wildfires, we're seeing storms. We had Melissa pass through the Caribbean just a week ago. How are you looking at that, and how can investors control for those kind of risks?
So I think that I would like to first, I will talk about risk, but let me complement one thing that is critical for all these products that put a price on nature, which is basically the KPI, the impact that we're looking for. And one of the main deliverables that we're bringing to COP as MDBs, as a group of MDBs, is a common taxonomy of what nature finance is, because it could be fisheries, it could be mangroves, it could be also carbon credits. There's a variety of investments that are linked to nature, and having a common taxonomy is the first thing. But the second thing, to be able to design a product, a financing product, we have to have clarity on what KPIs are we using. And in our examples of the debt swaps that we did in Bahamas from the public sector side, and even ourselves working with private companies, the definition of those KPIs takes a long time. There are more than 600 KPIs being used. And so we came all together, all the MDBs, and decided that we needed to have clarity, a guide for practitioners to say, if you want to respond, basically manage the risk or plant trees, we have to have one type of KPIs. But there are other KPIs that are linked to pressure on the environment, and the other one is the state of the nature, right? And so having clarity and having examples of what's basically the theory of change is very important. So we're launching that at COP30 next week in Belém. But in terms of risk, part of the issue when we work with banks and with clients is for them to understand that right now is not only for them to see the impact that they can have on the environment, but also how the environment is impacting on them. And frameworks like TNFD or TCFD or ISSB are very useful to engage with private clients, for them to look at how the climate risk or the nature risk will affect their business, their bottom line. And when you do that, they start understanding that they have to take care of nature.
Brilliant. And just for the audience, please, I'm looking for questions, so if you have any, just scan the QR code and we'll take those and put them to our panel.
May I add something on just
Yes,
on the risk
Donna,
point? This is my 5th COP now. I mean, my first one was back in Scotland, and when I think back on those days versus today, I think the private sector is so much closer to the public sector. We've developed so much over the last 5 years, and forums like this have really helped advance those conversations. And what that means is that we're able to work earlier, sooner, faster with the MDB community to help de-risk things. And the universe has expanded. Corporates are now involved. We spoke about insurance companies are coming in earlier, philanthropic organizations, and that's enabling everyone to figure out how to de-risk a project much earlier, much faster, much better, and that's a huge change over the last 5 years.
I'm glad you talk about that, and particularly the demand side of the equation, I think, is something that needs to be addressed here. Giselle, how are you seeing demand currently? I mean, obviously, we're operating in a different geopolitical environment now. We're seeing a number of technological changes, whether it be AI or data centers. How do you see that, and where do you see the big elements of demand coming from for these markets?
So demand over the couple of years in the carbon credits market has evolved dramatically, right? Before, you had what Bloomberg called behavioral purchases, where were driven by companies trying to offer avoidance solutions to retail customers. Now, what we see is a shift towards very high quality. And what do I mean by high quality? These are credits that have permanence, that are additional, that have certain co-benefits. That means benefits to the community surrounding the project. And so those credits are harder. They're more expensive to develop. And so demand has moved towards those credits. Right, and you have first movers such as Frontier, you have first movers as the tech companies. So that's where the demand is going, and I think that is where we need to grow from now onwards. And frankly, a lot of institutions like Microsoft has been a first mover in this space. They've said, this is what I consider a high quality. And it has set the bar really high, but I think developers are moving towards there. And with AI data centers, you are probably going to have more emissions, right? Because we're going to use more power, and the grids are still not fully decarbonized. So as a result, we're going to have more emissions. And so as especially hyperscalers move towards fulfilling their net zero commitments, then you're going to see more demand for high quality credits.
Brilliant. Let's turn to the COP30 summit a little bit. One of the key initiatives that Brazil, the presidency of the COP30, is putting forward is the TFFF, the Tropical Forest Forever Facility. And that is one of a lot of people are saying that's incredibly innovative. It's going to be rewarding countries that have standing forests to keep those forests standing. How are you thinking about that in the banking community, and what advice would you be giving going into COP30? I'll start with you, Helen.
So I think that it's a very innovative instrument that we needed to develop, and as always, to develop these types of initiatives takes time. That's why COP30 presidency had put a lot of effort on bringing this home, right? From our perspective, understanding and designing bankable projects around this idea is something that we have to start with. So we are supporting with IDB, supporting with technical assistance for them to be able to design what type of investments can be then bankable, hopefully later on, not at a concessional state, because what will take root and it will be long lasting is if it can become a commercial state, right? But right now, I think that the idea of having this large pot of resources that can support and reward countries for their standing tropical forests is a very important signal, and it can be complemented with all this type of work that we have learned in other areas, right? There's a lot of learning that has been done in renewables energy, for example, where 10, 15 years ago we needed concessional resources, and today is basically commercially viable. So hopefully the forestry conversation will also end up being a commercially viable conversation in a few years with the starting of this mechanism.
And Donna, how do you see the role for Standard Chartered or banks in general?
I mean, specifically to the TFFF facility, I think it's important to understand it's an incredible reward system. I mean, we're hopeful that 70 plus countries are rewarded for restricting their deforestation, below a certain thresholds. But that being said, if it's successful, and I think this is an important point, the math is kind of working out, depending on how it plays out, something like roughly paying out $4 per hectare. That's nowhere near the value of this beautiful forestry. So I think we need to think about that as incremental value to reward countries that stop deforestation. And I think the TFFF facility can be used in combination with other, financing mechanisms such as carbon credits. But I think we need to think about it as incremental, and I think that's fine and that's good because we have to start now. And it's, it may not be perfect, but if we don't start and tackle this issue, then we won't get anywhere. So I think it's important to think of that as incremental.
Great. We do have a question from our Q&A. How can financial institutions finance, invest in, and support projects to ensure that they have high integrity? Giselle, if I come to you on that one.
So look, let's take a step back and let's look from a financial perspective. What are the risks that we need to mitigate, right? So the first one is obviously revenue risk, right? And so for us, it's very important to see who the off-taker is. So in this case, if it's an investment-grade counterparty, that's amazing because that means that we can finance and lever that purchase agreement. The second thing that we look at is what is the carbon yield of the project, meaning what is the mortality risk of that forest? What is the growth risk of that forest? The third thing that we need to look at is land acquisition. Is the land there on an affordable basis to acquire, because you need large plots of land, and does the company have an effective way to identify these plots of land? That's where AI, for example, is extremely useful. Then the fourth thing is nature risk, right? This is at the end of the day, this is a life asset. And so you need to account for the risk related to wildfires, convective storm. Can this wipe out the plot of land where I'm putting my trees? And then are there insurance solutions, like such as parametric insurance, to mitigate or reduce some of those risks? And so once we look at that package, then we can say, okay, is this financeable, right? Does the economic make sense? And then, of course, as an added value, we look at, okay, does the project that has co-benefits, right? Does it follow the do no harm rules at all the banks at year 2? And so if those packages make sense and the returns are there, the financing will be there, right? And on Chestnut, for example, that's where we had a lot of success because, again, it was high quality, followed the Microsoft standards, it had a Microsoft offtake, and so once we packaged that up in a project finance loan, then when we went to the banks, the demand was there.
So there's a new report that's out today that says banks have arranged more than $425 billion of financing for companies contributing the most to deforestation since the Paris Agreement was announced almost a decade ago. How do we change that equation? How do we stop that from happening? How do we build up the nature markets? I don't know if one of you would like to take that, Dana. Yeah.
I think it's critical. I mean, we operate in 52 markets, many of them which are the most biodiverse countries. And so we have to be part of that solution. And, I think we touched on bringing first of its kind transactions to market where we can change that equation is so critical. And I think organizations such as ours that have the liberty to experiment and push the boundaries of what financial institutions can do will help close that gap.
We have a, do you want to comment on that?
Yeah, no, I just wanted to say that I think that at least the MDBs, we have committed to support countries in their NDCs, and we have the commitment to align and support our financing to the country's commitments, not only in the NDC, but long-term strategy. That is why the supporting and the presentation of the NDC 3.0 is so critical, because I think it's not only the private sector developing these projects, but the signaling from the public sector that this is relevant, that there are the enabling conditions in place, and that there is a commitment, a long-term commitment of the country is very important for us to then be able to finance and structure these types of deals.
Brilliant. We do have one more question on the Q&A, which I think is very relevant. Do we need perfect pricing of nature to drive investments to projects, or is there enough information that markets are financing the projects that will deliver the greatest value? It seems to be a question on transparency and data and the like.
I would love perfect, but we can't let it get in the way of progress. Some instruments, I think, are very elegant of pricing and trying to be very data-driven. For instance, impact bonds that only pay for specific, measurable, audited outcomes are a beautiful instrument to ensure you're trying to price in that nature risk or the nature progress as data-driven as possible. But and that's wonderful, but I also don't want to stop progress.
Great. We have 1 minute left, so I'd just like to take the view of our panelists about the one or two things that this COP can deliver that banks will be looking for to help boost nature markets and carbon markets. So starting with you, Hélène, a few words.
Yeah, one of the first things that I think Odile mentioned it in the panel before is this is the COP of implementation, right? So we want to see examples. We want to see how we can provide more instruments, more structures that can allow for the financial flows that are needed to respond to this crisis. We as MDBs are going to support and present a paper on all the different innovations that we're doing, specifically on adaptation in this case, but many of these adaptation solutions are a link between nature and climate, which is very important to bear in mind. So having examples and understanding and learning from each other is one of the main things that I think this COP should bring to the table.
Brilliant. And Giselle, in a couple of words?
For me, it will be the implementation of the TFFF. I think it has a lot of application and it's very scalable.
Great. And Donna, to finish off?
I would love countries to be brave with their national determined contributions and think about how Article 6 and carbon credits can play a part of that.
Brilliant. And on that note, thanks very much to my panelists. Enjoy the rest of the day. Thank you.
Thank you.
Please welcome to the stage Bloomberg's John Moore.
Morning, everybody. You're nearly there, nearly lunchtime, I think. So one of the real joys of my job is I get to travel around the world a lot. In the last few weeks, been many parts of China, Southeast Asia, Japan, the US, Europe. And if there's one thing that's really, really clear, is that in the energy transition, each country is taking a very different pathway and moving at very, very different speeds. You could actually see that if you look carefully at last year's data. This was the $2.1 trillion that was invested in clean technologies last year, up 11%. But if you look at the dotted box, what you will see is that actually it grew 21% in Asia, it grew 7% in the Americas, and minus 1.7% in Europe. So already very, very different rates of progress across geographies. And if you look at it by technology, it's even more stark. So 93% of the 2.1 trillion went into just 4 different technologies: renewable energy, batteries, EVs, and the grid, and 7% into everything else. So again, depending on which technologies are getting deployed in your geography will tell you how quickly you are moving. And there's sort of four different trends four different drivers I wanted to highlight around this. So one is technology costs. It's been mentioned a lot. Everybody talks about, rapidly falling costs of renewable technologies. Solar modules were down 61% since 2023, so that's absolutely massive. Battery packs down 20% in the last year alone, so really steep. It's a slow wave change, so again, it's easy to overlook. Policies are much more of a fast change, and particularly this year, so there's been lots of interest around tariffs. This is the US tariffs, sort of in blue where they started, where they were mid-year, and kind of where they are now. So very volatile, very, very fast change, and policy is either a headwind or a tailwind. Temperature is another one of those actually slow-moving changes, and actually in the last 30 years, this is in Europe, temperature increased by 2.3 degrees C. So that's pretty massive increase in just 3 decades, and we'll see the implications of that. And last but not least, probably the fastest change of all this year, AI, and again, this great quote from CEO of Anthropic, it's sort of how fast it's moving. So it certainly is moving very quickly, and this year sort of every meeting has had a whole series of discussions around AI. So what does that do to the transition if you take those just an example? So let's look at the power system first. Actually, this first 6 months of this year has been another record 6 months of renewable energy implementation, so investment flowing into renewable energy. It's like 2/3 into solar, particularly small scale, and 1/3 into wind, particularly offshore in this half. But again, considering what's going on, it's pretty amazing that it's still in record territory. That does vary by geography. So actually, in the US, that number was down 36% year on year for the first 6 months. And in Europe, that was up 63%, based around some large offshore wind deals. So you can see the very different, again, by geography. And this is the US. This is our forecast for the US for renewable build-out. The dotted line was where we started the year with sort of consistent policy. The sharp line that drops was where the on-BBBA came in, and that was our prediction of the impact. We've just announced a reforecast which actually smooths that curve. And again, you'll see there's a dip where policies are being removed, support is being removed, but you'll see it actually does start to rise again. And that's really where the economics kick in. So the technology cost curves override the headwind of policy. And if you look at AI, so this was our forecast in April of the year of power demand for AI, what you'll see is it ends up being similar to EVs, growing more sharply. It goes from about 3.5% of power demand in the US to 8.6%. So that is significant. It's not as wild as some people think. Our forecast is that blue line, so maybe we're being too modest and too low. But again, there is a lot of different estimates out there and forecasts out there. So very, very unclear. Let's see how it plays out. We're factoring in what can actually get built as opposed to where people would like it to go. And really what that means is that data centers, if you look on the right-hand side of that chart, joins air conditioning and EVs as a significant addition to power demand. It's not the only thing that matters. It's one of a number, but it is significant. But again, even that varies by country. So that's a global number, but if you look, say, at Indonesia, you'll see air conditionings double what data centers or EVs can be. So again, very different pathways for different geographies. So what about road transport? So this is EV sales continuing to grow. We saw battery prices, falling rapidly. That's feeding into EV sales. You can see, and on the right there, year to date, again, you can start to see China and Europe being much more above the global average. But again, if you roll the clock forward a little bit, what you'll see is pretty much all of those start to curve upwards. Again, that's the costs of batteries really starting to drive uptake. And you'll see the highest riser actually there is Australia, which is going to see a sevenfold increase. And that's really driven by that openness to all technologies, all providers. So Chinese EVs in particular will be a big driver of that number. So again, moving at very different speeds depending on the geography. Costs, so the cost parity in China is already below that of internal combustion engines, and that's why it's already taken off. And the other countries will cross that barrier. At the beginning of the year, this was the policy support across those all major markets. Again, EVs was the direction of travel for everybody. That's where we are now. So in China, those policies are still in place. The US, they're pretty much in reverse, and they're slowing down in Europe. But so in the US, what we think is we'll move by 2030, instead of almost half sales being electric vehicles, about a quarter will be, so it's 27%, just over a quarter. Again, it slows down, but it doesn't stop. The economics take over, and it still rises. And probably one of the clearest charts that show you the difference in geographies, this is Chinese EVs sales overtaking passenger vehicle sales in the US. So you really are seeing the two different pathways being chosen. And this will happen probably next year. In the hard-to-abate sector, so we've seen somewhat of a reset on that. This is for committed projects, so actually this number of 3.3 million metric tons is actually a small number, but it is growing, so we're starting to see committed off-takers for production. The left-hand chart shows you what was announced, with over 200 million metric tons. The bottom bar is what has an off-take agreement. The right-hand side, that's the 13.4 million metric tons, and the right-hand side shows you exactly who, really where the off-take's firm, and again, that's the bottom slice of that. So it's about 2 million metric tons of sort of, if you like, real business. And you're starting to see who the off-takers are. The off-takers are going to be people that use hydrogen today, so fossil-based hydrogen, also aviation and shipping. So these are the biggest deals. And you're seeing very different pathways again being chosen. So if you're in the US, you're going to have blue hydrogen, so gas and CCS. If you're in China, you're going to have renewables and electrolyzed, so green hydrogen. Again, two very, very different pathways. It's early days. We'll see how those scale. And lastly, I just want to talk about adaptation, actually. It's a newer area to us, but it's a real area. And, this is Europe. Fires in Europe in summer were really not heard of until very recently. But you can see how that has really started to become a real feature. So it's land burnt in Europe with wildfires. And our colleagues in Bloomberg Intelligence have crunched some numbers about what that actually costs. So last year, $1.4 trillion was spent on climate-related damages. So that includes damages to property, also the cost of outages of power, crop damage, inflation for build back, those kinds of things. All factored in, it's $1.4 trillion. And again, we said $2.1 trillion last year was invested in clean technology. So this is a significant number. If you just look at the property damage pieces of it, just look at the last 2 full years, it's around 350 to 400 billion. You'll see the costs were borne, about 50% was government. About the next half of what's left was insured, and the other quarter was actually uninsured. So these are real damages going out to households or banks that have lent the money. So again, this is now becoming a sort of serious financial consideration. We just did some research to create a country adaptation framework. We looked at 25 different countries. That's the x-axis here. And we put that against the Notre Dame gain, so the sort of climate exposure rating. And what you'll see is a very wide distribution. Again, by country, the preparedness and the impact will be very different. If you look at the very right-hand edge, these are the people who we believe are the best prepared. One is Canada, and one is Singapore, but then you see a long tail of other countries. So again, the pathway that's going to be taken, the approach to adaptation, the risks that people are facing, be it fires or floods or those kinds of things, or sea level rise, are going to be very, very different. So I think you'll find, every geography now is really on a different pathway. It was mentioned before about country platforms. That's important because every country is different, and depending on the pathway chosen, the speeds are also very, very different. There's a number of key factors pointed out that are really going to have a major impact across all of the sort of key sectors that we think about when we think about decarbonization. So I hope that framing is useful for you as you go into COP in the next 2 weeks. Think through a country lens and what does that mean, and hopefully that will help us all to make progress. Thank you very much, and enjoy COP30. Thank you.
Thank you, John. So that takes us to lunch. I invite you all to join us for lunch up on the level 2. I want to make sure that's right. Floor 2. Bloomberg Hub on floor 2. It's outside. So we'll have lunch there. We'll also have 2 different breakout options available if you're interested in either. First, we'll be hosting 2 deep dive sessions. Those will be in the networking hub that I just mentioned. These are just casual conversations that you can opt into based on topics of interest to you. There will be 2. One is the AI paradox, and the other one is navigating physical risk. So you'll see signs and moderators. You can just join those while you're enjoying your lunch upstairs. You can also, if you have been registered to attend our lunch breakout, Integrity and Impact at Scale, Carbon Credits on the Road to COP30, which is sponsored by Amazon, please head up to the Pavilion Room, which is also on level 2, and you can join us there. If you weren't registered, if you were interested in attending, they can check if there's space available, but it did require pre-registration as well. So we will see you back here at 2 p.m. when we start up again. Thank you so much for joining us.
Olá, sejam bem-vindos à nossa sessão Integridade e Impacto em Escala, Créditos de Carbono no caminho para a COP30. Hoje nós vamos falar sobre como as compras de créditos de carbono podem ajudar nesses investimentos. Tudo bem? Use novamente. Então, antes de começarmos, vou fazer rápidos anúncios. Aqui é uma sessão durante o almoço, então, por favor, durante a nossa discussão, fiquem à vontade para comer e depois reservem suas perguntas para o final da sessão, quando faremos uma sessão de perguntas e respostas. Também gostaria de dizer que o nosso patrocinador dessa sessão é a Amazon. E gostaria de pedir que me ajudem aqui a dar as boas-vindas a Ashley de la Torre, vice-presidente de políticas públicas da Amazon. Boa tarde e sejam bem-vindos a essa sessão da Bloomberg. Eu represento a área de políticas públicas da Amazon e tenho a sorte de trabalhar com equipes que desenvolvem as ferramentas, os produtos e os serviços que ajudam também a atender os nossos compromissos climáticos. A Amazon, todos sabem, enfrentou muitos desafios na sua jornada climática. E, no ano passado, lançamos um compromisso de sustentabilidade para poder dar suporte aos nossos fornecedores e parceiros de todos os tamanhos dentro do esforço de sustentabilidade. Então, nós temos então playbooks e estudos de caso, tudo que nós aprendemos e que eram proprietários e que agora nós compartilhamos para poder inspirar outras empresas a agirem. Além da Amazon, essa iniciativa também congrega aprendizados de outros setores, como a área de energia, transporte, construção, água e circularidade. Nós temos 280 recursos em 9 idiomas e 10 manuais nesse sentido. Também estamos muito empolgados com uma atualização nessa iniciativa, que é a parte dos créditos de carbono, que é para poder ajudar os signatários desses compromissos, para poder ajudar várias empresas a superar essas dificuldades através dos créditos de carbono, para poder ajudar nos esforços de descarbonização. Nós contamos com o conhecimento que ajudou a Amazon a poder fazer essa jornada e sabemos que outras empresas também estão comprometidas com a descarbonização e soluções que ajudem a nós termos benefícios climáticos realmente significativos. Nós trabalhamos juntos para poder criar ações conjuntas que levam a soluções e esses serviços ajudam a levar a mudanças significativas. A discussão de hoje ocorre num momento crítico, porque as empresas querem entender e implementar estratégias de descarbonização. Então, muitas estão aumentando as suas iniciativas para poder atender a esses desafios. São novos métodos, novas tecnologias e também algumas iniciativas de parceria para poder ajudar a comunidade. Contamos com muitos indivíduos para falar sobre integridade dos créditos de carbono e teremos aqui uma excelente discussão. Agora vou passar de novo a palavra para a Sarah Wells, que vai ajudar nessa discussão sobre o futuro e a qualidade dos créditos de carbono e como eles fazem parte das nossas estratégias de zero carbono. Agradeço a todos por estarem aqui. É muito bom ter um representante do governo brasileiro, da Amazon, e eu também estou muito empolgada em liderar essa discussão. Então, José, vou começar com você. Parece que há um momento adequado aqui por conta da COP30. Nós falamos hoje sobre compromissos também do Reino Unido e de Singapura. Eu gostaria de saber o que o Brasil pretende atingir com a COP30. E aqui, como nós temos aqui uma audiência corporativa, como esperam daquilo que as empresas estão fazendo dentro do mundo do carbono?
Okay, now it works. Thank you very much. Good afternoon, everyone.
Muito obrigado. Sejam bem-vindos ao Brasil, a São Paulo. É um prazer tê-los aqui. Especialmente nesse momento, estamos muito empolgados com a COP30, que ocorrerá no Brasil na semana que vem. Respondendo diretamente à sua pergunta, realmente nós temos um grande momento de impulso para o mercado do carbono, dos créditos de carbono no Brasil. Dezembro do ano passado, o Congresso aprovou uma lei que introduzia a parte de crédito de carbono, a Lei 15.042. Demora alguns anos para ainda implementar essa lei, mas existem algumas características dessa lei que terão consequências para o mercado voluntário e eu gostaria de destacá-las. A primeira é que nós entendemos que a NTS do Brasil tem uma demanda constante por créditos voluntários. Nós sabemos que, pelo menos no Brasil, uma das avaliações que nós fizemos do mercado é que nós temos muito potencial, podemos crescer muito, podemos oferecer soluções climáticas para o mundo. Porém, nós precisamos de políticas que permitirão que isso aconteça. Nós temos que dar suporte a esse mercado. E esse mercado ainda está dando seus primeiros passos. É por isso que a nossa lei exige que uma porcentagem de compensações de carbono possam ser feitas, mas isso exige também uma demanda constante de projetos. E isso terá o seu papel para poder trazer mais atores para esse mercado. Uma segunda característica dessa lei é que o órgão governante dessa lei vai ter as metodologias certificadas em relação à qualidade, medições e outros aspectos técnicos. A ideia é que seja como se fosse um gatekeeper para esse mercado voluntário, ou seja, só vamos aceitar empresas com alta integridade.
Will serve as a lighthouse for the voluntary market as well. Well, at least this is our ambition. Let's see. The next year we're going to have some news on this regard. And finally, also, we're gonna, as government, the government will provide its rules for engaging with Article 6. So, of course, this is a huge source of demand for our projects and for our voluntary markets, and we tend to use it responsibly. Of course, with a look to our NDC goals, but as much as we can, taking advantage of this mechanism. And given all this internal momentum, when we were deciding about what we would bring to COP30, the Minister of Finance, together in conversations with other actors, thought that it would be a great idea to bring countries together, bring other ETSs together to come up with common rules for, well, for some technical issues as well, such as MRV standards, as, for example, carbon accounting as well. But for use of offsets too, meaning that we would love to have a common understanding between ETSs all over the world as to what sort of voluntary credits are allowed in their systems, recognizing some sort of project types as robust and meaningful from the environmental point of view.
And Jamie, sorry, can I pass to Jamie and ask, as a corporate buyer, how do you view these government initiatives? And then more broadly, Amazon is obviously very active in offsets, and that's even against a backdrop where the voluntary market in total has been shrinking. So can you just explain your strategy?
Yeah, sure. So I'm Jamie. I lead carbon neutralization at Amazon, and I said this that third pillar of the climate pledge, which is our net zero by 2040 commitment.